Good morning, everyone. Thank you for joining us today. I'm Gil. I'm Gil. This is Steven. This is Kuhn. And we are the organizers of BAS. BAS is a Blockchain Application Stanford Summit. It's basically the in-person kind of nexus of thought leadership that we try to bring from the blockchain community over at Stanford University. So the three of us help run a bunch of things at Stanford, which is really exciting in the blockchain space. We run a blockchain accelerator called the Stanford Blockchain Accelerator that incubates teams from student alumni teams from the ecosystem. Kuhn started, and we teach a course on blockchain entrepreneurship that has a lot of thought leaders that come in, and we run this event series as well. So we also run a fund called Blockchain Builders, where we help support teams coming out of the ecosystem. But appreciate you being here today. We've got an amazing lineup of speakers, and the aim is to bring the foremost thought leaders together here and then highlight up-and-coming founders from within the ecosystem as well. So spread throughout, you're going to also see some exciting founders from the Stanford ecosystem and beyond speaking.
Yeah, awesome. I think that's a perfect intro. Just my name is Steven. This is one of my favorite days of the year. So please come say hi, enjoy the event and the speakers. Cheers.
Yeah. My name is Kuhn. As Gil said, we all did all the BAS thing and the class thing and the Blockchain Builders Fund and a bunch of other events and the Stanford Blockchain Accelerator. So happy to see you here and looking forward to chatting with you throughout the day. Thank you for coming.
And Wei Dai, who's the moderator, is running a couple minutes late, so he will be here literally in 3-4 minutes. So just bear with us, and we're going to get things kicked off in a second.
We'll start once he arrives. Thank you.
Cheers. All right, we're back again. There's some new faces. That's good. This won't be repetitive for everyone. We're doing this again for the live stream for all the people out there in internet land. So Gil, take us away.
Sure. Thank you guys again for coming. This is BAS. BAS is kind of the center point in the nexus of thought leadership around blockchain and entrepreneurship over at Stanford, and this is our kind of in-person event. We call the Blockchain Application Stanford Summit. We've been doing this for 3 years, and it's almost always been like about infrastructure because we needed good infrastructure before we could have applications. I'm excited that this BAS is actually almost all the application of blockchain in the real world across finance, fintech, AI, et cetera. So this is Steven Willinger.
Hi, nice to meet you. I'm Steven. I help run all the things that Gil just mentioned at Stanford as well as our fund. Previous background was at Coinbase Ventures, and before that, I built stuff at Google for a long time. This is one of my favorite days of the year, so I hope you all really enjoy the program we have set up for you. It's awesome, and also hopefully you get some good swag. There's some free hats in the front. Those aren't reserved seats. Those are free hats, so if you want to move closer and get a hat.
I'm Rosen. I was a founder building kind of distributed compute platforms and big data platforms for the IRS, London Stock Exchange, and a bunch of others, had a couple companies, and then pivoted into blockchain to be a builder investor and to support all the programs that we're doing over at Stanford. And many of these programs are ones that Koen started, so I'll let Koen give a quick overview of the programs that we run over at Stanford.
All right, thank you, Gil. So my name is Koen, Master in Management Science Engineering at Stanford University. I started teaching a course, now teaching it for fifth time, blockchain entrepreneurship at Stanford University. Also started a Stanford Blockchain Accelerator, been running that with Gil and Steven for 4 years. And then also the Blockchain Builders Fund that we started together, and then several event theory like East New York, East SF, and also BAS. Like this is, as Steven said, is also my favorite time of the year. We run major BAS twice a year, once during Stanford Blockchain Conference, once during Eastember. So yeah, happy to be here and looking forward to chatting with everyone, as I mentioned before. Thank you.
Thank you, guys. We've got an awesome set of speakers and some new founders coming up from the Stanford ecosystem. And with that, we're going to have Justin Brill from Anchorage Digital, head of revenue, being on a fireside chat with Brent Matterson from Bankless Ventures.
All right.
All right, good morning, everybody.
Hi, everyone. I'll get started with an intro. So I'm Brent. I work at a fund called Bankless Ventures, and we invest in early-stage crypto companies. And we're lucky enough to have Justin here, who heads revenue over at Anchorage. And Justin and I have actually known each other for a little while, but not in person, so it's really great to be able to meet you in person. And as part of that, that's through the new Anchorage Ventures, initiative that they have. So maybe to start it off, it'd be great, Justin, if you'd like to give a little bit of an intro on yourself too.
Yep. Did a bunch of years on Wall Street to start the career, mostly in foreign exchange, some futures trading, and then moved about 5 years ago into crypto. Full-time, was at Jump Trading, Jump Crypto, running some of the market-making sales and early-stage venture operations, and got recruited about a year ago to be the head of revenue over at Anchorage Digital. Jump's a client. That's how I got to know them, and it's been really cool to see the evolution of the more and more traditional players coming into the space, and I guess that's what we're going to talk a little about today. So, excited to be here.
Cool. So we can kick it off with maybe the first question. So Anchorage has a ton of offerings, custody, security, trading, settlement, staking, self-custodial solutions now, and a venture arm now too, right? So, as head of revenue, I'm wondering if you could give us a little bit of a peek into, where you're seeing biggest adoption right now, and also maybe what, as a part of that, makes the most money too.
Yeah, good question. I mean, I think generally the services that are the least commoditized and the newest and the you're the fewest competitors offering them are where you can charge the most. So we've tried to take some more concerted bets on chains that we believe in and try to get there early. It's if you're supporting a particular L2, you don't just want to do the basics of just custodying the asset. You want to enable all the ways you can interact in DeFi, support staking, support different integrations we've done. Yes, with our Porto solution, and it is really difficult to try to be everything to everybody because we have those grown-up clients like the BlackRocks. And we have the new launches. There's partners who we get involved with from super early stage when it's just two people in a room with a white paper. So I think really it's been some of those things that aren't just the core custody offering, and it's where there's like more bells and whistles, and there's not just any old provider who can do it.
Nice, that makes sense. I mean, maybe talk to me a little bit about the ventures arm that you guys just launched too. I mean, that's really exciting, and I think it's a way for us to be able to collab too more.
Yeah, we've been sharing some deal flow with Bankless Ventures, so that's been cool. And I think, before I got involved and became an Anchorage client, I didn't probably understand everything that they did for some of those early stage teams. It's a really amazing founder success story. It's just two guys who started the firm 8+ years ago. Diogo and Nathan now has over 700 employees, a bunch of offices, thousands of clients. It's really one of the true, amazingly cases where we've seen a company grow to have institutional fit from the crypto space. So what I'd say the venture arm from that perspective is about trying to give back to some of those early stage founders, understanding where they are in the journey, come in with some of these early stage checks, nothing crazy, but pre-seed round. I've seen getting involved with hackathons was one of the first ways I got involved in crypto. Really moves the needle when you can give some of that support and also help with some of that institutional distribution. We have a few really great developers who spend time with the teams that we work with, and we've written somewhere around 9 or 10 checks right now. We're doing another demo day, our second live demo day later today, and hoping to write a check to one of the winners out there. So I think it's just another way to sit at that intersection between, we have so many clients who are looking to deploy capital, those who are looking to raise, and that's a role where I think Anchorage can really add value.
Yeah, super cool. So in your position, you are super well set up to see the shift of institutional adoption. Where are you currently seeing the most growth, and for what use cases would you say?
Yeah, it's amazing when I think back to my early career and the type of clients, whether it was pension funds or asset managers or those sort of firms I was having meetings with. I thought I was kind of running away from all of that when I got when I got into crypto, and it's amazing. I do still think it's very far from all figured out, but everyone from some of the largest GSIBs, globally systematic important banks, to old, stodgy, risk-averse pension funds. Everyone wants to take a meeting to have a digital asset strategy, to talk not just about Bitcoin, but developments in stable coins, ways to generate yield, I think is a big topic of conversation. So what I'd say is, it's happening more and more. I think it's interesting, and I've seen this as all these different markets proliferate. You do get more of these frenemy type situations where someone who is a client of ours, we could be viewed as a competitor, as we launch new businesses and different sort of services is something you can't totally be blind to. So, the whole idea of really just trying to grow the pie, I think is really, really the most important thing that it comes back to, because, that's what's going to allow us all to be successful.
Yeah, totally. Kind of flip side of that, are there areas that you're seeing any contraction right now? Maybe liquid funds, some crypto treasury companies.
Yeah, you haven't heard as much about DATs and digital asset treasuries launching in the past, let's call it 3 months here. There are still some, that is a space where we do have a lot of clients there, and I think that is a great role for a custodian to play, and some of them, like all these new innovations, you can't say like necessarily all of them are always going to work, but I don't know. It's definitely an area where generally, I don't think you're seeing as much buzz around it. But generally, look, I don't think we can say we're in the height of an absolutely ripping bull market right now, right? Like deal flow generally, when I think about investment committee, we do still, again, we just wrote 1 or 2 checks. We do still think there's interesting stuff out there. We're building new integrations all the time, but the pace, it used to feel like, oh man, I think we need to add an extra IC meeting this week. There's a crazy backlog. And now it's like, okay, more like normal course of business.
That makes sense. How far along do you think we are in TradFi, with TradFi and fintech adoption? So are we really talking like serious replatforming right now? Do you have like a segment that you think is like excelling specifically like within this? Would you say it's like also like larger? I mean, you kind of mentioned it's a lot of larger institutional players, but Are you seeing, maybe smaller banks, smaller organizations also kind of seeing crypto as like an edge?
Yeah. I think when you talk about the pace of some of these massive, large global institutions, they move pretty slowly. It's like anything, it's a crazy amount of changes happening in one calendar year. Even feels sort of abrupt. But I would say, perfect example. RIAs, a little bit more independent. They are getting some demand from their clients as some of this wealth transfer has happened with younger generations saying, I want to be able to custody these assets, not just the ETF. They might have had some younger clients come onto their books. And that's an area where I've learned financial advisors, if they can charge for something, they're willing to put it out there. So we do have some pretty plug-and-play solutions, up another 20 basis points, 30 basis points, whatever it might be, keep my client happy. Like I have seen some of that in my own portfolio. I would definitely keep my accounts consolidated if I could, right? So that's an area where I would say, like there's thousands upon tens of thousands, maybe more, and the service offerings haven't been amazing. So that's an area where I've seen much more uptick than if you asked me a year ago.
Cool.
It's been impressive.
Awesome. What do you think was the most overrated expectation of institutional adoption last year? Or, what was the biggest maybe misconception around institutional adoption that people had last year?
Just in the last year. I mean, we did have some really serious clients who were asking us to build out support for an array of meme coins. So I know there was actually like some people who bought into the trend, if you will. But in hindsight, it seems sort of ridiculous, that all these things, when you look at the market caps and all the other values. I mean, honestly, man, I might go with that one.
Okay.
I mean, that's
fair.
That's one where there were people who really kind of believed in it in some kind of paradigm shift or something along those lines. Where like I thought it was a fun little thing, you could like a little bit of a weekend hobby. It seemed like almost ridiculous, but when people are talking about launching ETFs and some of these meme coins, I was like, okay, this is a bridge too far, almost, But, ETFs are an area where there's just you see, even some of the ones who you'd call slow movers in the space. I spent 12 years working at Morgan Stanley. When they do something, they go big into it. They didn't, necessarily have an ETF for a while. Now they do. I think that, they're going to be up there with the biggest sooner rather than later. Schwab's talking about it, all these big players, it's just a matter of time, I think, before the product suite expands well beyond just Bitcoin into some of the other core assets such as ETH.
Yeah, great. So a lot of crypto companies have avoided the US for a long time. And that's kind of been changing, last year, maybe kind of as the start of it. I'm curious if you've seen like that shift at Anchorage and how you're thinking about serving more US companies and having, more products aimed at like US customers.
Yeah, really fair question. I mean, Anchorage has had an OCC charter, federal charter, for 5+ years at this point, so it was always kind of held to this higher standard. And then, the government wasn't really open for business for a while, let's say fully with granting new ones. Now there are others that I think it's really good to have increased competition in a way, and we've always said that couldn't be our only moat. It's nice that there are folks who, can do it the right way, and that we have a supportive legislative body behind us in that regard. I guess what I'd say is, from previous shops, just hearing so many new entrepreneurs out there and companies who just were too scared of getting a Wells notice or just getting debanked, that they didn't stop building anything they were going to build. They just moved it offshore. Yeah. I think we won't ever really know the effects of that. And then it almost sort of like quietly everything got moved back. Anchorage never really changed. Like they were one of the few companies because of that sort of status as a bank that they couldn't have done any of that. But like we have offices, we have a Singapore license and offices in Portugal and other offshore locations where we do other business, just like any other company. But hopefully, I think people have realized that they want the core of the innovation to happen in the U.S. and I think we're set up for it too at this point.
Yeah, good. What do you think is still missing from an infrastructure, regulatory, UX, market maturity, kind of anything perspective that is stopping crypto from truly penetrating mainstream finance, if anything?
I mean, there have been some really cool inventions. I still think perps are something that TradFi didn't figure out for a long time that has continued to be an amazing innovation. I don't necessarily think, I don't really think we need 50x or 100x leverage in all these other products. I don't think that's the innovation that is keeping us from, mainstream adoption. There's elements, of course, that should, that where it can feel like gambling in all these markets, but that feels like a little bit too much. To me, I think it's just more robust liquidity. It should feel like, it should feel like there's deep and orderly order books in all of these places where we're trying to trade. It should feel like the infrastructure is going to work when you click on it. I think those sort of things where it's just of course, Bank of America's website can go down too, but I think that's the thing that's really holding us back is just, a cleaner, more integrated UX. That's the biggest thing that still is lacking a little bit to me.
Yeah, totally fair. Well, we have 5 seconds left, so thank you so much.
All right. Yeah, great talk. Thanks, everybody.
You need to introduce him.
All right. Thank you, Justin and Brent. Next, we've got Carolyn Pham, who is currently Chief Legal Officer and Administrative Officer of MoonPay and was the former commissioner of the CFTC. And she's going to be moderated by our very own Stephen Willinger, founding partner at Blockchain Builders Fund.
Thank you, Gil. All right, how's everyone doing? Okay. Caroline, thank you so much for being here.
Thank you for having me. It's super fun to be here in Denver.
Amazing. This is the second time we've had Caroline on one of our stages in the past month or two, and so y'all are in for a treat. We're very lucky to have you. So let me do a quick intro and we can get into the fun stuff. As Gil mentioned, Caroline is the Chief Legal Officer and Chief Administrative Officer at MoonPay. Prior to that, she spent 7 years at Citi, where she held senior roles across legal compliance, Chief Administrative Office, and many other groups. I won't do the full list, but it's quite long. Obviously had a huge impact at Citi. She later served as the acting chairman at the CFTC during one of the most consequential periods at the CFTC. And so I won't get into that because we're going to go into it later, but it was highly impactful. Suffice to say that twice she was named one of CoinDesk's most influential figures in crypto. And I think, candidly, we all owe her a thank you for the work she did. I think one of my favorite quotes from you is that you can just do things.
Yes.
And I would say that really summarizes her time there. So maybe I'll turn it over to you, Caroline. Can you tell us a bit about what the CFTC looked like when you took on that role, and then what changed, and sort of like how the CFTC is standing now after you've left and moved on to MoonPay?
Sure, of course. So it's really great to be here. Thanks so much for having me. You know, what's interesting and what I think sometimes people don't remember is that when I became a commissioner at the CFTC, it was actually my 4th time at the agency, because I first started at the CFTC as an intern in 2009, and then was there through a number of different roles, including being a commissioner, counsel to a commissioner. After the Dodd-Frank implementation, I actually worked when Chairman Gary Gensler was chairman of the CFTC, and then went and had a private sector career. So the institutional knowledge that I bring to the agency is actually something that spanned like 15 years. And so what was interesting to me when I joined during the last administration, so I became a commissioner in 2022, was actually how different the agency had been from when I was there previously after the Dodd-Frank Act. And to be honest, how the agency almost had an allergic reaction to innovation, had an allergic reaction to new products and new markets, which is not how the agency traditionally has been over decades. The CFTC has always been at the forefront of innovation. It's right there in the CFTC's dual mandate, which is to promote responsible innovation and fair competition. So that was one thing. And I would say that that was actually actively blocking new markets and new products, which, again, I found very disappointing. The other thing that was really surprising to me was that although the agency was not doing a whole lot in the way of creating regulatory frameworks around developments in the markets, there was so much enforcement. And it was almost like the first reaction to anything new was let's investigate it and bring an enforcement action. Then, of course, that was regulation by enforcement. So that really is the context of how surprising it was for me and how different it was for me to join the agency during the last administration.
Yeah, brutal before. But then in your time there, could you maybe give us a quick zip of the major accomplishments and what we're sitting on now?
Sure. So I'm really excited to talk about why 2026 is the year of institutional adoption, as sounds like some of our previous panels have been doing. And a lot of that is because of the tremendous progress and regulatory clarity that has been made under this new administration, under President Trump, and his leadership. So as a commissioner, of course, I dissented on much of the regulation by enforcement. I identified a lot of the blockers, and I proposed like a comprehensive strategic plan for reform at the agency to foster innovation and address some other structural issues at the agency. So last year, you really had some very key milestones, right? Just to quickly recap. So the President's Working Group on Digital Asset Markets, which the CFTC, which I was a member of, that really laid out the U.S. crypto policy roadmap. And so what's been happening since that report was released in July was that the agencies have been implementing it. So the SEC launched Project Crypto. I launched the Crypto Sprint. Those now have been combined under just one, Project Crypto. And the key milestones of the CFTC's Crypto Sprint last year, what has really created the environment for institutional adoption this year are a couple key things. Number one, for the first time ever, there is a federal framework to trade leveraged spot crypto on a CFTC-registered designated contract market, a CFTC-registered exchange. That's huge. That's new. That never existed before. It's been part of the CFTC's authority since Dodd-Frank, but the agency never implemented rules for that, even though exchanges had been coming and wanting to list leveraged spot commodity transactions since at least 2020. Then the number two thing, which was really key, was having a tokenized collateral guidance. So when you think about the size of the CFTC's markets that we oversee, right? It's a global market. It's the global nearly 700 trillion notional derivatives market. That's massive. And so much of that is everything that underpins, right, the real economy. The key piece in that is collateral management. Capital efficiency is actually what helps to drive liquidity. And so having tokenized collateral was the real world asset piece of what the CFTC did. So that was for RWAs like tokenized treasuries, tokenized money market funds, payment stable coins, and other RWAs. And then the other piece, finally, was having the collateral guidance for native crypto assets like Bitcoin, Ether, and payment stablecoins like USDC. So I created a pilot program last year so that the CFTC registered brokers could accept Bitcoin or Ether or USDC or other stablecoins as collateral for their trades. This just, again, creates the capital efficiency that allows for more trading, which means there's more liquidity, which means there's more efficient and effective markets. That's why you see so many institutional players coming into the space, because they needed that clarity around tokenized collateral, the pilot program, and I think that's why you're really going to see some exciting things this year.
Amazing. Yeah, I can't understate how important.
Oh, and I ended regulation by enforcement. You're welcome.
Yeah, can't understate how important the clarity on collateralization is. It allows all these assets to become clear collateral and then settle as quickly as it's meant to on the blockchain. Thank you so much for all your work there. I'm going to skip ahead to prediction markets, and we'll come back to clarity if we have time. So prediction markets, obviously, insane product market fit, one of the fastest growing segments in our industry, right? But as things grow, they draw ire, right? So I've got 2 quotes here. Event contracts offered on some prediction markets mimic sports bets and may operate as unregulated gambling without consumer protections, blah, blah, blah. New York Attorney General Letitia James. Uh-oh. On the other hand, we have Brian Armstrong saying, prediction markets fall under the CFTC. Any state saying otherwise is keeping Americans from accessing tools to get them ahead. Like, help us understand a bit more the nuance around prediction markets and why a prediction market is a prediction market isn't a prediction market.
Sure. So I'm happy to talk about this because there is so much noise and misinformation out there, and so I'd love to be able to help set the record straight. And there are obviously huge announcements that are happening. Just this morning, CFTC Chairman Mike Selig said that the CFTC was going to file an amicus brief in some of the litigation that's ongoing. We are really starting to see some developments here. So a couple things. Number one, I've been working on event contracts since probably 2013. And the CFTC has this long history where for over 3 decades, there have been prediction markets or event contracts under the CFTC's jurisdiction. And what I've been talking about for the last several years, including with sort of the first thing that I wrote that was a dissent in 2022, and then going on from there, is what we're really talking about here with prediction markets, which is so exciting about it, is a prediction market is an information market. It is the first market that is just pure signal. It is sentiment. So you are able to take these signals and this sentiment, and you're able to really provide, using the power of the market, accurate information that I think is so critical in this era where we have Gen AI. We have so much information that is out there. How do you know what is real? What is the most valuable commodity of all? It is information, as we are living in a digital age and a digital economy. What is real? What is true? And so again, if you look at the last election, there were signals that were being produced through the prediction markets that showed the utility of these markets. Okay, so then why the CFTC, right? And this is something that I think people have lost, right? So the CFTC has a national public interest that is in our statute. And this is what I think people really need to be focusing on here, right? So there are 3 reasons why the CFTC has markets that are in the public interest. Number 1 is for price discovery. Number 2 is for price risk mitigation. And number 3 is for price dissemination. That's it. There's a lot of people talking about hedging utility. There's a lot of people talking about economic purpose. Those are actually old frameworks that the Congress abolished from the CFTC's statute back in 2000. So there are people clinging to this previous iteration that doesn't exist anymore. And so that's why I think to be successful, people really need to focus on what is the actual public interest, price risk mitigation, price discovery, price dissemination. And that's exactly what markets do. I mean, that markets, if you think of the stock market, it takes all the information available about a company, its management, its strategy, its capital, its OpEx, all of that, and distills it into a single price. And so that's what we're seeing happening in prediction markets. There's so much more that I can go into here, but do you want to jump in?
Yeah, I think the one thing I heard you say as we were talking earlier, it's not all prediction markets are the same, right? A sports gambling prediction market versus a financial event prediction market. What are some of the distinctions that we should think about as we start to see regulation and perhaps legislation form around prediction markets?
Yeah, so one of the key issues I think that's going to be coming out in the litigation is that even before you get to what is the underlying in one of these prediction market contracts or event contracts, right? Like you said, a sports game. Even before that, what actually are these instruments under the CFTC's jurisdiction? So they are retail binary options, and options are a type of swap. So under the Dodd-Frank Act, that's what gave the CFTC jurisdiction over it. So it is an event-based retail binary option, which is a swap. What's the definition of a swap under the CFTC's jurisdiction? It's very long and complicated. I actually had a 200-page swap definition policy when I was at Citi, but the long and short of it for this purpose is that it is the occurrence or non-occurrence of an event associated with a potential financial, economic, or commercial consequence. Okay, again, that's not about hedging, that's not about economic purpose, that's something associated with a potential financial, economic, and commercial consequence. So how far out does that extend, right? When you think about things like sports games, they do have a tremendous economic consequence on the cities, where they are, right? So this was some of the earliest arguments supporting having contracts on sports games is if you are local business owners or you're a sports team or any of those types of things, stadium owner, there are financial, economic, and commercial consequences associated with the occurrence or non-occurrence of that event. So there's so much more to unpack here. There is also what happened in the Dodd-Frank Act is there was a kind of a carve out, right, from the kinds of event contracts that you could have. And so it specifically says that you can't have event contracts that are based upon war, terrorism, assassinations, gaming, or any activity that is unlawful under state or federal law. And it's those last two prongs that are really at issue right now with all of the litigation.
Fascinating, fascinating. So interesting. It sounds like there's actually a bull case for sports to still be on prediction markets. Although maybe that's not what you were saying. That's what I heard. Sorry. One other topic on prediction markets. I found it interesting as we've talked about this. Like, this is going to be an issue. We're all going to watch this play out in PR, in Washington, and at state and local fights over prediction markets over the next year. Can you help us understand like where the power lines are drawn? Like, who cares and why?
Yeah, absolutely. So here's some like key issues, right? So first of all, the CFTC absolutely has exclusive jurisdiction over swaps. The CFTC has exclusive jurisdiction over derivatives in the United States. That is how the CFTC and the SEC's jurisdiction works, right? If it's a derivative, the CFTC has jurisdiction that preempts all of the state laws and regulations. If it's a security, it's the same thing. The SEC has preemption power, but then there's this interesting thing between like state blue sky laws and SEC securities. But so it's really like, first, what is it? So that's why that matters. And then, why do we care? Like, why is this going to be so important?
Well, I think what
are the players?
Yeah. So,
involved?
well, your stance is obviously CFTC Maxi, which makes sense. Anyway, I'm putting words in your mouth again.
Maxi.
But there are going to be other, could we kind of like steel man the arguments made, or at least the incentives made by, let's say, like state legislators?
Exactly. So let's get into it. So why is this going to go to the Supreme Court? Because I 100% think it's going to go to the Supreme Court. The reason why is because you are really having that tension between like our system of federalism, like what is for the federal government to regulate, and then what is at the state level. So that's a 10th Amendment issue. And there are court cases that say that historically the states have regulated gambling. And so where are the interests there? There is, of course, tax revenue that is generated from gambling. And there are also states where it's in their constitution or it's their culture where states have either allowed or not allowed gambling to occur. I mean, this is one of the oldest industries, right? And so I think that that's a really interesting piece there. On the other hand, right, you absolutely have to have the integrity of the markets, and that's why the federal system is so important. So it's going to be a 10th Amendment issue. We are going to also have some interesting, I think, so first of all, the CFTC has a terrible track record in litigation, by the way, on this issue. So under the last administration, the CFTC lost the case in the DC District Court, the Fifth Circuit, and was going to lose the case in the DC Circuit, which is why the commission voted to dismiss the appeal there. What is going to be interesting is that the CFTC actually has Supreme Court cases. There's a cluster of them in the 1920s and the 1930s. There's another cluster of them in the 1980s and the 1990s. And those actually really dig into what is the CFTC's jurisdiction, where's that line between federal and state. I think we're going to see some of that coming out now because I was not able to hire or to do a lot of the things that I wanted to do last year to create regulatory clarity around prediction markets, which is such an important innovation and also important to get it right, that balance between federal and state. But now the CFTC has an all-star team, right? You have Chairman Seelig, you have Tyler Badgley, the new general counsel, who comes from this background where he was on the U.S. Chamber of Commerce's litigation team. I mean, that's an all-star team, the Fifth Circuit, Sullivan and Cromwell. So I think this year you're going to see so much activity here. But again, to what you said earlier, there's a difference between the sports contracts and then all of the other prediction market contracts.
Amazing. That's going to be a hot space to watch this year. We're very lucky to have heard your brief teeing us up for it. Follow Caroline on Twitter for more takes on it as we go. And I think that's all we have time for. So thank you so much, and thank you to the audience.
Thank you
Cheers.
for having me.
All right. Thank you, Caroline and Steve. Next, we have Tomasz Stanczak, who until recently was the co-executive director of the Ethereum Foundation. So excited to hear Tomasz give his perspective and inside view on Enterprise Ethereum 2026. All right.
Hey.
Thanks, Tomasz.
Thank you. Hi, everyone. Good to see you. I'll go over maybe like high-level enterprise Ethereum vision goals, probably from the foundation perspective. As you know, Ethereum Foundation act mostly as a coordinator, activator. We don't really deliver directly, the products for enterprise, but we do work with the entire ecosystem of Ethereum, trying to make sure that there is a good information flow support for everyone that chooses Ethereum as a platform to build on. And quick review of the numbers. So after 2025, I think that we have pretty solid results with Ethereum in the real-world asset space, both on the stablecoin side and the asset tokenizations. Ethereum increased the market share in both categories last year. So it was the strongest, and it got even stronger. Here we see 58% market share of the asset tokenization on Ethereum, and the asset tokenization market is continuously growing very, very strongly. So I think that over the last month we had 20% increase in those distributed assets on the network. So particularly on the rwa.xyz website, we see those two categories: the distributed assets, so the ones that are actually deployed on chain and can be freely traded. They also added category that's called represented. So this is more like just keeping some kind of chain as a registry, but not really allowing people to trade those assets. So there we see the canton, but I think that what will happen is that practically everyone will be talking in the long term about tokenization as a distributed assets, the ones that you can actually trade on chain, and that's what we really get excited about. So I think that all of those assets that are represented now maybe will go another step and will be traded publicly on Ethereum or on Ethereum-related networks. So this is stablecoins market. So you see 55% on Ethereum mainnet. I think on Ethereum we lost around like $10 billion of assets last few months. They went to Tron, to Solana, to BNB chain, but still Ethereum is holding strong, and I think it's still like on the long term it's improving the market share as well. And I think we see for both markets continuation this year in 2026. In 2025, Ethereum Foundation was considering that was pivotal year for talking about Ethereum, for showing to enterprises, to governments, to regulators what Ethereum is about, how Ethereum is credibly neutral, what are the reasons for choosing Ethereum. 2026, I think many of those conversations will be bearing fruit and still be bringing more and more institutions to Ethereum, choosing Ethereum, knowing why they're choosing Ethereum, and more regulators feeling entirely familiar with the network. What happened last year and happens this year? So Genius Act and Clarity Acts in the US. So we had a lot of clarity in the Genius Act about stablecoins, but the continuation, what happens still is this big debate about non-interest bearing versus yield bearing stablecoins. So if that happens, then we can have a massive change, because for the customer's perspective, the stablecoins will become much more convincing way of storing assets, right? So nowadays, the companies will still go for the money market funds instead of holding assets in stablecoins. But if we would have the interest-bearing stablecoins, then much of the banking systems gets somehow, like it's a very strong competitor from the stablecoins issuers. So while we have already much of clarity on the rules of issuing stablecoins in the US, there is still that step of big fight, like fight on the side of policy between the existing banking system and the stablecoins issuers and the crypto native solutions. On the Clarity Act, you may have heard, you're probably discussing it. There's lots of uncertainty at the moment about whether it will pass, when it will pass, whether it will have full support because of concerns from some of the major crypto operators about whether it really satisfies what the industry is expecting. So those two acts really drive the market changes in the US. Those changes in the US were driving the enterprise Ethereum adoption, and I think the continuation of that strategy should simply see more and more institutions getting on board. Why they choose Ethereum? So Ethereum, I think we can start talking really in the terms of risk. Historically, when you think about the crypto native people, they would talk about trustless, they would talk about decentralization. But really when talking to institutions, to enterprises, it's good to mention that Ethereum really has this very good risk metrics from the perspective of blockchain. So by decentralization, we deliver low counterparty risks. Credible neutrality of Ethereum is really low jurisdictional political risk. Ethereum is accepted widely internationally by regulators as a credibly neutral chain with very high security and legitimacy. So it's seen as something much safer for the institutions to adopt. Security focus of the Ethereum ecosystem coordination, security focus of developers, core developers, that's really low technology risk, and that's why we see Ethereum now leading the efforts among the large chains on the post-quantum security. On top of it, Ethereum continues as the largest developer ecosystem with deepest liquidity in the DeFi market, stable coins, most institutional integrations. It also has the L2 ecosystem where many of the enterprise chains can be launched on Ethereum layers. And generally, regulators continuously say, we are familiar with Ethereum, we understand Ethereum. If you're choosing Ethereum, this is something that we're familiar with. It's a good choice. What else? We'll see in 2026 for sure an explosion of agentic commerce, or at least the explosion of interest in agentic commerce. So we have standards and solutions like X402, A2A, 8004. So these are systems for reputation of agents, registration of agents, agentic commerce directly. So various protocols enabling agents to use stablecoins and other assets and start trading between themselves. And here we have a quote from the Circle CEO saying that practically billions of agents very soon will start trading with stablecoins on chain. And we can expect that majority of that will be on Ethereum. So one thing that I was exploring recently, even last year, I was asking very often myself a question whether agents would really choose blockchains, like whether it's so obvious, because we keep saying it's obvious that the agents will use stablecoins. That is the most natural way for integrating agentic systems that are really digital native and would choose blockchains and feel safe there. It feel like this is the easiest way to manage money. And like a week ago or so, I asked this question to Claude and ChatGPT, the newest models, and I asked them, what do you expect to be there for the next 2 to 5 years? Would agents use blockchain, or they would use traditional cards, like debit cards and banking accounts? And the answer from both systems was that they would probably use traditional financial systems. And the reason for that, they say, is there's still lack of integrations of stablecoins payment systems to be able to pay for everything. So I think the big expected change that we can see is that as agents are representing more and more users, there'll be more and more demand for the services that are catering directly to the agents. And maybe this will be that pull for more of the stablecoins adoption, and we'll see some dramatic increase of the stablecoins adoptions because of those new agents entering market and the totally new software as a service solutions delivering to agents directly and thinking that then they have to support stablecoins. In the meantime, if you're asking your agents to set up a GitHub account, to set up Versal accounts, to buy a domain, very often you have to equip it with a card, with a debit card, potentially with a crypto debit card. Now, what Ethereum Foundation did in that direction, so the AI Ethereum Foundation team talks about standards, 8004 for trustless agents, and separately, okay, now I'm jumping to the next topic. So the post-quantum security thing, and this year we announced that for Ethereum Foundation, post-quantum security is a strategical priority. Why we do it this year? It's not that we're starting this year, it's really continuation of the 5 years of research and roadmap. Actually, I think 2 years, 1.5 years ago, when Justin Drake went on stage in Bangkok and said, here is our 5-year lean roadmap, and he talked about quantum, post-quantum security. People thought, oh, this is too long a roadmap, and the cool thing is now we are 2 years into that roadmap, and everything is progressing very well. And the next 3 years means that already Ethereum is in a very good position to be presenting the full scope of solutions for the post-quantum security. This year, we announced it very clearly and started talking about it a lot because this is the year when there is a lot of anxiety from institutions about whether blockchains will be quantum secure. And here are examples. There's lots of anxiety around Bitcoin now. I think it's around 6 million Bitcoin at risk. And quote from Nick Carter that says that really there's a huge discrepancy between how the markets are thinking about the risk of post-quantum security, because the markets are choosing now the technologies for the next few years or where to allocate funds, while the developers, core engineers are thinking more about, oh, somewhere there in 2035, 2040, there'll be a quantum threat, so we don't have to rush. But I think it's very important to think about the anxiety of the users. The users are choosing their technology stack for many years ahead. So this is the mentioned lean roadmap for Ethereum. We are in 2026, and we're building those solutions. We're deploying DevNets. Here is the progress of the improvements on the lean signatures, hash-based signatures that are quantum secure. So we're targeting proper throughput and sizes of the signatures. Also on the aggregation of signatures for the consensus layer. So this looks super, super promising. And we've already deployed 2 DevNets, and the third DevNet is in operation, is active now. And many teams are working together on this post-quantum security solution. Here is some more set of research progress on various aspects of post-quantum security. And separately also, we're talking a lot about the program that we call $1 Trillion Security. So last year we announced it. We continued with a survey of various ecosystem infrastructure builders, users, wallet operators, institutions. We asked them what you're worried about on the security side, what are the risks, where do you see the most breaches and hacks happening. And based on that, we collected a few areas where we continue improving and supporting through the grants and ecosystem collaboration system to be more safe for the users, whether it's institutions or retail users. So institutionally, really, this continues to be showing that we put a lot of effort to make sure that not only network upgrades are there, properly tested, verified, but also that all the tooling around Ethereum is safe. And we keep talking about security because this is the reason why institutions choose Ethereum, and they will be choosing Ethereum for that reason in 2026 as well. Quick review of what will be happening globally. However, this is mostly like just, you can treat it as, you could probably generate it at home and review. But I have 1 minute more, yes, okay. So Europe, Micah, I think that most important thing is that it's maybe less progressive or very clear. So we have some tokenization happening in Europe through like France, Luxembourg, solutions, tokenization for those countries, but also Germany. Big discussion about euro-denominated stablecoins. Still, dollar is 99.9% of the global stablecoins. In UK, we may see a bit more of the tokenization sandboxes, but still, I don't know, I've lived in UK many years, and I think I was always disappointed with how slowly in the end the things moved, but some promises are there. UAE, particularly Abu Dhabi, Dubai, we definitely seen them waking up last year to become more of tokenization hubs. A quick review: Singapore, success; Hong Kong, tokenization. Here we have, oh, I had one more thing, but okay, I'll skip it. This is a quick review. I wasn't sure if I'll have much more time, but this was not so critical. Thank you so much.
Thank you, Tomasz. So I think we could all see that we've gone from a world where Ethereum is purely for the crypto punks and the degens to it is here for industry, for enterprise, and for all. Next, I'm super excited to introduce Daniel Marin of Nexus Labs. Nexus was one of the projects that was in the Stanford Blockchain Accelerator, and they have a ton of exciting things that they've been building across the enterprise space as well now. So
thank you. Thank you, Gil.
Thank you.
Hello, hello. Great to see you. Great, I'll give a pretty quick keynote here. I will talk very briefly about the Nexus project, what's coming next, and so on and so forth. Interestingly, this is the third time that I give a talk at BAS. The Stanford community has been a place that the Nexus project has been part of for quite a bit now. So I'll go straight into it. I will talk about an interesting concept that we are about to launch. So just some context here. Nexus is an upcoming layer 1 blockchain. It was incubated at the Stanford Blockchain Club a couple of years ago. And we work in the field of verifiable computation, and in particular in the applications of verifiable computation and zero knowledge proofs in the field of finance. We talk a lot about the concept of verifiable finance, and we think that it's an exciting new primitive that is arising as we speak in the blockchain landscape. Interestingly, we think about it as something that goes beyond DeFi, right? Decentralized finance, something that is closer to traditional finance. So anyway, there's the definition. In particular, we're excited about not only the decentralized property, so to say, but the properties of programmability, composability, and of course verifiability. So as you all know, traditional finance has a lot of bottlenecks. One of the exciting things about blockchain and beyond, in particular zero knowledge proofs, is that it allows for the properties of composability and programmability, which interestingly, and I'll speak about that soon, allows us to create new financial primitives that are impossible to see in the traditional finance space. So once again, a little bit of context. Nexus is a layer 1 that was built under the premise of verifiable financial computation. This is upcoming, and it is about to launch. Recently, we announced the upcoming launch of the Nexus Exchange. The Nexus Exchange is an upcoming decentralized perpetuals exchange that will feature various types of markets, such as equities, commodities, forex, so on and so forth. Many of you are probably familiar with the Hyperliquid project. Interestingly, here at Nexus, we think that some of the innovations that Hyperliquid has done are here to stay, and also are here to be extended beyond what they have achieved so far. In particular, the concept of enshrining special purpose financial applications, which I'll talk about soon. Lastly, we're about to announce, it hasn't yet been announced yet, but it's upcoming. The Nexus Layer 1 will also launch a native stablecoin, which we find quite exciting. This will be in partnership with the M0 protocol. I think we're seeing a new wave of exciting blockchains that are considering launching their own native stablecoins, and that allows for very interesting incentivization primitives. So let's move on. Very briefly, what is the architecture of the Nexus Layer 1? So interestingly, you will see that this differs from a lot of things that we have seen in the space, except potentially novel projects such as Hyperliquid. So the Nexus Layer 1 has 3 layers. At the top, you're able to see the execution layer. In the middle, the verification layer. and at the bottom, the consensus layer. Nexus, as a project, started building from essentially day zero at the Stanford Cryptography Lab, the Nexus Zero Knowledge virtual machine, which is currently in its third iteration, and there will be a fourth iteration, and so on and so forth. Now, this is similar to other CKVM projects that have launched there. In particular, our vision for the Nexus CKVM has always been, so it's the core verifiability engine powering the Nexus Layer 1. As you may have seen in the Ethereum landscape, Ethereum also has ambitions to enshrine CKVMs natively in the protocol, which we think is pretty exciting. In the Nexus universe, we take a little bit more of an active approach, which is we are actually building the CKVM itself. But most excitingly for this talk, I want to talk about a concept that we internally called an economic trifecta. And this economic trifecta seeks to combine three interesting economic primitives on top of the EVM. And that's what I mentioned, the Nexus Exchange and the upcoming stablecoin USDX. All of this live within something that we call Nexus Core. A Nexus Core is a special purpose engine within the layer 1. I will talk about it in a moment. So the so-called economic trifecta looks like that, right? So the layer 1 is upcoming, EVM compatible. As a project, we've had some success across various testnets. We've had, across past year, had over 3 million users participate in testnet campaigns that have engaged people, especially in the Asia-Pacific region. As mentioned, upcoming is a Nexus Exchange, which we are very excited because it will inject volume and capital velocity to the layer 1. And thirdly, we're very excited as well about the stablecoin, which will provide the Nexus project the ability to accumulate capital and capitalize on the capital and the TVL of the protocol. Part of the thesis here is that there should be an opportunity to build a financial engine, an economic machine, where economic primitives compound in powerful economic ways. So interestingly, the architecture of the Nexus Layer 1 is a little bit distinct from most other blockchains, though not too distinct from the Hyperliquid architecture. In particular, there exists this notion of a dual block architecture, where you can see there are big EVM blocks, traditional EVM blocks, powered by Reth. But interestingly, there exists this smaller high-frequency Nexus Core blocks. And the Nexus Core blocks inject some of these exciting financial primitives that we are building, including the Nexus Exchange. In particular, these small high-frequency blocks endow the blockchain with essentially a trade-off curve that allow us to inject lower latency into the applications. Let me switch. Oh, there you go. So one thing that we're excited is about the ways in which these primitives compound. One way in which these primitives compound is what we call the performance loop, which is the way in which the exchange and the layer 1 interact. This is not too distinct from modern perp dexes that you may see in the market. Excitingly, the previous dual core architecture allows Nexus Core blocks to expose non-EVM APIs. What that means is that financial applications on Nexus Core are able to expose APIs in traditional Web 2 terms, such as, I'll go back to this one, such as REST, such as WebSocket APIs. And importantly, these APIs can be compatible with a standard, it's not mentioned here, called CCXT. CCXT is a standard that standardizes APIs for all centralized exchanges, right? So like if you're a trader, if you're a high frequency trader, and you want to trade on Binance, on Bybit, on Coinbase, usually you just use the same standardized APIs for trading. Interestingly, you can do that on Nexus because Nexus Core exposes APIs that conform to that protocol. Nexus Core looks a little bit like this. So Nexus Core is the pre-built special purpose dual core engine of the Nexus Layer 1, as mentioned. And it features the Nexus Exchange, which is being built as we speak. part of the vision for Nexus Core is that other high performance, high frequency, low latency applications are able to be built under this model. Certainly, there is a trade-off that is being made here, right? The trade-off is the protocol is becoming more complex. Validator hardware is going up. And, but we are excited about some of the innovation that can be materialized through the building of special purpose applications. I will skip this one slide. Last thing that I will talk about, and happy to take questions after this, is just the upcoming stablecoin. We think that this is something that the industry hasn't really seen too much before. Like if you think about it, which blockchains have launched like their own stablecoin? Well, I mean, it's a few, especially in the latest days. Sui launched their own USDE-based stablecoin. Mega ETH announced USDM in partnership with Athena. We are about to announce our own stablecoin in partnership with M0, as mentioned. And the point of the stablecoin is that it will have a very tight integration with the exchange. It'll be used as the margin collateral quote asset for the exchange. And it will instantiate something called the global yield distribution system, which is a methodology by which yield generated by the stablecoin will be distributed to incentivize protocol growth. So unfortunately, that's all the time that I have today. Certainly there's a lot more to talk about, but happy to take questions outside. Thank you all.
Do the furniture real quick for you. Do you mind holding this?
Thank you. Good. Awesome.
We've got a little furniture adjustment, and then we will begin the next panel. Thank you, Daniel. Super excited for the high frequency DEX. Okay. All right. On our next panel, we have an awesome cast of characters. We have Ellie Davidson, who's head of research for Espresso Systems, Matt Pearring, who's senior director of product from Off-Chain Labs, and one of our very own from Stanford Blockchain, J.U., who's now a partner over at Pantera.
All right. Well, thank you both for joining me. Yeah, maybe we can start off with like a round of introductions, and then we'll dive into the panel. So I'm Jay. So I'm a junior partner at Pantera Capital on the investments team. So actually, previously, I was the president of Stanford Blockchain Club, and I was honored to be one of the co-founders of BAS. So it's really great to be back at kind of an event that I've been kind of involved in since the very beginning, and good to see how it's been evolving over the past 2 years. So I'm joined today by Ellie from Espresso, as well as like Matt from Off-Chain Labs. So I'll leave you guys to an introduction, and we can start off.
Sounds good. Hey guys, I'm Matt. I work on the product team at Off-Chain Labs, the initial developers of the Arbitrum platform. Super excited to be here. Thanks.
Yeah, I'm head of R&D at Espresso. Espresso is a very fast, high throughput base layer specifically designed for rollups. And yeah, excited to be here.
Yeah, well, thank you guys. So yeah, I know that you guys, like Arbitrum and Espresso, have been working together for like a very, very long time. So I'm curious to learn, like, what is kind of the relationship between you guys kind of like, as well as like, how has it kind of evolved over the years?
Sure, I can start. We've got a really strong research collaboration trying to figure out how to build a performant distributed sequencing protocol. I think what's the main challenge we're working on right now is the core property that users and developers have come to expect from scaling solutions are really quick block times, fast finality in a sort of sense. And when you spread out the responsibility of sequencing to a operator set that's more than one, you lose a lot of the properties that people have come to expect with rollups. So we're working on better solutions. Think basically a version of distributed block building on Ethereum, but bringing that up to other chains.
Yeah, I mean, more specifically, we have an implementation that is like Espresso has built ourselves that has sub-second finality for sequencing, and it runs on a version of Sailfish, which is a DAG-based consensus protocol, and it's optimized to be extremely, extremely fast. So this is just an example of the R&D that we're doing.
Of course, of course. I know that recently Vitalik has gone on and in the press and talked about kind of like what does the future of like the L1 of Ethereum look like and versus like the L2s and stuff like that. I'd be curious to get kind of like your thoughts on where do L1s and L2s sit in kind of this future of Ethereum? What might both of them be like good at, and like where you guys are building in that future?
Sure. So my personal opinion is that Ethereum's core competency is decentralized settlement and data availability. A lot of computers all around the world storing information and being able to arbitrate over what is true. When you want to conduct high-performance trade, you need a dedicated, specialized throughput layer for that. That's why layer 2s were invented, to scale execution. I think right now we're seeing kind of the unfortunate tension that has come up as a result of leveraging basically capitalist forces of innovation to have competing L2s try to compete for value and usage to grow Ethereum's scale across the world. And now, instead of just being able to support them and kind of grow, Ethereum is dealing with this reckoning of, okay, if value is going to move up the stack, what do we do? And those are the questions I think being asked. You saw Vitalik's post maybe a year ago around how do we make Ethereum more valuable, more useful as a type of payment or a type of currency. And I think we're just going to have to continue to fight through figuring out what that is. In terms of what I think this will be in 3 to 4 years, I do think that what Vitalik laid out recently is probably true, or is true in practice today and will continue to be for some time, which is that layer 2s are basically other chains that build on top of Ethereum that are really good at 1 or 2 specific things will work, right? You need a product that is better at Ethereum than what Ethereum is trying to do, and Ethereum is growing very quickly and scaling very quickly because the most people are working on that technology. So specialization will be very crucial in order for chains to succeed going forward.
Yeah, I completely agree with that. I think that there is still a lot of room for L2s to scale Ethereum, even though the L1 is doing a lot to scale. I think that the demand that we're going to see, hopefully, in the next several years, you need these really high-performant L2s. I think, additionally, customization is a very big one. So when I talk to partners and enterprises wanting to customize things like gas, maybe remove gas altogether, in fact, customize their sequencing, have KYC enforcement, all of these things are much better done on an L2 where you can fully customize it. You can have guaranteed. So it's not just about high throughput and low latency. It's also about predictable high throughput and low latency. And this is something that L2s really excel at.
Yeah, that's really cool. So obviously the enterprise adoption has been a huge trend over the past year. There's been some really high-profile partnerships, like for example with Robinhood and stuff like that. So I'm curious, can you give us an example of how has your technology empowered some of these enterprises coming on chain over the past year or so?
Sure. So 2 good examples are, I think, bringing new tokens or new assets on chain. So I think Arbitrum is the kind of number 2 chain behind Ethereum in terms of new real-world assets actually being tokenized. There's a lot of liquidity value and network effects that we kind of have to bring to the table, so that's been very, very useful. I think as an experimentation ground for enterprises looking to have 24/7 trading of their underlying asset, think planes, hard assets, right? Things that you would not normally trade kind of in an off-chain setting. They can experiment by giving more volume to those assets by putting them on a blockchain. So we have a mainnet, we have a technology that's very performant. That works for a lot of enterprises. There's this other group, though, that are large trading partners, Robinhood is a great example, that seek to control sovereignty over the value flow of their trade, right? So they need their own chain. Deploying on a network like Ethereum where they don't have full ownership, that just doesn't work. That's like asking a business owner to give you their business and give you the keys to their house. They're never going to do that, right? And so the fact that we have a production-ready chain stack where you can deploy your own chain, you can customize things, to Ellie's point, that is actually a requirement for these enterprises. Now, does it match the kind of philosophical values of Ethereum at the beginning? That's an open question. Robinhood has been great partners in this, and I think with our announcement last week, you can see they're putting their money where their mouth is in terms of wanting to build a decentralized chain. So we'll continue to see this.
I think in terms of espresso specifically, fast finality is really key for interoperability, particularly stablecoins. A lot of companies, enterprises want to launch their own stablecoin, but it needs to be able to flow freely from all of these different chains to be useful for payments and settlement and all of these things. And this is a known issue today in that stablecoins, maybe with the exception of Circle, who kind of has a fast path that they charge you more for, and then a slow path that's free. A lot of people who issue their own stablecoins, they do not want to wait for slow finality on Ethereum. And I'd also like to point out that, even though Ethereum probably will have much faster finality in the very near future, that's not the only component to slow finality, because you still have to wait for chains to, post their data to Ethereum or post a ZK proof, and that takes time as well. So, yeah, fast finality as this really big key to interop for stablecoins specifically has been very popular.
Got it. I mean, obviously, stablecoins has been such a big narrative over the past, I would say, 2-3 years. One of the things on the infrastructure level that goes hand in hand with that, though, is privacy. So especially since public blockchains are public by default, and I guess a lot of general purpose L2s are also public by default. So I'm curious on how do you guys see privacy as kind of an emerging demand, especially from enterprises, and how are you guys planning to address these sorts of demand side?
Yeah, I mean, I think that privacy, there definitely is demand. I think it's interesting because not all enterprises demand this. I think it depends on their use case. If they're kind of trying for a more crypto native use case, they actually maybe don't view privacy as that important. But yes, when you're bringing traditional finance on chain, they want privacy. And this is a really good use case for an L2 because you can customize the VM. So it can have a private VM that's compliant. There's a lot of existing VMs that do this, like ZK Sync has an existing VM. But this is one of the great use cases of L2s specifically, and why a custom VM is really good for that.
Yeah, I completely agree. You kind of need your own chain if you want to enforce true privacy. At the moment, or you can use solutions like I think Aztec, where everything's fully encrypted, but encryption is expensive when done in a distributed setting. So the moment enterprises start to look at the actual marginal cost of having a fully private blockchain, it gets very complicated because they're not used to paying these sorts of fees. They just run everything in the back end on an AWS bill today. The biggest feature we see is just permissioned access. So particularly to seeing contract state, for example, or even if you're running your own chain to have permission access to the RPC. For a lot of institutions that are testing out a specific application on a specific chain, coordinating off access to that is real easy. You can still do withdrawals and the tokens are themselves interoperable with the EVM, but restricting access to sending transactions is really the core feature. Now, it's scary because in a way that's censorship, right? But for certain applications, it actually does make sense. Not all information needs to be public. So that's typically what we see.
Yeah, that's super cool. I know that you guys are both researchers and product by trade. So I'm curious, what are some of the research breakthroughs that you guys are really excited about on your respective projects for the upcoming year?
Yeah, so I've been very excited about all of the new research with consensus protocols. So many of you may be familiar with Alpenglow or Minimit or Hydrangea. These are consensus protocols that get very, very fast finality because they can get finality within one round of voting. The key difference is that you change your Byzantine threshold from 33% to 20%. But in a lot of cases, that's very reasonable to do. So I'm very excited about that. Espresso does have plans. We will be using Hydrangea, which is one of these one-round protocols that should give us, finality within 300 milliseconds, which is very, very good. And is that's approaching the what you get from a centralized sequencer.
Sure. Yeah, actually, particularly on that, I think for distributed ordering policies, that's really exciting. We're working on upgrades to Time Boost, which is the ordering policy on Arbitrum 1 today, that leverage similar techniques. I think the other thing I'm really excited about are looking at, and I can't share all the specifics, but I think the previous speaker was talking about kind of enshrining perps into the L1 protocol that they're building, basically making nodes more responsible for core execution that everyone's doing. Right now, that's something, actually, I think Ethereum could be doing that, arguably. There are types of trade that everyone does on Ethereum, just make that part of the binary for nodes. But that's a big breakthrough that we're working on, particularly scaling payments or micropayments into the core execution.
Got it. Yeah. I think like one of the really interesting phenomenons that you've seen over the last like 2 years is also this explosion of block space, but not necessarily within the Ethereum ecosystem. Maybe also like on like Solana or on Hyperliquid and some of these other things. What do you think the Ethereum community can kind of learn from these sorts of like experiments and how to bring more, bring a lot of the energy and a lot of the future block state growth back to the Ethereum ecosystem?
I mean, this is a really good question because I think this gets into a philosophical debate about what Ethereum should offer and whether or not Ethereum should try to do things like Hyperliquid. I would argue that Ethereum is very good at decentralized settlement, censorship resistance, things like that. I'm not sure it should try to have sub-second finality because that would require it giving up a lot of its properties that we very highly value. So I think what Ethereum should do is it should scale DA, it should scale execution through ZK VM, but it shouldn't try to be Hyperliquid or Solana or any of those things. That's where L2s come in, and L2s can do that.
Yeah, it goes back to what I was saying at the beginning, like settlement, DA, good at it, you could do it in a distributed setting, keep doing it. I think kind of the fundamental challenge with trying to build more of like an application-centric product from an ecosystem perspective is you have like 100 stakeholders. Right. Who makes the decision? It's no one until like Vitalik wakes up and writes a blog post about the idea, right? And then everyone kind of goes in that direction. and that's not how you build a consumer product. And so, and that's also not what Ethereum is, right? It's a infrastructure product for the world economy.
Yeah, I think definitely Ethereum has emerged as like this credibly like neutral trust layer. That's like a foundational thing, and maybe that's like a very different value proposition from what Solana or Hyperliquid or some of these app layer things are doing. I don't know if we're running short on time or we can. So yeah, so fun rapid fire. What's like one big prediction you have for 2026?
Well, regarding Ethereum, I think in 2026 we will see a very concrete plan for Ethereum to get to sub 10-second finality.
I like that. Yeah, I mean, I do think we're going to see growing reliance on the banks and the Fed in terms of value creation on blockchains. The most popular products are completely rooted in stablecoins for their value, and the value of stablecoins are completely controlled by governments. Yeah. And agreement is crucial in order for us to scale these technologies. So I do think our reliance on them and our kind of trying to be at the behest of regulation will continue to grow in importance. I would say maybe not at the end of this year, but maybe at the end of this year we'll see I would say we'll see a collapse of stablecoins towards a few. Like everyone issuing their own, it works. It's really just a rule set around the value, but the archetypes of stablecoins will collapse. That doesn't mean that you can't issue your own, but there'll be like 1 or 2 standards and that's it. Everyone will use the same thing.
If I could add on to that, I also think that with the popularity of stablecoins, you really blur the line between what is a chain and an L2. Like what's an L1, what is an L2, what is a canonical bridge versus not. And I think stablecoins really blur that line. And we're going to continue. I don't think that we should think so rigidly in terms of a chain is an L2 because it settles to Ethereum and it has Ethereum DA. It's much more nuanced than that.
For sure. All right. I guess like my final closing thought is that I do think like we are also like moving into a world where stablecoins and payments are going to be like an increasing part. I'm personally very excited about this crypto neobank type thesis. How if fintech neobanks were innovating on the front end of banking, how can we innovate the back end and go from basically these permissioned systems out to like DeFi protocols into like stablecoins and into a self-custody system? And that's one of the things I'm most excited about. So thank you both for joining me today on this panel.
Thank you.
Wonderful.
You got a remote handed to you? Can I please have it? Yeah. There you go. Okay, nice job, guys. I'll take this. Thank you.
All right. Thank you, Jay and team. And next, super excited to have Dan Albert, was Executive Director of Solana Foundation, now member of the Board of Directors of Solana Foundation. And Dan is going to dig into, I think Ellie mentioned before, like Ethereum shouldn't try to be like Solana. Well, Solana should try to be like Solana. So let's hear it from Dan.
Hello, hello. All right. Thanks, everyone, for being here. My name is Dan Albert. I've been with the Solana project for about 7 years. I want to talk about tech. I am not here to argue about adoption metrics or anything else. I will let our business folks sort of enjoy that debate. But the one thing that I just wanted to highlight is, what is Solana? What is the goal of Solana? And I think this really encapsulates it. Solana is designed to be one network that can host every asset and every market. And the only way that we are, have been and will continue to be successful in being this global state machine, this single network, is to make the fastest, cheapest, and most scalable L1 blockchain. And that's what we have set out to do from day one, and that's where we continue to put all of our primary efforts. So I wanted to start with a little story, because this is fun for me. But where did we come from? So this was the Solana network about 6 or 7 years ago when I joined the project. It was a couple of the early engineers ordering computer parts off of Amazon and off of Newegg to build the very first validators for the Solana network. We built these by hand. A few months later, we racked them up in a data center actually here in Denver, just a couple miles away. And these were the nodes that we actually used to bootstrap Solana mainnet. They ran live in production for several years before this data center actually shut down last year, which was kind of sad. So we had to tear the machines out. So this is where we started, and this is the Solana network today. There are over 5,000 validators across 6 continents. Really become a truly global network. This number can and should continue to rise. This distribution can and must further distribute outside of these North American and Western European hubs. But we still have a really strong global presence in every major economic center. So I wanted to jump in and talk through some of the big technical milestones that were accomplished on Solana in last year, 2025, as well as a couple really exciting things that we're pushing forward to advance the protocol this year in 2026. The first thing, and this was a project we have been working on for several years, is FireDancer. FireDancer is a brand new validator for the Solana network. This was in development by Jump Crypto. We've been working with them since 2021, 2022. This was a ground-up rewrite of the original Solana validator. FireDancer is now live on Solana mainnet. It went live just before Breakpoint in December last year. FireDancer and its relevant forks currently holding about 15% of Solana mainnet stake. So a lot of people were telling us for years that it couldn't be done, that Solana, because of its unique architecture, could never achieve true client diversity, and this is simply not correct. So there are now 2 fully independent implementations of the Solana validator live on mainnet. They're written in separate languages. They use separate compilers, separate tool chains. So a lot of the potential risks of single points of failure to a protocol like Solana are mitigated with this increase in client diversity. Something else that went live late last year is a new exciting project called 00. Solana's goal has always been to settle transactions at the speed of light. And what do we mean when we say that? That Solana should settle as fast as data moves through the internet. And that speed limit is how fast does light move through fiber optic cable. When you send a trade or a piece of data drops on a newswire in New York, how quickly can that information reach a trader in Singapore? And the answer is strictly, it's about 140 milliseconds because you've got 8,000 kilometers of fiber optic cable, which is a finite amount of space, and that data takes time. And what we found in scaling Solana is that there were some cases where the public internet was actually too slow, and the Solana network was actually getting bottlenecked by the routing and the inoptimal paths taken when you want to send information between continents. And so 00 is a new project that came up last year to attempt to outpace the public internet. These guys are using pre-existing fiber lines that run under the ocean that have been laid by the Googles, Verizons, the major fiber players and are getting sort of fast lane access to make data available intercontinentally faster than one could get on the public internet. 00 is currently supporting about 40% of the stake on the Solana mainnet. So a lot of the validators on Solana have chosen to make use of this technology and are using it to accelerate their performance and thereby accelerate the performance of Solana mainnet. A couple other quick things. XDP has been rolled out on Solana. This is a Express Data Path. It's basically a lightning fast network acceleration to expand our block propagation capacity. And this really paves the way for bigger blocks, more block space, more transactions in the same time period. Similarly, we have in Solana the concept of compute units, or CUs as we call them. This is the equivalent of block space or gas in sort of EVM land. The CU limit was increased earlier in 25 from 40 million to 60 million. Basically what that means is we now have 50% more block space than we did a year ago, which means 50% more transactions, 50% more compute in the same time period, reaching the same fast 400 millisecond confirmation that Solana is known for. So Solana's been through a lot over the years. We've made a lot of improvements just this year, constantly shipping new features, trying to unbottleneck anything we can on the network. And the question is, how does it work? And I will let the numbers speak for themselves. So we've gotten a lot of flack for some of the performance challenges and some of the reliability challenges that the network did experience in its early days. Won't deny that. Solana has seen over 2 years of 100.0% uptime, despite all of these major performance improvements, shipping new major releases every 3 months, constantly pushing the envelope. The network has really strengthened. It's gotten more resilient, and we're seeing that in these kind of uptime and reliability figures. Similarly, October 10th, a day that will go down in infamy in the crypto markets, not only did, unfortunately, the markets nuke and we saw massive liquidations across our entire industry, not specific to Solana, as the market was sort of going through its churn, a lot of blockchain infrastructure projects were struggling with the load as DeFi protocols were executing liquidations and market makers were trying to stay in front of the market. And one of the things that we saw after the sort of big 10-10 market crash was that the Solana network was ingesting 100,000 TPS on mainnet in production, and everything worked. Everything kept running. So this is not a claim that one day we will theoretically hit 100,000 TPS. This was 100,000 TPS in a real market event, and the blockchain processed everything beautifully. So, all right, looking forward, there are 2 very significant protocol changes coming to Solana in 2026 that I just wanted to highlight here. If anybody's sort of been following the Solana discourse or you follow some Solana folks on Twitter, you will probably hear both of these concepts, Alpenglow and MCP, multiple concurrent proposers. I'm going to spend a couple minutes talking about each one of these because they are respectively some of the largest architectural changes to the Solana protocol that we have made to date. So, Alpenglow. This is a complete rewrite of the consensus protocol for Solana. The TLDR here is this is simpler, faster, and more reliable than the current consensus algorithm that we have called Tower BFT. And it is going to bring down block finality times on Solana to 150 milliseconds. Currently, Solana runs at 400 millisecond block confirmation times, so we're going to bring this down by more than 50%. There's a team of researchers that have been working at one of the core development shops, Anza. They put a design proposal forward to the Solana network and the validator community, passed with 99% support this past summer. Testing and early infrastructure is underway, and we are expecting the launch of Alpenglow later this year. So just looking at these 2 side by side, Solana's current consensus, the algorithm under the hood is called Tower BFT. This relies on the decentralized clock within Solana called proof of history. This is always proof of history has always been like a big talking point from Solana's white paper days. And with Alpenglow, we're actually getting rid of proof of history. We're getting rid of Tower BFT. We're getting rid of forking and fork selection algorithms. And we're getting rid of the fact that votes on Solana today are characterized as full transactions because they are indeed sent over the same transaction pipeline that a token transfer or a swap. They're processed in the SVM just like any other smart contract. And so we're moving the vote processing pipeline out of the SVM and making a much more efficient data relay service called Rotor and a block finalization service called Voter. Apologies from our colleagues who came up with these names that are easy to confuse. But the takeaway from this is that we can achieve finality with 80% of Solana stake online and participating in 150 milliseconds. And if for some reason we have a larger outage or lack of availability on the network, we can still reach fast finality with only 60% of the network online and participating. So it actually increases the resiliency threshold to infrastructure disruptions, outages, cable cuts, mass validator failures for any reason. All right. So this histogram really just kind of shows what I was talking about here, but that we can achieve vote finalization up to 60% of the stake, looks like in about 120 milliseconds, 80% of the stake, about 150, 160 milliseconds. Lastly, and it's hard to do this justice in the 1 minute I have remaining, Solana is moving from a single block builder or single block proposer to a multi-block proposer architecture. So we call this MCP, multi-concurrent proposer. And the primary goal here is a couple things. One, to break the monopoly that the current block leader has on transaction inclusion and ordering. In Solana today, when you are a validator and you have stake and it's your turn to build a block, these groupings are assigned in batches of 4 slots. So if you have a validator and you're the leader, you get to build the next 4 blocks. And then the next leader gets to build the 4 blocks after that. And the next leader, the 4 blocks after that. At Solana's current block times, which are 400 milliseconds, that means that each leader has 1.6 seconds where they monopolize which transactions go into the chain and in which order. And 1.6 seconds in DeFi, in market making, is an eternity. Particularly if you have a validator who's simply offline, we get no transactions for 1.5 seconds. That is far too long of a time to have effectively what is a partial outage because we have one block producer who's offline. By moving to multi-proposer, we break this monopoly, we increase resilience, we decrease the surface area for potentially harmful MEV. If you have a validator who is excluding transactions, the parallel multi-proposer would most likely not be participating in the same behavior. So again, here's a side-by-side. Really just increasing resilience, decreasing the risk of exploitations, monopolization, or even temporary holds on the ordering or the inclusion of transactions. And now we're moving to a future where no single validator or no single node controls transaction inclusion, transaction ordering. Sequencing of transactions is moving from being controlled by the block builder to actually enforced at the protocol level. All of these things make it harder to suppress or censor transactions. So we have increased censorship resistance, better MEV resistance, and much better resiliency as the chain continues to march forward. MCP is in, I'll say, a slightly earlier design phase. We are expecting to see in-protocol ordering and inclusion rolled out later this year. Alpenglow, the consensus mechanism that I mentioned previously, is a precursor to full MCP. So we're going to see Alpenglow first later this year, and full multi-proposer Likely, don't quote me on that, probably sometime next year. Very last thing, everything I just talked about was protocol-oriented, performance, consensus. Most of these things, other than keeping the network reliable, fast, and cheap, most people don't feel these things, right? When you use Solana and you click send transaction and it just works, that's what most users feel, and that's great. That's what we want. There's a couple other things I wanted to mention for the developers, for the app builders, a number of things that are coming to make builders' lives easier. Biggest thing is the rent is coming down. On Solana, when you want to reserve state on chain, you lock up some small amount of Sol in what we call rent. This is coming down by about 90%, possibly as high as 99%, which means that if you're an app builder and you want to pre-fund wallets, with your own token, and you want to create 100 million wallets for 100 million users or potential users, or if you want to cover the cost of account creation on behalf of your users, these costs are coming down by a 10x. Similarly, transaction sizes are increasing and the CPI nesting limit is increasing. Both of these serve to make it easier for developers to execute more complex transactions. You can have more complex application logic with bigger transactions and more recursive depth when you're doing program-to-program calls on chain. So lots of exciting stuff coming, lots of stuff. It's been a hell of a year last year. Some interesting times in the market today, but I think the future is bright ahead for Solana. So thank you very much for your time.
Awesome. Thank you, Dan. And our next session is on, as we think about enterprise adoption, agentic adoption, like wallets are the touch points of the world into blockchain. So we've got a super exciting panel coming up. I'm going to butcher these names. We've got Michal Pospieszalski from American Fortress. We have, who's the CEO of American Fortress. We have Charles Guillemet, the CTO of Ledger, and Max Segall, CEO of Privy. Thank you, guys. And it's going to be moderated by Dinghan Luo, partner at J Square. Thank you, Dinghan.
Hi, guys. Obviously, we're going to talk about wallet. So before that, let's give a round of introductions. Maybe start with Michal.
Sure, I'm the CEO of American Fortress. We're a worldwide universal privacy layer for custody wallet systems and other people's wallets and custody systems. So we've been talking to Ledger about that already. Excited to share the tech. It's like decentralized PayPal for all the crypto.
Hi everyone, my name is Charles Guillemet. I'm CTO at Ledger. Raise your hand if you own a Ledger device. So okay, most of you already know Ledger. So Ledger is very well known for the retail offering with the hardware wallet, hardware signers, and Ledger Wallet, which is the software. But we also have an enterprise solution for corporate organization, financial institution that want to manage their crypto securely, but with a strong layer of governance. On my side, my background is cryptography and security, and I joined Ledger in 2017. So in crypto, it's forever. Happy to be here today.
I'm Max Segall. I am the COO of Privy, and this is my fourth ETH Denver with Privy. First was in 2022, which is a wild thing to reflect on. Privy is software that makes it easy to embed crypto functionality into your product, and we serve many of the most popular crypto products, ranging from the sorts of things people think of when they think of crypto, like Hyperliquid, Pump Fund, Zora, all the way through to mainstream scaled products that are embedding crypto functionality like Klarna and Deal and Stripe, and very excited to be here.
Thank you. My name is Dinghan, and I'm partner at J Square. J Square is a crypto VC that invests from early stage crypto deals to like late stage pre-IPO crypto companies, and we are managing about a few $100 million of AUM right now, and still very actively deploying and support builders in our industry. So thanks everyone for coming to this panel. So first, I would like to start with Michal. Like we know, like you you've been very vocal about like Bybit's hacks like happens last year, and can you tell us like you mentioned that was like a very like way simpler than you think, right? So what happens? What went wrong? What's your fix?
Yeah, so the Bybit hack was my one viral video of 25 as a tech guy that got like 20,000 views, and I was like super thrilled. But I mean, ultimately the problem was it was a blind signing on a hardware device. Was it a ledger or was it a Trezor? It was one of the two, right? So like here's how that hack went down. The hackers got really sophisticated. They infiltrated the repo that they were using for safe.org, and so ultimately some bad code got on the Trezor, and that Trezor or ledger, I don't know which, basically presented a bunch of hexadecimal. And they just signed a hexadecimal, and that hexadecimal allowed the attackers to just control the whole thing. So what was really the problem? Was it like a safe.org problem? Was it a hardware wallet problem? Well, every time they did that transfer, they saw all that hex. So they were asked to interpret the hex every time. So they were going to get it wrong at some point because, after you've looked at the hex for like 100 times, you're not going to see that there's a difference on the 101st time, right? So what's the answer? The answer is to have that hardware wallet actually understand what's happening. So instead of it saying, hey, sign this hex, sign this transfer from cold wallet to hard wallet, here are their names. And that's exactly what we build. And, hopefully we'll get this out the door to all the people, besides just Tangent, which is what we've done it so far with. But I'm not dropping any hints.
Yeah, the reality is like hardware wallet like a Ledger or Trezor are not designed for enterprises such as Bybit that are securing 1.4 billion. Like these devices are made for individuals that will manage their crypto in self-sovereignty and security. But when you are an organization, what you really need to have is a strong product when it comes to the security, but also when it comes to the governance. And Safe is a good product, but I'm not sure, at least at this time, that it was well suited for in terms of compliance, in terms of regulation, in terms of the governance itself. It was not really well suited for these needs. And when you are blindly signing a hash on a device, obviously at some point you will get wrecked. And if you think about it, like the security budget for Bybit to secure 1.4 billion was like $100 times 3. It doesn't make sense. It doesn't make sense. And the thing is, there exists solution for that. Like as I mentioned in the introduction, like Ledger is offering a solution for that, which is a Ledger Enterprise solution, where Bybit or any kind of such player will be able to define the governance, and when they want to move funds from an account to another, they can set different policies saying this one is our own account, so it's possible to send money without so much governance because it's whitelisted. But if they want to move like more than 2 Bitcoin in a day on an external wallet, then you need to go through the policy, and you need to gather 3 approvals out of 5. And this is the kind of governance that is required for institutional adoption. And this is what we are seeing these days. And I hope the use of wallets for institution will be something of the past in the near future.
I'm in a nostalgic mood right now, so it's kind of crazy. The Bybit hack happened ETH Denver this time last year, and I remember because our security lead at Privy is a part of SEAL 911, and he got tapped in and wrote a whole blog post about what happened. It didn't go nearly as viral as your breakdown, but I remember being in the corner of a happy hour at ETH Denver trying to publish that blog post. Blast from the past.
I was in the middle of the town square in Jackson Hole. I just got off the plane, and like the antler arch was right behind me. I think that had something to do with it.
Yeah. Okay. Thank you. So, I mean, since we're talking about this, like you mentioned, like one of the major problems was like blind signing, right? So obviously, Michal, you are trying to push for clear signings. Can you explain to the audience more about the clear signings you are proposing, and also, like, are these like the right problem to solve, or these are second order issues while fundamental user experience still broken?
So you're asking me about a clear signing, yes? Yep. Okay, so what is clear signing? Clear signing is the idea that the device that's doing the signing completely understands exactly what's happening. So the fundamental problem, so these days that's actually moved along quite a bit, where like if you're signing some DeFi operation, and it's a common DeFi operation that uses essentially a sort of template, like the device will tell you, hey, you're calling this function on the DeFi. But from like a granny understanding's point of view, we're still like a real ways away. And one of the fundamental ways that we're a real ways away is that people are still forced to evaluate addresses. So these days, unless you're using like ENS, then you're sending to a name, but then the problem with that, it's not private, right? So what we've done is we've created this name system where the actual addresses are dynamically computed only by the sender and receiver, but the devices and all the little pieces of crypto in between that interact with the user just understand the name. So it's like you can send from Alice to Bob, and the hardware wallet or the software wallet will say that you received money from Alice if you're Bob, and you can prove to a third party that you received that money from Alice, even if it went through like a ZK confidentiality machine, which we're also doing. So what we created is this ability for the clear signing to be completely transparent, where you see no hex at all.
Charles, how about you? Yeah, definitely. Clear signing is something very, very important. So you bought your Ledger device, you generated your secret inside the device, you have created your backup, and as soon as you are signing a transaction, everything happens on the device. So you think you are in a secure situation. The thing is, when you are signing a transaction, you need to verify on the device, on the screen, what you are signing. Otherwise, maybe you are signing a transaction you intended to, or maybe you are signing away $1.4 billion. So this is what we are talking about. And the idea is to be able to display on the device what kind of transaction you are about to do. And this is the very reason why there is a screen on the device, on Ledger devices. So for Ledger, this is not something new. We knew from the beginning of the company that a screen was necessary in order to avoid this kind of threats. When it comes to signing a simple Bitcoin transaction, it's relatively simple. When it comes to signing a transfer on Ethereum, it's relatively simple on the device to parse the raw transaction to be signed and display the information to the user so that he can decide. But when you are about to interact with a smart contract, that can be arbitrarily complex. The thing is, the device is not connected to the internet. It cannot download the blockchain and analyze the smart contract. This is simply not possible because the device is completely offline. So that's why we have created the standard, that is the ERC 7730, that solves this problem. I won't get into all the details, but the idea is to create metadata files of all the smart contracts that are on chain, and these metadata files are trusted by a ledger, and then they will be sent to the device so that the device receives the raw transaction to be signed along with this metadata file that allows it to parse the transaction properly and gives to the user all the information so that he can decide if he wants to sign a transaction. So this is something that we have created maybe 1 year or 2 years ago, and now that is adopted across the ecosystem. So we are very proud of it, and we need the help of the DApp and the smart contract developer so that they built this data. Today we are also generating this data with AI, verifying this data with AI and so on, in order to have a large coverage. But this is a fundamental problem, and if we don't solve it, the trust in the ecosystem won't be solved. On top of that, we have created something that's called Web3 check. The idea is to have a firewall on the device that gives you a risk assessment for your transaction. And the way it works is pretty simple. Right before signing the transaction, the raw transaction is sent to third-party companies that are specialized into this, think Cybers, Blockade, like these guys. They analyze the transaction, and they give a risk assessment for this transaction. And then the device receives the risk assessment along with the raw transaction plus the metadata file, and the device will be able to give a risk assessment of this transaction on device plus the clear signing on the device. So if you are in this situation, you are really in a good way to take the right decision to sign the transaction or not. We have created like Web3 Check maybe 1 year ago, a little bit less than this, and we have saved around like $25 million with this very feature. So this is the way to solve like security in the ecosystem, at least for a retail user. For B2B, the same applies, the same principle applies, but you also need like a strong governance policy engine on top of it.
Thank you. Max, I want to ask you something else about security features. We know like Privy use like key shardings and TEEs, right? So can you explain to the audience about these two technologies like you are using, like how does that provide securities to the wallet users, and what kind of problems they are solving, and what are the remaining potential vulnerabilities around that?
For sure. So our take at Privy is wallets are not one size fits all, and you can't have one security system that underpins every wallet out there. You might be signing a $1.4 billion transfer, and you might be signing something that attests to a non-monetary event. Those two should have very different security systems underpinning it. And so the two things to call out with Privy are, one, we think it's critical that users will always have a reason to bring in their own wallet and their own security model. So being able to bring your own Ledger or Trezor in, or your own Phantom or MetaMask, that's always a first-class capability in a Privy-powered product. There will always be legitimate reasons why Hyperliquid users or Jupyter users will want to take action like that. And then what Privy is best known for is provisioning wallets, and the cryptography that underpins that system is super flexible to serve the different needs. So there are two technologies. One is key splitting. So when we provision a wallet, we split the key into shares, and so there's never a single point of compromise. If a bad actor gets access to one of the key shares, they can't do anything with the wallet. And then the second technology is trusted execution environments, where all wallet activity happens. And so when the party that controls the wallet wants to take an action with the wallet, the key shares get reassembled in the trusted execution environment to execute the wallet activity. And you can layer on all sorts of policies and controls and quorums of people that control the wallet in order to suit the use case that you're building around. I could go a lot deeper offline, but want to keep the conversation going.
Yeah, thank you. I want to switch to like a different topic, like agentic AIs for wallets, right? So we know like it's developing super fast, it's evolving every day. So what kind of like, from your perspective, what kind of like architecture we need to provide wallets to agentic AIs to support their evolvements, and what are the security concerns we're going to have, like that's not like what we were having with humans? Yep, go ahead.
So a lot of our security features are built organically around agentic use cases in a really cool way. So a year and a half ago, Privy, our wallet infrastructure is an API that allows you to provision and manage wallets. And a year and a half ago, a few teams started using Privy to provision wallets for AI agents. And one of the most visible teams is this team called Banker. It's a really cool bot that lives in the X feed and can be tagged to take any action with the wallet. So I could say, I want to provision a wallet for Mehow. I want to send him 100 USDC, and then Mehow can go in and say, I want to swap my 100 USDC for Solana. And it's a fully agent-managed wallet. And these teams, as they started building and more asset volume was flowing into the wallets, they started demanding all sorts of policy logic that can be airtight to secure. This wallet should only be able to do the sorts of things that I want to permit the system to do. I only want the wallet to be able to interact with a range of allow listed addresses or allow listed contracts. I only want the wallet to be able to transact over a certain dollar amount each day. And so that whole feature set ended up proving to be super valuable for fintech enterprise customers as well. And over the last month, really, there's been an explosion of the sort of activity that Banker and the early teams kicked off. It feels like just about every team in the crypto native market right now is experimenting with agent managed wallets. and it's a use case we're investing a ton around with features like X402 and integrations with LangChain and other parts of the AI stack, and we're really excited to see this design space open up.
Yeah, this AI revolution is really exciting, especially like the recent progress that we saw with Claude and so on, and the link with crypto is quite clear. Crypto is the native way for agent to spend money to interact with the financial system. There is no doubt with that. However, it comes with like new security challenges, because all of a sudden, like you have agents running on your machine or on the cloud or wherever that can do many different things that are not completely deterministic, and it creates plenty of challenges. We can also mention that we can do like prompt injection. It creates like real new security challenges, and this is where like ledger or wallets have like an important roles to play. And the thing is, like as soon as you are like your agent is interacting with the crypto, then you want to have like a strong like security guardrails. So something that you can easily do, and this is a hackathon that we did a few weeks ago, is to create like a framework where the agent is going to like do different trade, different on-chain activity, and that will like propose different transactions to be like signed afterwards by the device itself. And if you think also enterprise, as I mentioned, we have like a Ledger Enterprise solution with the Vault, with a strong policy engine, and you can directly connect your AI agent to this policy engine, and you will create a different set of policies where your agent will be able to like interact with this account and not this one, do this kind of transaction and not this one, and you can create like different threshold. Above a certain threshold, then you want to the CFO of the company to validate the transaction. So this is really the way we solve the issue, and the technology that we built is already like ready and suited for this kind of use case. And if we think like longer term, you can think of like agents will be able to like interact with crypto, but interact with any kind of assets that you own, your credentials to any kind of API system, your credentials to Twitter, your credentials to your API keys, and so on. And you would like to have a similar governance layer on top of it, because otherwise the agent might do things that we are happy with, but maybe not. So this is the kind of governance I mentioned should be extended to any kind, all your digital life and any kind of interaction with your assets that are on the internet. And this is what we are building right now.
Go ahead. Yeah. So right now on the top 10 chains, we have roughly 200 billion of daily volume. So that's like Ethereum, Bitcoin, USDT, USDC, and none of it's private. And so when the AI agents are operating, we want all of that to be private. So what we created is a tool set where the humans and the AI have the exact same tool set for privacy and identity and DID and KYC between each other, but it's not revealed to anybody else. So like an agent can just know, okay, this other counterparty is an agent, it's not a human. I got proof of robothood essentially from this person and or this robot, and now I can transact with that robot on say Ethereum or Bitcoin with the same sort of security as you have with Zcash without having to go off and use another chain. So for us, the only real difference is we spent 4 years making all this privacy tech, and then right at the end we wrote a model context protocol interface that's open source. It's coming out in the next month, where robots will be able to just use the wallets as if they were people, and really that was the only little last step. So we have 1 million lines of privacy code and 10,000 lines of robot code, but it turns out the robots are very excellent at they need to know your counterparty's identity just as much as a person does, and it has to be just as human readable.
Thank you. Let's get back to humans. So we know there's two different type of crypto wallet users, right? There's a mainstream people don't care about cryptos, they just want to use wallet, and there are very native crypto users. How differently are they when you are serving them? And what kind of security level difference are there? Do you see any security level? Because people are often thinking about, do we have to do trade-offs between like convenience versus like securities?
I think the true value of crypto is the fact that you give the power back to the user. It's really about ownership. It's really about self-sovereignty. And this is the very reason why we have created Ledger, in order to like give the users with the tools so that they can implement their ownership and their self-sovereignty. So it comes with new challenges, security challenges, and so on. At the same time, we are seeing that the financial institutions are starting to adopt crypto, mostly like the technology, the blockchain technology, just because it's like far more efficient. Like sending stable coins on chain is cheap, fast, instant. You have the settlement and so on. Compared to what exists in the traditional finance system, it's already far more efficient. And stablecoin is just like a very simple use case. Think of all the use cases that are already existing in the traditional finance system. All these use cases will go on the blockchain rails and so on. So both things are real and exist at the same time. On one side, I really feel like the revolution of ownership, the fact that you can be completely sovereign and so on, has a big value. And that's why I think crypto is a revolution. At the same time, we have like banks and traditional finance that understand that the blockchain technology is really well suited for their use cases, and they also have like security challenges and security threats that they need to be fulfilled, and that's the reason why we have like there's two main part of the business, one which is more like for individuals, and the other one which is more for traditional finance institutions. And I think like both items are true at the same time, but I don't believe like in a future where every single human will own its value like completely in a complete sovereign way. But for those people for which this part is really important, like crypto is the best way. But at the same time, we have the technology that is adopted by banks. Banks won't disappear tomorrow.
So, like, my way of finalizing that is that the difference between the newbie user and the sophisticated user is how much anxiety are they willing to tolerate to do a transaction. If your anxiety level is really high, you won't do it. So, between like what we're doing with the send to name and the confidential transactions that keep you safe, on top of what Ledger is doing with the metadata around DeFi, where theoretically every transaction is just a plain English thing, that's under the hood of cryptographic proof that your hardware wallet or software wallet can just translate for you and say, you're about to stake to this DeFi contract, this is its identity, this is exactly the amount you're sending, and done. Now we're lowering that anxiety bar, so now the newbie user can be a sophisticated user and they don't have to be afraid they're going to lose funds. So that's like my personal goal in life is to make everybody super relaxed and just lower the bar of technical sophistication required in DeFi and crypto, so that no one can be fooled, including the robots.
Yeah, Max. Yeah, I am a deeply anxious human, so what you shared resonates. And so what we've seen at Privy is not intuitive at all. It's that these embedded wallets that we're provisioning will need to deliver many of the security guarantees that people have historically gone to Ledger for. A couple of quick examples are Pump Fund, Jupiter, Hyperliquid. They all implemented Privy actually to cater to their advanced pro trader audience, not to cater to their newcomer audience. The ability to have embedded UX in the platform and not pop people out to an external application to trade was valuable enough to the extremely high stakes trader. And by serving those users, we've needed to bolster the security feature set to support tens of billions of dollars of transaction volume flowing through Privy wallets per month. And so whether we offer the ability to bring in your own wallet or not, embedded wallets are going to continue attracting more value, and we need to bolster the security foundation of that product so that they can scale confidently.
Yeah, the real challenge is to always improving the user experience while never compromising with security.
Thank you. Thanks for the insightful discussion, and hopefully the audience will be more comfortable to sign any transactions after this discussion. Thank you.
Thanks, guys.
Thank you.
Really appreciate it.
All right. Great panel, guys. Thank you. Thank you so much. Hi, everyone. Stephen Willinger again. I will be your MC for the next chunk of the day. Next up, I'm just going to let the moderator do the introductions, but we're excited to have a bunch of blockchain builders, portfolio companies building for yield in 2026. And moderating the panel will be a repeat speaker in the Stanford ecosystem and a former coworker of mine at Coinbase, Nemil Dalal, who is now a crypto partner at Y Combinator. So please, come on up, everybody, after hugs, of course.
Hello, everybody. Really excited to be here. My name is Nemil Dalal. I'm a crypto partner at YC. We've invested in a lot of different startups over the years, and DeFi is near and dear to my heart. I used to run USDC, and so it's really amazing to see what each of your teams is building. I'll get started. Maybe if we can just do a quick intro around the room, and you can just a minute or less, could you just give a quick intro of your team and why you win in the market?
Hey, everyone. My name is Ash, founder of Axel. Axel's goal, best place on earth to earn yield. Consumer-facing mobile app, 6 to 10% DeFi yield. We're rolling out a bunch of other strategies soon. Team of 8, based in New York. We aggregate over everything that's out there. I think we win because you're not putting all your eggs in one basket, whether it's Morpho or Aave or different chains or new primitives that are starting to be innovated on. We'll take dollars and deposit them into those strategies and diversify with tons of helpful automations. Yeah, I think that's good.
Cool.
I'm Weso. I'm the CTO and founding partner of CAP. We're a three-sided marketplace for private credit. Essentially, it's a novel concept where the liquidity providers, so whoever's providing like the USDC or something that's going to be borrowed in the system, they're completely covered by like basically surety bonds, guarantees from Eigenlayer and Symbiotic. And then this allows institutions to have access to liquidity, create private credit loans, fully guaranteed by the Eigenlayer and Symbiotic systems.
Hi, Steve Pack, Rock Solid. Yeah, co-founder and CEO. We offer single-click access to the best of DeFi. To protocols and partners, we offer custom vaults, customized to however our partner needs it. The reason we win, 3 things. We're in a growth market. Vaults are growing as a larger and larger percentage of crypto. They're kind of the TCP/IP layer, I think, of crypto. That sort of simple interface. We also win because we've found a winning go-to-market motion, which is instead of just putting a vault out there, we work with partners. So we launched with the Rocket Pool protocol, for example, where it's like, what do you need for your token and for your holders to be successful, and then build that for them. And so we kind of launched the vault with a community and a distribution there from day one. And then third thing is technology. We kind of have the second mover advantage. We're able to see what some of the early vault movers did and then really iterate and improve on that. So in terms of being like flexible, being agnostic to strategy, we're really able to, similar to what Ash said, to find the best possible risk-adjusted opportunities in crypto.
What is different this time? So one is crypto prices are in a bear. We've been through this experience where there's battle-tested protocols like Aave, and then there are also things like BlockFi and UST and all these other blow-ups that happen because of high yield. How do you think about this part of the market and where we are in the cycle?
Yeah, I can take a stab at it. Yeah, especially with BlockFi and Celsius, like so much has changed since back then when it comes to yield. Like almost 3 buckets. Number one, at a tech level, I think Max from Preview was talking about this earlier. You have so many innovations to make things actually non-custodial, which prevents actors from doing things with your money that you have not consented to. So when you look at like a BlockFi or Celsius, there are just permissions that they have that they should not have. Like a user is depositing in Celsius, seeing a Reddit post or an ad that's claiming like 15%. But when you diligence where the yield is coming from and where the curator or the actor is allowed to move funds, there's many locations that are not tied to what they've been pitched. With TEs, with ZK proofs, like on-chain vaults, and a lot of what Morpho's doing with V2 as well, for like better permissions and controls on the curator, you have a lot more guarantees as a user. So I think that's one. Like area 2 that's exciting is you have way more liquidity in these markets. Like Apollo, BlackRock, like big institutions seriously tokenizing assets and coming on-chain and using these lending markets helps a ton. Coinbase's mobile app has been great as well when it comes to just regular people being able to go and take out loans, go and invest, earn DeFi rates just on an app. So I think that's been good. Yeah, those are two things I'd highlight. Also, just policy, like the ability to just start to care about this in the U.S. and start moving. I think is now possible. It's not like very off-chain or offshore.
Cool. I have more questions about that. Anything else you guys wanted to add?
Well, I think we also saw that there are still some stablecoins that are sort of like acting like hedge funds a little bit. So though it's on-chain and not just part of like a centralized exchange offering, there's still obviously issues with transparency. We also saw that there was like a big blow up that just happened at the end of last year. I feel like, I don't know, I haven't heard anybody talk about it really, but it was pretty impactful to the DeFi landscape. It like ruined a lot of the different morpho markets because there was just like problems with what they were utilizing as for like oracles, and then there was actors that were essentially utilizing funds off chain, and then obviously losing those during like market crashes, and then there wasn't a whole lot of transparency around those funds, and so they're still like in like the legal process of even just clawing some of those funds back, but it does show like a lot of the high yield season that was sort of going on was like a lot, but mostly because of like a lot of the borrow demand and the looping and stuff like that, but it was caused by these tokens that were essentially doing things they shouldn't have been doing, and we're still trusting them to basically act like hedge funds. So I would like to see that like the yield that comes on chain is a little bit more transparent, and I think we started on that path post like 1010 and all the blowups. And like what Cap's trying to do is actually bring like institutional yield on chain. So we're finally like having for the first time like Susquehanna and Flow Traders and Apollo coming on, utilizing private credit loans via our system, which is real yield. It's not built upon speculative tokens. And I think that's a lot more sustainable and scalable, as there's like billions of dollars of private credit demand that can come on chain.
And maybe a question there is, how does the needs of a customer that's an institutional customer compare to retail? Because I would argue that for most of the last few markets in crypto, it's been largely retail driven. I'm just curious, like, what types of features are you seeing customers look for?
Yeah, I mean, like for us, we can offer pretty competitive rates with private credit rates that are out there, and then obviously there's a lot of like strategies that these institutions want to do on chain, and so getting access to on-chain private credit markets makes things a little bit easier for them. So we've seen some pretty good demand from that front. I also think that like private credit on the retail side is still kind of being developed because it needs more of like a reputational system. So like we've seen products like 3Jane coming out and doing some more retail-focused private credit. So to be interesting, I think, as those markets sort of like mature and we see how those actually end up being and what the default rates are, if they can kind of expand. For us, I think leaning into more institutional focus is like a larger opportunity because traditionally the private credit demand is insane. And so when we were like building the product, we went out and talked to all these institutions, and so we actually compiled like I think a few $1 billion of just organic borrow demand from the institutions we were trying to sell and pitch to. So I mean, it's there. It's just I don't think anybody's built a firm system for that to be easy and accessible on chain yet.
Steven, what's different about this market?
Well, yeah, in terms of what you're talking about, like BlockFi and Celsius, I think it used to be like, that model of trust me, bro, and then, or DeFi, and that was it. There is now more of a spectrum. So our vaults are an example of this where there are trust assumptions, and we make those clear, but they're documented what they are. And when we work with a partner protocol, we can also sort of highlight those and say, if you would prefer this, for example, to be fully on-chain and like only based on an oracle, like we can do that, but here are the risks because I think oracles sometimes cause problems, as well as offer transparency. So, we're able to I think meet customers where they are in terms of what's important to them, in terms of how DeFi native it is versus how many trust assumptions there are. But a big one when you're asking about what's different for institutions, between centralized exchanges, DATs, liquid funds, family offices, they're all very different. So we have institutional investors in the RETH vault where they were already pretty DeFi forward, right? If they were investing in a liquid staking protocol 3 or 4 years ago. So they were quite happy to invest in a variety of strategies. But then you have ETH holders who just got comfortable with staking and maybe have been staking for a couple of years. And they're like, I want to do some DeFi, but only basically staking and maybe Aave, right? And so then compiling a set of strategies that actually meets their risk profile, that's important. You have to meet the customer where they are.
Got it. So one thing I think that's really interesting about yield businesses is that it's often can be difficult to create a moat. And the reason is, for a lot of, I think, the history of crypto, there's a lot of yield chasing. There's hot money that moves between protocols wherever the highest yield are. How do you see that changing in this market? I think you alluded to some of it, but like in this market, are there different forms of moat you're seeing? Is it risk? Is there other things that you're seeing as really the way that are differentiators for you?
Yeah, I can start. I mean, I can talk about Axel first, and then I can talk about places that we choose to allocate or how we view other partners. I think our moats, like a lot of the automations after you've found the yield sources, like speaking for consumers, and this goes from like private wealth clients to just like college kids even, like anybody who downloads a mobile app and wants to save in that, like diversifying your funds across many different locations with automations to rebalance tied to risk conditions is table stakes, and nobody's really built that type of product. Like in theory, that's what the curators of vaults do, and like we've seen many blowups and like curators that are very black boxy. So I think giving users those automations, like if this then that statements, like if Aave does worse than T-bills, get the fuck out of Aave. Like very obvious kind of circuit breakers, and then it could get fancier as well. It could be like diversify across protocols on different chains, like pools have a minimum of TVL. So like we do a lot of that with our trusted execution environments, and I think that's just a straight up tech moat when it comes to like tracking these conditions, getting my users in and out of positions as fast as possible. A lot of what we've seen with like the Telegram trading bots where they have your private key, but people use them because of how fast they're able to get you in and out of positions. Like that's exciting. And then for people outside of Axel, like I think there's a moat in like handling scale for a long time. Like when I look at like Gauntlet or Centaura or some of these folks that we chat with on the curator side, like if you can prove that you've had a vault or strategies that have weathered things like 1010 to an extent or have handled like sizable TVL during big market turnarounds, like that's exciting. That builds confidence. Like it's art and science. That's a lot of what we say internally. There's like the science of just the pure metrics and how long it's been around, and then there's the art of like this guy's done it for a while. So that's how I think about it.
I think we need to get people off of like risk-free yield. So for a long time, especially for like ETH stakers, Bitcoin holders, they're coming into DeFi and they're just kind of like earning speculative tokens that are just going to go down in price, and then they sell them for more of whatever. But it's pretty risk-free for them. So I think in order to get like some really important and impactful new DeFi primitives on chain, the people have to start to take risk. And so, like, even for us, I think, like, one of our motives is obviously the business-to-business side. So going in and talking to the institutions, getting them to trust, hey, like, come on, use smart contracts, borrow from us. At the same time, we need delegators to cover those loans. So people with Bitcoin, people with ETH and stuff like that. So how do we get them to say, hey, come in, cover this loan. If it defaults, you might get slashed. That's risk to them. But right now, they're just kind of earning eigen tokens, and they don't have any risk of slashing. So how do you convince them to stop doing that and come take on some risk? What's the premium you have to pay above, what the risk-free premium is? And so for us, it's been like obviously doing a lot of those negotiations. And I think, we've worked really, really hard on the business side. The tech stuff, it is novel code. We're building on top of the shared security systems. It's really fun to build that and, to take on the features that we need. Like we're going to offer fixed rate lending and stuff like that, stuff that we got from the institutions that are feedback. But I'd say we really have to win on the business side. So going in and talking to people who, haven't had conversations with Web3 companies like that before.
Yeah, in this way, crypto is no different to the rest of the world. Distribution is king. Distribution is everything. And that's why we went with this go-to-market model of like launch a vault with a partner, right? So in Rocket Pool's case, like we had hundreds of depositors on day one, like mixture of retail and bigger ones. And those are the types of deposits that are sticky, right? You said like there's yield chasing, so like we're chasing yield, but on behalf of our depositors. So it's nicer to be on that side. But yeah, once you're established in a community and you're like integrated into front ends and stuff like that, like as long as you do what you say you do, like and do it well, like it's hard to have a reason to boot you out, right? So I think like being smart about where you find distribution and then just doing a good job once you're in. I think that's still the killer moat. That's going to be more than technology, more than even yield is that distribution.
Okay, spicy question. In yield, one of the biggest ways people do it is to launch a token. So question, to token or not to token?
You're saying like tokenize the yield?
So a lot of teams have been launching tokens. Back in the day, Aave, Compound, all these others launched tokens. That was one way in which to drive initial usage. Curious, you guys are all early stage. how do you think about like launching tokens?
Yeah,
Again, you don't have to share, if you don't want to share it for your team, you can at least share it when you give advice to a founder.
There's a lot of other good comps too. Like I look at Maple and EtherFi all the time. Like these are two like yield businesses, similar business model to what Axel is trying to do. And like EtherFi is going super consumer and normie with like a lot of what they're doing with the cash product. Liquid tokens in the market. A lot of people think Maple is very undervalued. Like I think it's too early at the stage that we're at, and frankly, like most companies in crypto, like to that exact point, like win the distribution, win AUM, hit targets, and then think about like launching a token, at least for where we lie in the stack, which is like top of it completely. Like I'm the consumer app doing like the Instagram UGC content and like getting you onboarded, thinking about ramping, like all of that. It doesn't make sense to distract yourself with like token utility at this stage is what I think about it. But there are a lot of good comps. Like it's interesting to think about like tokens beyond purely being a shareholder in the business. Like if you're a Maple token holder or an EtherFi token holder, maybe you get to, maybe people could be curators or decide certain strategies based off of what they hold. Like it's almost me outsourcing some of the risk management to people that hold the token, which could be interesting. But no, for right now, all we think about is like distribution.
Okay.
I mean, it's like the easiest method to bootstrap a little bit, right? Yeah. So I think just because of how competitive the space is, get your brand out there to start to build. I think we had a point system. So it's, we bootstrapped a lot of liquidity, but at the end of the day, what happens is you end up paying a lot of money in your token to people who are mostly just there to farm it. And so there is a disconnect, I think, when some of these you're issuing a token, you send out your airdrop, you have some distribution, immediately everybody sells it, token has a bad chart, goes to zero, and we've seen a lot of even chains, blockchains, like people sit there, they'll farm it, they'll use it. They're using the applications, they have lots of TVL, they launch a token, the airdrop, TVL goes to zero, and they move on to the farmers go on to the next chain. So we're really trying to avoid that. So we actually came up with like our stable drop, which is instead of airdropping tokens, we're gonna airdrop you stablecoins. And we're shifting from hey, you've now farmed us. We know you're going to sell the token anyways, majority of the time. But some might want to hold it and speculate on it. But majority of the time, people are just using it for yield, especially when they're farming with stablecoins. And so we'll give you stablecoins. We'll give you the yield that you were farming. And then what we're going to do is we're going to shift now over to the ICO. And then when people come in and buy the ICO, we believe that those are people that want to be in the token. So it's just aligning people on who should own the token, and we believe the people who are going to come in with their money and say, hey, I'm going to purchase the token, are going to want to stay in it for a while, and that those who are farming it for points or whatever are probably not, and so we'll just give you guys stable coins. So we're trying something different than what everybody else has been doing. I think the whole airdrop model is sort of broken, and so we'll see how it plays out, but it's at least innovation on that.
Cool. Yeah, I'd echo all of that, especially the there be dragons here, right? There's a lot of ways it goes wrong, and every token chart for the last 18 months seems to have just been trending to zero. So you need to have a better plan than just put it out there and airdrop it, right? For us, like we earn fees, right? Like our business model is grow AUM, earn money for our clients, take fees. So like we do have a very good basis for a token, like at the point it makes sense. And I think the point it might make sense for us is, yeah, at a higher AUM in a better market when it's like we really want to accelerate growth now and do it now. I think in this market, for us, not the right time, but yeah, that time may come, not sure.
Got it. So in the last year, there's probably been more changes in crypto regulations than for many years. And I'm curious from your perspective, are there specific things that you're looking for from regulators that aren't there today? And specifically, for example, clarity, there's a lot of conversations going on right now. Curious, like, what are your thoughts on that as well?
I might have like a very different take from people, but I read the full Clarity Act, and we got lucky enough to meet Hester Pierce and some other folks. The SEC has done a lot of great work with just trying to talk to early stage crypto companies. It seems pretty good. Like it name drops vaults. It's very like explicit about like what is actually non-custodial and what's like somebody is a custodian who's managing funds. Like if you're in the clear, whether it's like purely on-chain contracts for like a vault or like maybe some of this new tech like TEs or like other things, I think you're pretty good. Like I think it delineates a lot. It lets people innovate. Yeah, I've been pretty happy with it. I think Coinbase is pissed because like you maybe live in this gray area. Like you're building at the intersection of people who absolutely need licenses. Like you need MTLs, you need a banking charter, let's say, and then you're also like doing your own yield products and like trying to own that side of things. So like there is an argument that maybe you do have to be regulated. A lot of what you see on Twitter with like stablecoin yield is the main issue. Also, like, it doesn't really impact me. Like I'm not passing on my users T-bill rates. Like we're looking at far like more diverse ways to generate yield. Could be basis trades, could be private credit on chain. Today it's just the money market funds, like the lending markets. Like, so to me it doesn't really help me sell a new user if like, oh no, they can't just hold an Axel stable to earn T-bill rates. Like that doesn't matter. And I think most people don't care about that. Like the high yield savings market is already so saturated. Wealthfront, Betterment, Wealthsimple, like you name it, even Robinhood Gold or like most bank accounts. If you cared, you would have already found a way to get access to T-bill rates. So I frankly don't understand why it's such a like huge issue right now.
Yeah, I mean, I just think participation, especially like on the institutional side, needs some like guidance. So like, or at least guidelines to say, hey, like, you can interact in this fashion. Because right now that's part of the skittishness of a lot of people that want to come and interact on chain but haven't done it yet. Is that like, you know, they don't want to live in that gray area. They kind of know what they can and can't do. And so I think that, you know, passing, you know, I don't know if we're ever going to agree with everything that a regulator is going to make, right? Like, I'm definitely not pro-regulation, but I do think that if you do make guidelines, then at least at some point, you know, institutions and stuff will start to come on chain a little bit more and work within that framework. And especially like, you know, we're building a stablecoin, right? So it doesn't impact us. But I think, you know, for us, it makes us like, hey, however we're going to design our stablecoin now, we can design it in this way so that it is, you know, compliant with whatever the Clarity Act is going to, you know, end up, you know, it's not actually passed yet, but whatever it ends up saying. So we have been watching it. We have been, you know, working with our legal team and structuring and designing to be, you know, obviously compliant with all of that.
Yeah, just tell me the rules. I just want to know the rules. Like, I'm sure I'll like some of them. I'm sure I won't like some of them, but tell me what they are. Like, it's way better, at least we don't have the regulation by enforcement anymore, or it's like, Uniswap, you're like an orange farm. We're gonna prosecute you. But
are there specific rules you think are missing?
In Clarity, it seems to update pretty regularly. Like, the last version I saw, I appreciated they were trying to make clear like what was decentralized and what not, what wasn't. But like there seemed to be some weirdness around things like even if there was like an emergency pause when a hack had been identified, well, that's not decentralized, so you're now like a centralized custodian. It's like, well, is that really what we want? Like, so I don't know. There's details, right? But whatever they are, like, yeah, just give us the rules.
It is wild though, right? Like you're like protect us from hacks, or like, you know, help put something in there to, you know, we can, you know, utilize in order to protect us from security incidents. But then that makes you centralized. So it's like, where do you go as a protocol and how do you build?
Yeah.
Yeah, so I think that's something interesting to see what's going to come out of Clarity. I think candidly, it changes by the day is the sense that I get. Well, thank you all very much. Really excited for this next wave of safe, maybe secure yield and probably more broad participation in it.
Thanks for having us.
Thanks, everyone.
Thanks all.
All right. I mean, that is where DeFi is going, right? As we get regulatory clarity, like that is the infrastructure that's going to allow us to be capital efficient, and those guys are leading the way. So we have another awesome panel coming up right before lunch. Capital formation. Basically, since the ICO boom, it's been like the killer use case for crypto. But now it's actually finding ways to become legitimate, getting regulatory clarity. So we brought in one of our favorite lawyers, Joshua from Blockchain Capital, who is just a total boss, and he's going to walk us through this with a couple amazing founders who he's going to introduce. Come on up, everybody.
There's no such thing as a favorite lawyer. Nobody has that. So just set expectations right now. Hello, everyone. I'm Joshua Rivera. I am one of the partners and, yes, the lawyer, the general counsel at Blockchain Capital. Blockchain Capital is a venture capital firm. We invest in startups. We've been doing that for almost 14 years now. We are exclusively in the crypto space. We think a lot about capital formation. We've been doing it. We tokenized our own fund in 2017, which was so much fun. But it has actually become a really interesting vehicle. And I'm really excited to explore this topic a little bit deeper today, understanding that you guys are waiting for lunch. We stand in between that. We'll try to keep this engaging. And so I'm going to just do a quick introduction to all of our panelists. And then I'm going to let them kind of talk about their platform. So first up, we have Helena Zhang. Helena is the co-founder of ICME. ICME is tokenizing startup equity and hopefully facilitating liquid trading for startup equities before they become public. And so that'll be interesting to talk about. And then we have Anj Gallego? Yeah, okay. Anj is the co-founder of Dev.Fun, which is utilizing AI to essentially supercharge dApp building and distribution. And this is all in service of finding opportunities to bootstrap funding. And then we have Ev, and Ev has asked me not to butcher his last name, so I'm just gonna let you look at it up above him. But Ev is at Legion. He's the commander of operations. Legion is a merit-based fundraising platform operating predominantly out of Europe and is essentially looking to allow for professional-grade token launches and token distribution. So all founders kind of speak about their projects better than someone else. And so I'm going to let each of you just kind of go into more detail around what your project is, what it does, and maybe why is it unique in this kind of moment in time from what we've seen in terms of capital formation in the past in the space. So Helena, we'll start with you.
Yeah, thank you for the introduction. ICME's goal here is to basically fix the problem that a lot of token holders face, which is that their incentives are not quite aligned with the project's incentives. And the way we do that is for all the tokens we launch, they're backed by something real, that being equity. So the token holders end up being shareholders in the actual company. And we do this through a couple regulatory exemptions. And the goal is to enable 24/7 trading, global liquidity, and a platform that enables early stage startups to fundraise continuously alongside their typical mechanisms with venture capital.
Yeah, Dev.Fun is a platform we started a year ago, and the goal was to help people build Solana apps with AI, and we kind of drifted away from that and created like capital formation primitives like pre-sales, but everything was oriented in the way that basically you're this new generation of people building products very quickly with AI, bootstrapping it, and then like going to market, and yeah, that's what kind of we're doing.
Yeah, I think at Legion what we saw with the most fundraising platforms is the issue that it's a one-way opt-in, that users choose the projects, they invest money, but founders and projects, they don't have any say on who to accept and who to see at their cap table. So what we're building is a two-way opt-in system where users apply into the sale or into fundraising, and projects can choose who they want to accept. And we use a merit-based system based on on-chain reputation, social, developer activity, value-add participation in the previous launches. So like all sorts of stuff, which helps us prevent from Sybils, from bots, and from just the value extractors, people who buy the token and immediately dump it.
Yeah, Ev, I want to stay with you for a sec because your concept of kind of merit-based capital formation is not something that I've heard before, at least articulated with those words. And from what I kind of saw looking at your project, you're really trying to kind of do a 2017 style ICO correctly. And so could you maybe talk about like what were the deficiencies that we saw in previous ICO kind of cycles in the space? And kind of how does Legion specifically address that in a way that is like better for the participant?
Yeah, so I think like first thing is compliance. Like in 2017, there was like zero. I mean, you're a lawyer, you know, just wild, wild west. So you just send money, you get the token, great. So what we're trying to build from day one is a fully compliant system under MiCA in Europe and under Reg S in US that users, like they do KYC, they do proof of address, and they're like fully verifiable who invests in the projects. Like for serious startups, they're not going like degen route. We're just like, hey, here's a contract address, send us money. People like want to build for the long term. The second thing is like hot deals. They are getting oversubscribed, and normally the flow is either first come, first serve, or just a raffle based or fill from the bottom, which creates tons of problems. It's either like Segalls and bots who get all the allocation, and like normal users don't get anything, or even if it's a real user, a project you don't have any control who this person is. They get the token, and what they do with the token, like in 99% of cases, they just immediately sell the token. So the challenge is like how you can identify the people who will bring value to the project by holding the token, doing something useful for the project, contributing, like whether it's on social or to code base. And we built this system, which we call Legion Score, to identify those people.
And Helena, you also are kind of trying to approach this problem in a unique way. Can you like give us a little bit more detail, like how are you leveraging maybe those regulatory rails that you mentioned to both open up markets in kind of private equity, little p private equity, little p little e, right? As opposed to what we saw in early ICOs.
Yeah, for us, we've done a lot of legal architecting here. We've taken a look at the existing regulatory exemptions, and we've kind of looked at them and been like, what can we do here to enable what we want, which is we want people to trade them without being an accredited investor, and we also want very liquid secondary markets. So we took a look at, Reg CF, Reg A, and we were like, what can we do here to really enable what we want? Is it, reducing holding times? Is it enabling crypto on these regulatory exemptions? And so we've strategized a combination of various tactics to do what we want. And the goal, like Ev is saying, is to, create capital formation that is very aligned for the founders and also for the token holders.
Amazing. And Anj, yeah, I would also love to just hear, when I saw on your project, right, deploying or enabling kind of app development or decentralized application development, right, to enable bootstrapping, I'd love to hear kind of what is that sounds a little different from kind of these two projects seem kind of more aligned. Can you explain kind of how your project is approaching capital formation via enabling app development?
Yeah, I mean, we're not really even like kind of a launchpad. Actually, we're happy to refer projects to even others. We did build some primitives because they didn't exist and we just needed them.
Like what? Like what kind of primitives?
Like we built something we called IPO, which is an initial pump offering. It's just like a pre-sale contract on top of like the pump and bonding curve that just flattens it, gives an equal price to everyone, but it just redirects it to pump.
But you called it IPO?
Yeah.
That's bold. Okay, all right.
I mean, right.
No, continue.
But I think like our main thing is like how do we bring more builders, and the other main thing is like how do we make sure that I think we made like a massive mistake when we were like, okay, we're gonna tokenize early stage projects. Like that sounded amazing, and it's absolutely terrible in practice.
Okay,
so
we got a little difference of opinion on the panel. I like it.
There's this massive hangover right now, right, in crypto. Like we super fucked up, like tokenizing all these projects very early on. And so how do we make sure now that this doesn't happen again? One of the ways we're thinking of doing this is basically making, revenue verified, like user traction verified, like these kind of things. Because like tokenizing pre-PMF is kind of suicide, and we drank our own Kool-Aid here, right? But
okay. Yeah, so that's a great question. I actually was thinking about this, Helena. Is it a good idea for, not even tokenization, do you want early stage startups to have liquid equity? Like, is that a good idea for their equity to be freely tradable in a liquid market that is priced, right? Talk a little bit about your thoughts on that.
Yeah, I totally think so. I think there's still some public companies out there still trying to find product market fit. But other than that, I think it's a really good avenue for early stage startups who have found like some traction with their product to use the token, which frankly, should have been a really beautiful thing. I mean, the token was always supposed to represent something, whether like an ecosystem was thriving and the token represented a currency for the ecosystem, or the token, itself is like kind of like a marketing engine. And we've seen this again and again with a lot of projects like Aster, which a lot of people discovered through their token. And so we think that for these early stage companies, we can have this token for them as a marketing engine and kind of like bring back like this like beautiful narrative of what a token could be, which is to help a company grow. And that's also why we've structured ourselves a lot like how an IPO works, where roadshows run and then the token's launched on like an order book. And I think if it's done right and the token is not backed by just narrative, but by something real like equity, it's ultimately really beneficial for the startups.
So in some ways, you could think of what you're trying to do as kind of like democratize venture capital investing in some ways.
In some ways.
Interesting. Okay. Let's move into kind of using that as a platform. Like, what types of projects make sense to use your respective platforms? Like, what are you guys looking for? Are there examples of projects that are leveraging what you're doing to engage the rest of the industry in a unique way? How about we start with you?
Yeah, we have two types of launches. It's pre-liquid token sales, so early stage projects which will have a token at some point, but it might be in 6 months, 12 months, 18 months. So you can invest early, or ICO type of deals where you invest in the project and then 2, 3, 4 weeks later, there is token is live. You get the token either fully liquid or it's vested. So a couple of examples. Last year we did a sale with Yield Basis from Michal from Curve. It's his second project. Went really well. We had 200 mil in deposits in the contract in 24 hours. So huge demand for 5 mil allocation. Yeah, price went up. Everyone was happy. So that's kind of like the metric.
Did price stay up?
It stayed up for a very long time. I think it's back to the ICO price. And we did the sale in October, so like after 6 months. So yeah, it was like pretty successful from a price perspective. Like project is working, generating revenue. The other launch we did was with the project called Sport.fun. It's a fantasy sports product on Base. So the guys did a really good job. I think like both projects, what they did really well in selecting who will get allocation. Because in Yield Basis example, they give priority to people who supported Curve early on. It's all verifiable on chain, like who interacted with Curve, participated in governance early on. Those people got the priority access. So there were 200 mil USD in demand for 5 mil allocation. So the team did a really good job in selecting those guys. And Sport Fun, they prioritized users. So if you use the product for the last 3, 4, 6 months, you get the allocation. It was also 4x oversubscribed, so 25% of people get the allocation, and priority access was to the people who actually use the product. And then if you look at Sport Fun stats, only 14% of people sold the token on day one who bought it. Because again, if you use the product, probably you believe in the team, you believe that they're building for the long term, and you are more incentivized to keep the token. So I think those are two good examples of like how projects select the audience.
Anj, does that answer any of your concerns around early tokenization, or you still have skepticism? And if so, like how is Dev kind of taking a different approach and enabling kind of what you see as the friction there?
No, I mean I think like Legion, the things they tokenized are pretty later stage. And so I think it's perfectly fine to just tokenize at that point, and especially larger raises. For us, where we are really positioned at the very, very early cycle, like almost the bootstrapping, like you have like these solo founders just coming on and like bootstrapping products, those people should really not be making a token. And so what we want is just be top of funnel for all these builders. And kind of gives them a way to graduate into maybe something larger once they achieve like some PMF, like we can connect them to capital. And I think that's really the approach we're taking now.
So is it so you enable them to develop apps, and then as they go along developing apps and their kind of own protocol is growing, you can connect them to capital along the way?
Yeah, I think that, I mean, we're like completely revamping the product to also fully reflect this now. So yeah, you have like basically SDKs that you integrate in your apps when you're building, and this is going to track like some metrics. These metrics can be used to basically prove like your traction and these kind of things, right? Like people love to self-report and brag about it, and we just want to have like a leaderboard for it basically, and you can graduate, and we're going to connect you with capital, with maybe Legion, maybe others.
Keep you honest. Okay. So, Helena, is there, like, do you have a a kind of profile of project that you think, no, this is actually really a good kind of test case or a good example for early stage tokenization, right? And then are there ways that you think a liquid market for early stage tokenization can be informed better than they are now?
Yeah, for us, I want to say the sweet spot is companies that have already raised around, perhaps at the seed stage or the Series A stage. So companies that have had traction and some kind of product market fit. I do think it's risky for you to just like vibe code like a project and then launch a token for it and promise like your token holders a return. I think that's pretty dangerous. And for us, there are filings involved. So the companies we launch for would need to have, audited financials and financials to begin with. And we're not really exclusive to Web3 at all. I think there's a lot of potential in bringing like robotic companies, healthcare companies, all sorts of companies, AI companies to the platform.
Okay, so I think we've got a lay of the land here. Something that we at Blockchain Capital have been thinking a lot about is value accrual mechanisms. Obviously, we're talking about tokenization at some stage, and maybe tokenizing equity, maybe not. I think what we have seen is it is difficult to kind of merge value accrual between equity and tokens. And it's also difficult to understand whether one or the other is the better way to go about accruing value to a specific project. So I'd love to hear how you guys think about the token as the tool for value accrual itself. For you, you're tying it very closely to equity. Is that similar or different for each of your projects? And how do you see it? Are you hoping that value is only tied to the token, or is there kind of a parallelized kind of equity component for your projects as well?
Yeah, I can start. Yeah, I guess like we are in this regulation framework, which is a bit retarded with the labs plus foundation, and there is equity plus the token, unfortunately. So we raise only for the teams which have a clear value accrual back to the token, not to the equity, because otherwise, if I do a structure, then it doesn't make sense, because then if 50% goes back to the equity or more, then why you buy the token? I guess I really respect what Elena and the team are building, and we're also looking into this direction. Like how you can make sure it's just one thing instead of having equity plus token, whether it's like token is the equity or equity is the token. I guess there is no clear legal frameworks right now how to do it, but I think that's the direction we are going as Legion, but as an industry as well.
Anj, do you have thoughts on kind of the value accrual split?
Yeah, I do. I don't really care or think about this. I think at the end of the day, there's no amount of mechanism design or financial alchemy you can do that's gonna save you from not having PMF or making money. And so that's really what we encourage builders to think about the most. I think if you make money or you have users and actual real PMF, you can solve most problems, and you don't really need to think about those things as much, especially in the early stage. So we're pretty agnostic to whatever they want to do. I've seen any type of structure function. I think we can make anything work.
And Helena, is there a role for a token outside of just tokenized equity in your mind?
Yeah, definitely. I mean, I know we touched on this a little earlier, but the token can be a marketing engine. It could be a form of currency for your ecosystem if it's thriving. There's a range of things. I mean, I think there's even possibilities out there that haven't even been introduced. I think a lot about the loyalty points that Starbucks offered as their own form of currency within their ecosystem. And I think we'll see more occurrences like that in the future when, the token holders feel aligned.
Great. Okay. We are fast running out of time. Good news for you guys. But let's just touch on regulation a bit. I kind of left it for the end because I didn't want you guys to fall asleep. But that, capital formation is something that's heavily regulated. what are kind of the things that you think are still needed to enable the best use of your platforms in terms of kind of new regulatory paradigms for capital formation? Or do you think like we have what we need and you know, like we should just continue on?
Yeah, I guess I can start. But from our side, it would be great to have a very clear framework in US on how non-accredited US investors can participate in token sales. We had the first precedent of doing it last year with a pretty big token sale where US non-accredited investors could participate without clear legal framework. So I think like some platforms will go into this direction, but it would be good to have it on paper, which can, again, unlock the biggest market on the planet for token sales.
Lena?
Yeah, and this is something like we'd love to work with you guys on. I mean, in our heads, we're like, you know, we're just launching securities, and we're like not afraid of it because we're going to do it in a compliant way. So yeah,
but do you
excited
think
about
like
that.
do you have everything you need, or is there would your platform benefit from additional kind of regulatory framework or thinking?
Yeah, I mean, like we view regulation as a good thing because, like, I think in decentralization, like you can have a lot of bad actors. So we actually want like as much regulation as possible.
Okay, Anj, giving you the closing thought.
Yeah, the lion doesn't concern himself with regulations. No, actually, we're not really a launchpad, so we don't we leave it to you guys to figure it out.
Perfect. Well, thanks everyone. You get to eat now, speaking of lions, and we really appreciate the time.
Alrighty, thank you for having me. I'm here to talk today about what happens when the bottleneck disappears and what I see as 5 really critical problems that we need to solve as an industry in order to accelerate the growth of crypto and to have crypto be far more impactful in the rest of the world. My name's Keone Han, one of the co-founders of Monad. I started working on Monad about 4 years ago, and prior to that, worked in high-frequency trading as a quant. So spent a number of years in traditional finance, building efficient markets and learning about how the rest of the financial system works. Now trying to apply that to crypto. And Monad went live about 3 months ago, so this is a perfect time to chat about what the next frontier is. Just to sort of set the stage, sorry about that. Just to set the stage a little bit, I've been building Monad for the past 4 years, and the result of that work is a decentralized, credibly neutral layer 1 blockchain that has really efficient, really fast block times of 400 milliseconds, and a really high degree of decentralization as well, with low hardware requirements and many, many nodes participating in the network. It's a clean build, it's fully open source, and there's a number of key innovations that enable this, ranging from Monad BFT, which is a new, sorry about that. Just making sure I'm on the right presentation, but I am, we're all good. So there's a bunch of new innovations that enable this really high performance, but at the end of the day, what you get is a really decentralized, credibly neutral layer 1. And just to sort of give a snapshot of where we are right now, we're about 3 months into mainnet, $480 million of stablecoin on chain, $250 million of TVL, and so far over 3 months, 150 million transactions. And that's great, but this is really just the start. The dream that I have, which I think is a dream that many folks here in the audience share, is the goal of enabling a much more open financial world, where we bring many more assets on chain and we give many people access to many more assets, as well as tools for personal finance. One of the key unlocks of crypto is that assets are composable. People can apply leverage. People can, for example, own high yield bearing assets and lever those against other interest bearing or other assets that are much lower interest. And overall, it just enables a great degree of composability that can help our economy grow. And then lastly, another tenet, I think, of this open finance thesis is that smaller companies that currently maybe only have access to capital in a very localized market where there's like one or two banks that they can go borrow from, instead have access to a global set of lenders and can get better rates. Ultimately, what that means is that smaller businesses can grow faster, spend less on interest, and ultimately this enables more innovation and entrepreneurship. So I think it's very exciting what is possible if we can grow the adoption of crypto and if we can help address really the boundaries between the crypto world and the non-crypto world. And our thesis at Monad is that this requires a decentralized, credibly neutral base layer. We believe that asset issuers require decentralization for the purpose of counterparty risk minimization. They don't want to have to trust a single centralized sequencer. They want to know that everything is immutable, code is law, and that there's not just a single centralized sequencer that can do things on a whim. So this is really our thesis about the open financial world. But I think in order to address that, there's some problems that we need to solve. So first of all, in Monad, we see efficient markets getting unlocked. And one case study is order books on Monad. Kuru is a order book exchange on Monad. On Kuru, market makers can update their quotes really efficiently to reflect whatever fair value is. These tight quotes mean that capital can be used very efficiently, and it means that when people are trading, they can experience very low slippage. Compared to AMMs, as an example, which leak value to arbitrageurs and often need external incentives in order to sustain markets, especially for new tokens. What we've seen over the past couple of months on Kuru and other order book exchanges on Monad is that they're sustainable without incentives. And this is actually a huge unlock because it means that now there can be good liquidity on new assets without a bunch of emissions of that new asset token in order to sustain those markets. So I think this is one little building block in the overall growth of on-chain finance. And you could see kind of on the right, the growth of Kuru's volume over the past couple of months. We have sort of 5 major problems that I want to talk about today that I think need to get solved in order for this open market thesis to really play out. The first, I'll mention them really briefly, and then we'll talk about them in greater depth. The first is operational infrastructure, ownership infrastructure for RWAs. The second is transparency layer with operational audits for real-world assets coming to the blockchain. The third is fair outcomes and leverage looping. The fourth is the growth of indices in the crypto space. Indices are massive in equities. They're massive in the real world, but very limited adoption in crypto. And lastly, I want to talk about credit worthiness and this problem from the perspective of growing on-chain massively. So first of all, to talk about the operational and ownership infrastructure. So RWAs, I think everyone is excited about RWAs. We're excited about higher yielding assets coming to the blockchain. We're excited about tokenizing everything, anything and everything, all mortgages, equities, credit funds, you name it. But I think something that is not discussed very frequently is those ownership structures and how robust they are legally and how robust they are even in the tail risk scenario where you have the operator go down or disappear or have a problem, because that is fundamentally the thing that is blocking these real-world assets when they come on chain from being fully trusted and from being a better version of the non-tokenized version. So to talk a little bit about this in high-frequency trading terms, in HFT we have this concept of creation and redemption of ETFs. And if you're familiar with this, basically creation means that if you're a market maker and you go and you end up with a bunch of inventory, which is all of the individual assets within the ETF, you can go turn those in and to the issuer of the ETF and get the ETF back. And conversely, redemption is turning in the ETF and getting all the underlyings back. And so in the notion of tokenization, this is pretty much the same thing. Like, is there a robust mechanism for turning in the tokenized version of the asset and getting the underlying, or at least getting a cash equivalent? And is there a robust version for creating this asset? And I think the winner of tokenized equities, and more generally the winner of any tokenized anything, is really the entity that does a really good job of creating a robust creation redemption mechanism. Because and the reason for this, by the way, is that if you're a market maker and you're trying to make a market on this tokenized version, then you're often going to end up with supply imbalances or demand imbalances. Like, there might be moments when everyone is just trying to sell the asset to get back to stable coins, and you end up with an excess inventory. And you need to be able to go exit that inventory back to the real world and lean on the rest of the market and lean on all the liquidity in the real world market. And if that is not seamless, like if that process takes days, or if there's no redemption mechanism at all, then the price is going to deviate substantially. There's not going to be good liquidity. So I think really the growth of RWAs really is dependent on exceptional operational infrastructure for ownership of these assets. The second is transparency. So I think that we've all seen the rise of different tokenized hedge funds, tokenized money markets that are all sort of presented as stable coins. And recently there have been some really high profile collapses. USDX recently, like maybe 5 or 6 months ago, where it just turned out that the fund that represented that stable coin ultimately was not being responsibly managed, and there just was not transparency in what was going on. So I think that having exceptional transparency into the input-output and where assets are actually going is a really important problem that needs to be addressed. There's a protocol on Monad called Accountable that is doing a great job of bringing new transparency to this effort. I think more generally, the effort to bring transparency and third-party auditing, for example, like an S&P of crypto, I think is extremely important as well, where it's not just the asset issuer that's examining the asset, but there's a third party that's staking their reputation on this. The third one, and this is a little different, but leverage looping is clearly, in my mind, one of the key areas where crypto's found PMF. It's where there's an asset that's yielding, let's say, 8% or 10% or 15%, and someone levers up borrowing against stablecoins paying, say, 4% or so. And this helps these assets to grow substantially. It allows people that are further out on the risk curve to take on leverage. And compared to the risk that people are taking when they're trading like perps on altcoins, it's actually like a lot less risky. So this is clearly an area where there's been substantial growth, and leverage looping is huge, has been a huge part of the growth story of DeFi over the past couple of years. But getting really fair outcomes is extremely important, and it's really a balancing act, because on the one hand you have, you want to protect the people that are leverage looping, that are borrowing. You don't want to give them an unfair liquidation due to a flash crash or a mismarked price. On the other hand, you also want to protect the people that are loaning stablecoins to that borrower and make sure they don't end up with bad debts. This is a very tricky problem, tricky balance to find, and we need to find better ways of doing this. Fourthly, indices. I said this already, but indices are massive in the real world, and they're not there's still like very nascent within crypto. Just as one data point, the S&P 500, a huge part of the outperformance or the performance over the past couple of years has been driven by ownership in a couple of big companies that have massive AI exposure. And for all Americans that just own these indices, they're exposed to that, and they're getting carried along as AI gets bigger and bigger. And crypto needs its own index products. We don't see, like this is still quite new, quite unexplored. Glider is a great example of a team that's building indexing in the EVM space. But I know that there's just a lot of room for this to grow, considering where crypto is, or considering where the rest of the world is. And then lastly, creditworthiness. So I think the on-chain world, again, one of the theses of the open economy is that we can bring tools to many people and many businesses that currently the tools that they have right now are centralized, or they're very local, they're very limited. If you're a small business owner, really anywhere, but especially in an emerging nation, your borrowing options are terrible. The interest rates are super high, and this constrains your growth, and it means you're spending a lot of the income from your business just paying down interest. And if we can open up access and we can get the global lending market connected to all of the local businesses, this is a massive opportunity for greater productivity. But obviously the hard problem is, how do you actually make sure that people are going to pay back? They don't just run away. So I think that there's a huge unsolved problem here with respect to allowing people that are borrowers to establish creditworthiness and prove that they are creditworthy, and over time build up a credit profile that then allows them to unlock better rates. So just in conclusion, I know that, as one of the co-founders of Monad, you probably thought that I was going to come here and talk about Monad and talk about EVM and parallel execution and things like that. But I really wanted to come here and talk today about these problems that I see that are untapped, because I think they're all really at the same thematic juncture, which is solving the juncture between crypto and the rest of the world. And I think for crypto to scale, and for crypto to be maximally impactful, and for crypto to accelerate the trends that we're excited about, we need to solve these problems. So at the end of the day, it's on all of us to tackle these hard problems that aren't always technology problems, but are actually real-world problems. They're regulatory problems. They're operational problems. And we just give a shout out to everyone who's out there trying to solve these problems right now, because it's going to be really impactful in helping crypto to change the world. Thank you.
Thank you, Keone. Excellent. Well, I hope everyone enjoyed that. We can take this moment if you're standing by the door and want a seat. There are some available in the front. This is a good time to shuffle around. If you like standing, that's fine. Cool. So next up, I will be moderating a panel. So I am MC and moderator. So I'll bring up my guests and introduce them as they walk. I think, as many of you know, this has been the year for stablecoins, right? Legislation has cleared the way. It was already a fast-growing sector in crypto, but the growth has been astronomical. There has been volumes. If you're monitoring on chain, or if you have portcos, or if you're working in the space, you know that volumes are vertical. And there have been many companies who've been working hard in this space leading up to this moment, and are now leading the charge. And so we're very excited to have two leaders from the space up on stage. To my left, we have Jerome Fowry, founder of Immersive, which I'll let him describe what his company does in a moment. But they are a principal member of the MasterCard network and a BIN sponsor. Well, he'll tell you what that means. And then we have Christian Rao, a senior vice president at MasterCard, in charge of global partnerships and digital assets. So we're very lucky to have these two gentlemen here. Please give them a warm welcome. Thank you. Okay, so I guess before we dive into the hard-hitting questions, let's lay some groundwork around how this works, right? So Christian, I'll start out with you. Can you, at a very high level, and don't eat up too much time, tell us what initiatives MasterCard has in the stablecoin payment space, starting with the ones that have high volume and product market fit, but then also tease us with some of the further out ones.
So first of all, thanks for having me. The use cases we see today are, we use the term on-ramping. I think that is a universal terminology. Basically, users are using their debit and credit cards to move money on platform or directly through on-ramps like MoonPay, Stanczak to buy crypto directly. So that's very, very decent volume for us today. And then we see that holders of crypto in stable coins increasingly so want to spend their digital assets, but it's very cumbersome if you think about it in a sort of pure on-chain environment, so that we came up with crypto cards, and Jerome can speak to that, where essentially you have the benefit of spending digital assets, but you have access to the entire MasterCard acceptance network. So this is what we are doing today. And then we're looking at more, let's call it digital asset native products such as stablecoin settlement, a multi-token network, agentic payments facilitated by stablecoins on microtransactions. And all of this is more forward-looking, but what I described today, or what I described initially, is where we see a lot of traction and where we partner with Jerome and other people.
Awesome. And then Jerome, to you, like what is a BIN sponsor and what does Immersive do? How do you partner with MasterCard?
Yeah, cool. So very simply, a principal member of MasterCard is a similar relationship to what the banks have with MasterCard. You know, so we have our own regulatory approvals. We have direct settlement with MasterCard. We can sponsor other entities into the MasterCard network. So there's that. We're a regulated entity that also has a bunch of on-chain protocols. So I was the person who invented on-chain scheme-based payments. So if you want to transact directly out of your Web3 wallet without trusting a third party, no exchange, no bank, not even our company, we were the first in the world to do that, and we came up with that in sort of 2021, just for some context. We also have the ability to support custodial flows. So we look after companies like Binance and KuCoin and BigGet. We provide them with the on-chain tech. We provide them with the APIs, the regulatory licenses, the MasterCard licenses, so that they can issue their cards globally, get up and running in a matter of weeks, have the Apple Pay, the Google Pay, all that kind of stuff, so that their users can spend their crypto how they like.
Right, so there's no small amount of tech and operations that sits between a stash of stablecoins, either custodial or non-custodial, and helps it get to the MasterCard network in a compliant way that will keep the payment card working over time. So let's get into the meat of this, right? So if stablecoins advance the way we all hope they will, if they become the default way money moves, which part of the card network stack changes first? And this is for Christian. Authorization, clearing, settlement, some other word I don't know or understand. Could you help us understand where we're going?
Without going too far, when you tap a card and it says transaction approved, nothing happened. At that point, your bank says, you know, if Steven leaves the country, we will make the retailer whole. If the bank goes under, MasterCard will make the retailer whole. And then clearing and settlement happens, and that very much happens like in the olden days, you know, T+2. So I believe that stable coins will be sort of more potent lifeblood or a more potent engine underneath the MasterCard sort of franchise, because the interoperability or the interaction at the point of sale, that works perfectly, that everybody who uses cards in Apple Pay, Google Pay can speak to that. But everything underneath the hood, that can be optimized, and there will be a lot of positive impacts on risk, collateral, and so on and so forth.
Got it. Okay. And Jerome, to you, what does end-to-end stablecoin acceptance mean in practice? And I guess like help me get in the head of maybe a merchant as well. Like, why do we need card payments still as stablecoins are adopted by users? Like, what are the benefits to a merchant?
Very simply, it eliminates the bank. You know, it's the simplest way to look at it. So for us, the big benefit on using stable coins to settle with MasterCard is we didn't need to have a bank or a fiat account. We didn't have to deal with converting crypto. That actually changes your regulatory approval. Like if you convert crypto, then you need a VASP license. We don't need a VASP license because we basically move USDC from, you know, a user or, you know, entity's wallet to, you know, a settlement wallet. So that's good for us. Historically, if you want to do a co-brand card, airlines being the big example, you needed to have a bank involved, whether they sponsored you into the network or whether they held the funds for settlement. And you can appreciate if you've got millions or tens of millions of settlement going into a bank account from, you know, crypto sources, banks tend to look at that kind of stuff, ask a few questions, and may not be so comfortable with that kind of stuff. So that's a big thing for us, is it eliminates the bank. For the merchant, I think the value proposition is going to come down to getting access to their funds faster. Typically, while we're still using fiat to settle, then you've got to deal with next day settlement from the banking system. So real-time settlement into my account, being able to spend that, is where I think the real value proposition is for merchants. And maybe merchants don't want to deal with banks as well, because it's not that easy to get a merchant facility at all. Actually, it's really, really hard.
Got it. Okay, great. So yeah, sort of what I'm hearing is it'll reduce the cost for everyone in the chain, and also, speed is a cost of its own when it comes to liquidity, right? And so.
And I think it's consumer behavior, because nobody wants to pay. That's a fact, right? And payment never happens in isolation, right? You want to shop online, you want to split a bill, and all of these things. And as the population changes, as a payment network, we need to change. If you're not happening on an iPhone, an Android phone, the next generation is just not going to use you. I have a 16-year-old daughter. She's approaching 16. She never set foot in a bank, but she has very sort of sophisticated financial needs, right? And for her, all of these things are not innovation. They were there when she started interacting with these things. And that's why we need to offer these choices for people to use their assets for safe, simple, secure payments.
Okay, great. Let's switch a little bit. The two-part question, going back to Jerome, right? So a lot of people in this room probably are crypto native, use wallets, and I think would be very comfortable sending money peer-to-peer. You roll the clock forward, why is the end state not, why isn't Ethereum the payment network? Why isn't, just the L1 the payment network? What do we get from a merchant network that doesn't just exist in a instantly settled, peer-to-peer payment?
Yeah, look, so prior to Immersive, I had another company that did transactions on Ethereum and actually on Bitcoin. This is sort of 2017, 18, when L1s were kind of cheap to process payments. Before, what were those things? Was it the kitties? Was it some cats or something?
Crypto kitties, for sure.
Yeah, that's right. And they crashed the network, right? And then next thing you know, the prices went well up. I think there's a couple of things, right? One is if you have your proprietary network, first thing you need to do is deal with the merchants' existing technology. That's their point of sale system that you may want to integrate with, or their payment terminal. So, tech from Verifone or Worldline. Wallet Connect's done a recent announcement. So, on that side of things, whilst the hardware might have it, each bank typically buys that hardware and runs its own proprietary software on top of it. So then you have to do a deal with each of the banks, including commercials, licensing, different banks in different countries. Then you need to deal with each merchant. Then you've got the other side of the coin where the consumers are, where can I use this thing? The merchant's like, how many consumers have you got? And it gets really, really hard to scale. You've got to remember that these payment networks, Visa, MasterCard, Amex, Diners, they started out in the 50s. They've been operating for 7 years. They've got 150 million places that you can accept the payments. So if you look at it from a distribution perspective, you just can't beat the scheme rails. It's a massive moat. They've got the existing agreements in place with merchants. They've got the existing commercial model via interchange. It's definitely the not necessarily easy option, but the one that gives you the most scale, for sure.
And what about features? Features for merchants, features for consumers?
Sorry, let's go again. Apple Pay is the big one, right? So you can do a QR code on a terminal. That's kind of cool, but it's hard to beat tapping your phone or Ring or whatever dongle it is you've got. Apple Pay is probably the best user experience for consumers right now. We'll go no UI, UX in the future, but yeah.
Are chargebacks a feature or a bug?
I would say they're absolutely a feature. And I know there's buyer's remorse chargebacks. And if you abuse them as a consumer, the bank will find a way to make you feel that you shouldn't do that. But I genuinely believe that the ability to make a transaction and then something goes wrong, and that doesn't have to be by malicious intent, right? The ability to call someone and say, I want my money back, that is very powerful. So if you ran a web shop somewhere in, I don't know, in Portugal, and I live in Poland, would I make a real-time wire transfer or wallet-to-wallet transaction and hope that you sent me the merchandise, or would I use a card that is funded by USDC, EURC, whatever. And then if something goes wrong, I basically call up the issuer and say, this didn't work. And I know chargebacks, it's not suitable for this discussion, that there's some people have feelings about chargebacks. I think they are a mechanism to reverse transactions if everybody agrees to it. That's important, right? I can't do it unilaterally. So absolutely a feature.
Yeah, great. I think there's a lot of institutional knowledge that crypto tries to reinvent, and sometimes there's reasons things are the way they are. So switching gears a little bit, I don't know how many people in this room are from the U.S. and live in the U.S. Just quick raise of hands. Okay, and then flip. Anyone from outside the U.S. live outside the U.S.? Okay, pretty good. I think this event is over Chinese New Year's this year, so I think it's like far less geographically diverse than it has been in past years. I think what might be interesting for the largely U.S.-based audience is to talk a bit about different geos and the pace of adoption, right? I think from my vantage point, it is amazing how quickly stablecoin payments are being adopted over the MasterCard rails in other countries. And we just previously had an interesting discussion about some other partners and competitors. You're talking about their growth. So I'm curious, Christian, where are you seeing growth? Why do you think it's happening in those markets? How do you roll it forward? What do you forecast?
So I think at this point, there's two different user groups. There are crypto-rich people in the Western world, and they might be residing elsewhere that just want to spend their crypto. That is something that we see. But then there's people in what I would summarize as the global south, where you have a financial services ecosystem that does not allow you to build up capital stock, that does not allow you to hold FX, that does not allow you to escape an inflationary environment. So think about some places in Latam, Turkey, and so on and so forth. So people there, the ability to hold US dollar denominated assets in a self-custodial environment, that has really value beyond, I do an on-chain transaction. So we see both, and I think we will continue to see both, and there's new use cases emerging.
Okay, great. And maybe Jerome, you also touch more countries than I can name with your product. Can you maybe talk about some of the countries you support and what's interesting about supporting some of the further afield ones? Also, where are you from, for the audience?
I'm from New Zealand. So, to give you some context, US versus other markets. Last week, we launched Binance Card in Armenia, Kazakhstan, and Mexico. We can do that because we've got those regulatory licenses, the direct relationship with MasterCard, and it's essentially a turnkey solution. The US, however, in order to issue cards, you still need a bank involved. US is one of the last and very few countries where a bank needs to be involved because the current legislation in the US requires that there's FDIC for cards being issued. This notion of decentralized self-sovereign cards where I'm not a custodian of the user's funds is not something that the regulators or the system is aware of here. So for that reason, they want card issuers to have FDIC approval. To have FDIC, you need to be a registered bank. So naturally, to launch into the US, it's months, if not years, millions, not hundreds of thousands. So
what does that do for the quality of the product in the US? I'm curious, how much better is the product overseas versus in the US because of that regulatory hurdle?
I have an anecdotal data point. I wanted to pay, or actually I did pay my coffee at Starbucks with Apple Pay today, and the very nice lady behind the cashier, she forced me to sign the receipt because that is how it's supposed to be done, right? And that gives you a bit of a feeling of, I think, I don't want to talk bad about someone, but I feel that in many aspects, the digital asset ecosystem outside the US, we've seen traction before, but with Genius and Clarity coming into play, we believe that we will see more traction. We see very interesting programs in the US.
Okay, fantastic. Yeah, I think if I were to sum it up, there's also just a lot more people holding and transacting in stablecoins as their primary store of wealth overseas, and that leads to people wanting to spend in that. It's truly global. Okay, so let's talk about positioning a bit. I bet many people in the audience have heard of some massive fundraisers in this space. There's a company called Rain that I think became a fast unicorn over the last 12 months. Anyway, Jerome, I'm curious how you position yourself against other folks in this ecosystem.
Yeah, look, first thing I would say is I can count on my hand how many players there are in this space that have the full stack offering, like an Immersive, like a Rain, like a Motivate. We all talk to each other. We all support each other. You know, the pie is big enough that we can all share it, and there's enough to go around. So for the most part, we give each other high fives as opposed to anything else. And you know, they've done a great job on the capital raising front. For us, where we kind of focus and position ourselves is, you know, very much in the enterprise place, right? So when you're dealing with global partners, you know, like the Binances and the BitGets, and they want to know that you've got the regulatory approvals to operate in each of the markets. So I've got well over 30 law firms on my books right now as we scale globally and enable these markets like Kazakhstan and Tajikistan and Uzbekistan and Taiwan and you know all sorts. So that's a big thing for us, is have this global platform with local compliance. The other thing for us is around, you know, we're the inventors of the self-custodial on-chain payment flows. So we've got a lot of expertise in that area. We've got a really rich protocol.
Just to be clear what that is, can you explain that in simpler terms? Like coming from a wallet, like a self-owned wallet, not an exchange account, and being able to pay directly to a card, right? That's what you're describing?
Yeah, exactly. So, I mean, if there's technical people in the room, our protocol supports a couple of things, right? So if you want to transact on things like Ethereum, it's too slow, too expensive to do a real-time ERC approval per transaction. You know, too many of the transactions would decline or run the risk of double spend, or you'd pay more for your coffee and gas fees potentially. So our protocol supports the ability for users on those chains to deposit funds into it. On chains like Arbitrum, Base, Polygon, we can do a real-time ERC20 approval, which is like a debit card. You have your funds inside your wallet, you're the custodian of that, obviously with your private keys. You tap your Apple, Google Pay, and funds in real time are debited on chain.
Okay, very cool and helpful. Okay, so let's wrap it up with one final question to both of you. I'll let either of you jump to it. There's a very close partnership between your two organizations, right? I think it's very clear what the go-to-market is now. It's you know, consumer payment cards. You know, what else are you excited about working on? Like, take us further out on the horizon for stablecoin payments.
So I think on the consumer card, Web3 crypto still, I think, needs to optimize the user experience, because people that, you know, come to these events, they're very excited about, oh, it's an on-chain transaction, so on and so forth. But if you want to make this a mainstream proposition, the normal person out there, they don't care how they pay. So basically, you need to be on par where, you know, we used Apple Pay as a reference a lot today, where Apple Pay and Google Pay are. And I think and then you need to have all the assets that people can spend. So and that is still a journey in itself. And I don't think it's particularly exciting. It's a lot of sort of boring groundwork, optimizing, but it's very, very important. And then I think the intersection of agentic commerce, you know, combined with the ability of stable coins.
What does agentic commerce mean to you?
Agentic commerce can mean a lot of things to different people. So the way I use it is if agents talk to one another and pay one another, because that's where you have, you know, high frequency, low transaction volumes, and where the programmability, the unit economics, all of the things that stablecoin can help, you know, push forward. I think that's going to be very exciting.
Great, Jerome.
Yeah, I reckon this year will be the year for DeFi cards. We still don't really have a fully decentralized DeFi card out there. I think if you look at people...
Define a DeFi card.
So where funds are inside either, you know, the protocol that you have full control over, but where you essentially collateralize against your assets. So in places like the UK, you got 24% capital gains tax when you convert your crypto into a stable to spend. So what people want to do, there's a couple of things. One, they think the value of the crypto is going to go up, so they don't want to sell it. Next, they want to leverage it. So by having a DeFi credit card, think of it like your Amex or your MasterCard credit card. They're going to want to be able to access, you know, not access, they want to be able to leverage their Bitcoin or Ethereum, get a line of credit up to a certain amount, spend that and pay it off at the end of the month without having to actually swap or sell or spend their crypto. So this year for me will be definitely, yeah, DeFi cards.
Yeah, I'm really excited about the initiatives you're pushing on that front. Well, cool, everyone. We are at time, so let's give a big hand to our guests and thank them for the education on the future of stablecoin payments. And you guys can... Hey, cheers, thanks. All right. Well, that was awesome. I love what those guys are doing. It's just really great to see payment volume in crypto. Next up, we have my good friend, Juan Bruce, the founder and CEO of SuperNet. So we're gonna switch gears into AI here, and Juan is leading the way. All right, I'll leave it to him.
All right. Let's see if we can get the slides up here. We ready to go, everybody? Going forward into it. That's not the right thing. That's the video. Let's get the slides. All right. And back to the slides, please. All right, here we go. So I'm Juan Bruce, co-founder and CEO of SuperNet, where we're building portable AI context memory, or another way to think about it, the data rails for agentic commerce. But before we get started, I'll give you a little bit of context on why I'm doing this. So I've been involved in crypto since 2016. Also went to Stanford 3X, so big supporter of what's going on here. But I built in media tech, social, and ad tech prior to coming to crypto, and dealt with some really kind of important and nuanced issues around user data that we're thinking a lot about today when we talk about AI data and context data. So for those that don't know, I'm trying to get slide forward. And this is unresponsive, so maybe somebody in the back want to, there we go. First, it's important to understand what context is. In an AI sense, it's the rich user data, the preferences, and prior interactions that enable AI systems to interpret inputs and accurately generate relevant and personalized outputs. And this is becoming really important in AI systems. Slide forward, people. There we go. It's key to both the consumer AI experience as well as the commerce AI experience. So essentially what's happening now in AI is that models are commoditizing. And what that means is that the context data that a user brings to a model is becoming more important in quality outputs. And I think those of you that have tried OpenClaw recently have seen this, right? OpenClaw can be powered by any model, but it's really the OpenClaw as a framework that's bringing you different results than just using those models directly. On the commerce side, over 95% of AI users are using AI to pre-shop. That means there's an incredible amount of rich buyer intent that is available in this data. So when e-commerce companies or the SaaS stack that makes up commerce thinks about what agentic commerce is going to be, it doesn't just need composable identity and payments. It needs a composable data rail and context to go with it. And so let's dive into some of these problems. If we look at the consumer side, one of the biggest problems is that context memory is siloed. If you use ChatGPT, it gets to know you, you then try to switch to Claude or DeepSeek, you have to start all over again. And this is a massive problem because unlike a lot of us in the room who probably pay for an AI subscription, 95% of the population that's using AI doesn't. And so that means that over 58% of AI users are using multiple AIs because they run out of tokens on a daily basis. And so their context is very fragmented and they're always having to repeat themselves. If you run test ads on Google about repeating yourself in AI, you end up with extremely high CTRs of like 9 to 12%. There's also a total lack of privacy. And this data that we're putting in these systems is going to be monetized without our involvement unless we do something about it. And this is causing lock-in to apps, so it's hard to move. On the commerce side, there's some similar but kind of different problems. So the silos are also a huge issue. All these e-commerce companies want to get this data. The stack for commerce and for publishers would love to have this data. The people that, the SaaS that merchandises products, that does content management, even like Stripe doing checkout rails, it's all starting to use AI to better personalize and drive conversions. But they can't get this data that's rich in purchase intent to understand the user because it's stuck in Google, Facebook, Twitter, OpenAI, Anthropic, and they're never going to give it up because they're going to use it to support their own ad businesses, just like Google has in the past with previous generations of data. Now, an additional problem, even within the stack of a commerce company, is that the different parts of the stack aren't communicating their context. So they're getting AI, they're collecting user data, but then you may have, the merchandising engine realizing that here's a buyer that likes to buy things cheap on sale, they're selecting for lowest price, and then they go to a checkout and Stripe has no idea. even though they have their own AI and context engine that's trying to figure out a user and give them the right options for checkout. So you don't have interoperability or portability. And then on top of that, you have the regulations and data privacy, right? So in the US, traditionally, there's been these things called clean rooms that everybody in e-commerce hates that try and reconcile different databases. In Europe, they don't even really work because of GDPR. And so with the coming of agentic commerce, this is even more difficult because you're not talking about a standard database. You're talking about RAG memory, which is a combination of compute and the data, because it's having to vectorize, create semantic relationships, and then run search on top of this data. So there's an additional problem for enterprise. And that's within companies. They've spent a lot of money building these bespoke chat applications with their own proprietary data. And surprise, their employees aren't using them. That's because the consumer applications are getting better faster than these bespoke applications. And so there's no way to enforce guardrails to make sure their employees are all getting all the corporate data in there. And so this is kind of a third huge problem. And so what do we do about all of this? Well, there are a couple of use cases that we're focused on. We've talked about some of these. So AI chat portability, enabling users to go across different AI chat applications, bring all their data with them. Enterprise context for employees, so allowing employees to use any consumer AI or Copilot or even OpenClaw and bring their data and bring the company data and the guardrails. Multi-agent workflows, so being able to lend out your data and have it ZK questioned by agents in an appropriate way. And then, of course, marketing and advertising and e-commerce where they want the data. To support all of this, what SuperNet has done is build a secure, portable AI context layer that's on-chain. And we've done this at two levels. First, at the application level, we have reference apps which collect and invisibly inject the data back into any AI application that you're using. This is all built on top of a data management SDK, which allows any other application, or it could be a Web3 wallet, it could be a browser extension like Honey, to plug in and do the same type of data management. Whoops, didn't want to go forward yet. And then we have a data access SDK. So if you're an e-commerce company, you're a marketing company, you're ad tech, you can actually put out bounties to buy this data or to question a user's data in a responsible way. This is all built on top of an on-chain RAG memory layer. So as we said before, for AI to use data appropriately and efficiently, it needs to be vectorized, it needs to be searchable just as a RAG memory layer. And so over the last year, we built this all on chain. We have a complete secure pipeline. We've also have the new paradigm of data access transactions so that validators can get paid for unlocking this data. It can be composable with transactions. And we have forkless upgradability so that we can add the latest RAG memory algorithms and even things like inference in the future. So that's a lot about theoretically how this works, but let's actually show you a demo. So guys, if you want to go ahead and roll the video, and we'll show you what one of these applications looks like. So here we are in ChatGPT, and we're going to go into incognito version of this. And okay, it looks like we're slightly lagged there. Put it in temporary chat mode. And now we're going to look, there's a browser extension that is running our SuperMem application, and it has a bit of data which is proprietary to SuperNet. It's that chain ID. And so the first thing that we're going to do is we're going to turn off the browser extension, and we're going to ask about that ID and see what ChatGPT says. And because it doesn't know, it's going to give a very generic answer of like what it could be. So we'll see here. It's taking its best guess, but it's not right. Now we're going to go turn on the SuperMem application, and we're going to put the same question in and ask what the network ID is. and immediately it's able to answer it. Now, the next step is we're going to look at how this can go across platforms. So we've got Grok. We're again in a private mode. And what we're going to do is we're going to give Grok a nonsense word, and we're going to define it. So let's see. Oops. Did we not? Did we stop the video? Okay. There. Yeah, so a tremotlin is a blurb. Okay. Nonsense. And now we're going to go back across to ChatGPT, and we're going to ask about that nonsense word that ChatGPT couldn't possibly know about. And as you can see, ChatGPT now knows it's a blurb. So we're going across these platforms, and we can stop the video now. There's some more demo, but we're good on time. So if you guys just want to roll to the final slide. So you can kind of see a brief glimpse of what you can do when you can take memory across systems. Yeah, keep going to there. And so, nope, all right. So yeah, that's SuperNet, and our SuperMem applications are coming soon. If you want to follow me, I'm over there. If you want to follow SuperNet for what's coming out, we've got the QR there. And if you want a special surprise, we put OpenClaw in the cloud and put memory around it, which those of you who have used OpenClaw know that it has some memory issues. So you can scan that, and in about 2 days, you'll be able to use that. All right, thanks, everybody.
All right, thank you, Juan. It's an exciting, memory-laden future. So next up, we have a wonderful panel. The topic of the panel is going to be enterprise-grade developer infrastructure, right? Like, the institutions are coming. I hope we're ready. Let's build the right infra. emceeing that panel will be Baek Kim, a general partner at Hash, and I won't front-run him on the rest of the intros, though you can read them on the board. Although, actually, we did have a... Anyway, Baek Kim will... work.
You guys sit in the middle. Cool. Yeah, all right, thank you so much. Ronita and Griffin, thank you for joining me. I'm quite excited to moderate this panel because I'm an investor in Holiday, but also was a client of Alchemy, utilizing their stack inside our fund data operations. I think these two companies are one of the good example of a hidden champion that's empowering massive crypto industry behind the scene and been pivoting and offering new products through the cycles as a resilient offering product platform that you guys have become one of the giant market share holders in each of the segment. Why don't you guys give a quick intro about yourself, but also how the product positions within the industry today?
Hi, I'm Griffin. I'm the founder and CEO of Halliday. My background is actually computer systems at Stanford. I did research on embedded operating systems and cryptography during my time. I founded Halliday back in April 2022, and so we've been through a few market cycles now, and I look forward to the next one, given the sentiment online. But you can think of Halliday as Plaid, but for unified crypto deposits. We combine global on and off ramps, centralized exchange connectivity, and cross-chain routing into a single API or user experience to maximize deposit conversion at the point of deposit. That button you see a plus in an application, there's a good chance we may be powering that behind the scenes.
Cool. I'll go next. How's this audio? Good?
Yeah.
Okay. I'm not Guillaume. We had a last-minute switcheroo. Guillaume's our CTO, but I'll be filling in for him. He's stuck on a flight. My name is Romit. I lead enterprise sales here at Alchemy. Been with Alchemy for 4 years. To give you a little bit of background on who we are, so Alchemy is the leading blockchain development platform in Web3 and for Web2 institutions. So what we're really doing is we're helping developers to more easily access blockchain data, both through raw level core RPCs and some of our higher level abstractions, to really help them build better applications and more seamless user experiences. And then we also help consumers both in the Web3 and in the Web2 world, just to give them a more familiar experience when interacting with blockchain or with crypto. So to answer your question in terms of where do we sit, we work with all the major applications that you know of today. So in the Web3 digital native world, we power everyone from Coinbase, Robinhood, Uniswap, Polymarket. And in the institutional side, we power everyone from JP Morgan, Fidelity, and Visa. We're typically one of their first stops because when they're building in a testing or a DevNet type environment, folks will want to actually access blockchain data. So that's like smart contracts, state data, understanding transactions. So we're typically one of the very first partners that they onboard. And then consumers also interact with our platform when they're actually creating an account on the front end of an application, because they want a really easy way to both sign in and sign for transactions without having to use your typical EOA experience. So although we're one of the first stops folks make, we really think of ourselves as an early build-out partner, because as developers start to mature and go up the stack, they typically need more advanced abstractions or higher level APIs to both understand and transform data at scale. And obviously, as you build across more chains, those data problems, those scaling problems, they magnify, and especially with the rise of agentic commerce, which we'll talk about. So although we're one of developers' first stops, again, we typically work with developers throughout their life cycle as they move from testing environments all the way through production and through scale.
Awesome. And I think it's actually great that you have joined our panel because when I was networking outside this room, I met mostly engineers and founders here, not many salespeople. You were the first sales hire for Alchemy, which I think is very important for crypto industry to grow and also be sustainable. I'm curious about the early days of Alchemy on how you guys are evolving to find the initial PMF and how you guys scale beyond that.
Yeah, it's a great question. For those that are on the BD go-to-market side, I think you'll realize that Web3 sales, or really that word, it's really in its infancy. And I think that we're just starting to see really, really proficient and compelling BD teams evolve in the Web3 side. So to give a little bit of history, so Alchemy's been around for 8 years now. Prior to myself joining, it was all founder-led, product-led growth, which is fantastic. We started off our free tier, I want to say 5 years ago. That was giving developers their first, call it, million API requests free to access. Back in the day, that was just really Ethereum and a few core blockchains. And we found ourselves needing to solve for two things. First off, as many modern applications are doing today, everyone wants to scale across what's the next hottest chain. There's L1s, L2s, L3s. There's institutional and Web3 native blockchains. So the first problem we wanted to solve for is how do we effectively scale across many blockchains? And then how do we give developers a really performant, low latency, high availability environment? Because they want to provide their consumers continuous access to their application, and we're one of their key backend providers. We're also at the mercy of many of these blockchains, as you know, and we partner very closely with them. But for especially like a DeFi or a stablecoin type application, those types of apps are specifically building across 20, 50, 100 plus blockchains. And for folks that build at that scale, you'll notice beyond like the top 10, top 15 most transacted blockchains, many of the longer tail or newer chains, they suffer from kind of like continuous consistency problems or nodes going offline or regions going offline. So what our early days looked like was figuring out, well, what does reliability look like at scale? If we want to be the premier API solution, that really means modeling what Amazon, GCP, and Azure do for Web 2. And that means minutes or even seconds of downtimes per year. That's all we're really allowed to become a trusted partner. So it was both solving for scale, solving for the amount of chains that we have to service, and then ultimately understanding like, what does the consumer workflow look like? How do consumers want to interact with applications? Do they even understand what crypto and blockchain is, or they simply want to take advantage of what the app has to offer? So building really familiar experiences for them. I always relate where account abstraction is today, which is another concept we can talk about. Everyone in this room is probably familiar with how to use Venmo. You simply select a username, you send them money. You don't have to think about signing away or worry about signing away your private keys accidentally or signing for transactions or interact with protocols. So a lot of what Web3 and a lot of folks in this room are trying to do is bring the more common modern Web 2 experience to a very complicated world, but knowing that blockchain can ultimately unlock a much more seamless, instantaneous payment layer for what we've been trying to build for many years.
That's awesome. Griffin, for Holiday, you guys initially started as a buy now, pay later protocol when we first met. Obviously, through the cycles, you guys were actively looking for PMF and really pivoting to current product. And you basically pivoted your role also going from computer scientist to founder salesperson. How did you navigate that journey, finding the new PMF with the new market condition, new demand from enterprise clients?
Totally. And so for context, Halliday started out as a paying for financing product for digital assets. So think of it as Afterpay or Klarna, but for NFTs. And the idea behind a lending product like this is that it's a conversion maximization tool, right? In e-commerce, if you can increase conversion by 15%, that's a lot of revenue for a customer. The problem in blockchain was that there were no customers in the first place. People couldn't buy their first asset at all, so the market didn't really want a lending product. But what was interesting about when we were building the product, we spent 95% of our engineering time on an adjacent problem, which was how do we orchestrate and manage funds across 10, 15, 20, 30 blockchains. And when we saw that, and it's usually a good sign, like if you're a company and you're spending 99% of your time not doing the thing you want to do, but solving another problem, there's a chance that's valuable to other people. And we actually went to one of our early customers, DeFi Kingdoms. And we said, hey, we have this orchestration technology. Do you have other problems? And they said, we do actually. The deposit experience is really difficult for a user. It takes 45 minutes to get to our subnet. And for context, the deposit to a crypto application is the first action of consequence and perhaps one of the most important actions of consequence because that's the potential energy of your platform. You can't trade what you haven't deposited. And if your conversion rate through your deposit funnel is 2%, 5%, which it is in many cases, you're leaving 95% of your revenue on the table. And so we solved that problem using our core infrastructure. And then overnight, our deal funnel exploded. And now the problem has been, how do we build to meet the demand? It hasn't really been the flip. And sort of now building out a sales organization and going to market.
Thank you. From listening about both of the companies, you guys are quite versatile and they cover quite wide range of area within crypto. Is there certain things that are kind of out of boundary for you guys that you guys wouldn't touch, or a lot of people confused that you guys do certain things that you guys actually don't focus on?
Yeah, I'm happy to go first. So we started off as a developer tooling platform, and there's a lot of different areas that we could have gone with this. And I think it's very strategic over the years to figure out where we want to invest and double down versus where do we owe it to our original customers to really give them a reliable experience. So a little bit of history on Alchemy. We raised $560 million total across all of our funding rounds back, and that concluded back in 2022. That gave us enormous flexibility in both product acquisitions and where we built. But we had to be strategic in terms of, well, what do we want to scale? So a little bit around both where we built today. So I'd mentioned both our core level APIs, our abstractions, also powering many different rollups and consumer experiences on the wallet side. We've had to start and stop different initiatives. And that can be on the indexing side. That can be in folks like figuring out how to do more robust data transformations. There's a lot of amazing tools out there that we actually still power from a core level. There's our friends over at Allium, at Ponder, at Envio. There's a lot of different really cool tools out there that focused on these really low latency, flexible pipelines for transforming data. And why I mentioned those specifically is we've had to figure out, well, do we want to double down in that space or not? What we do still offer in those areas are many of our abstractions and data level APIs. So think of like if you're using anyone from Phantom to Rainbow to Coinbase to Robinhood's wallet, you'll see APIs like our token and NFT API that's populating a lot of the front end data. And that's still a lot of work. We still have to read many blockchains, many blocks consistently and make sure that we're giving users the most accurate, up-to-date information. But to your question, where we've had to pull back a little bit is, do we want to offer a fully unstructured raw data pipeline layer? And that's a difficult problem to solve. And there's really good companies that do it today. But I think that's what I really pride our leadership on, is figuring out, well, we either can go in that area, solving for a tool that I think is being solved for very well by some of our partners, or we can choose to double down on our core layer, which we call Cortex, because it really is like an AI intelligent blockchain accessibility layer. And what we did in the past year was really figure out how do we deploy across regions to have like multi-region redundancy, but to also have like sub-millisecond latency, because that's where the industry is going. That's what institutions need. That's what DeFi needs. That's what many of the darlings of the last year, from like a Hyperliquid, Aster, and Lighter, that's what they need. So we've chosen to strategically pull back from certain areas that developers would need. We still want to serve developers in as broad a way as possible, but we need to make sure that what we do provide is best in class before spreading, our surface area too broad.
I have a similar answer, and I'll answer it by walking through a deposit and sort of where we fit in and what the constituency and the sort of upstream components are. If you're doing a deposit to, let's say, an L2 perp DEX or an L2 exchange or a trading app, maybe I'll start with my funds in Binance, I'll withdraw from Binance, and I'll go to an L2. You'll hit a DEX, a bridge, and then a deposit contract. We orchestrate all those individual interactions into a cohesive and reliable flow. We're not the exchange at the source. We're not the chartered bank issuing your fiat. We're the interstitial and orchestration layer that makes it all work together reliably. And it's one of those things where as you build a system like this at scale and the customers ask for more and more features, it became very clear that that core orchestration problem was actually extremely challenging. And so trying to build a DEX, trying to build a bridge, or trying to build a chartered bank, to us was largely, that would be a distraction, and it would dilute our focus, because it's very different to build a deposit product with 90% reliability versus 99% reliability versus 99.999. And when you think about a deposit, you have people who are depositing $32 million into exchanges. 0.1% failure rate with hundreds of millions in deposits is unacceptable. And so that long tail of edge cases is actually where the vast majority of the work and the mass majority of the value is. It's almost, if you see like container orchestration products like Kubernetes or ECS, that is their value too in the cloud. And so we think about it that way.
Yeah, definitely agree with both of you. Building out new offering is great in crypto, but keeping that SLA and also the compliance aspect is really differentiating I think the winners that build the moat versus being just fast to the market. You guys have stellar list of customers. What are some of the fastest growing customer segments today that you expect to kind of continue growing in 26?
Want me to start? Yeah. Yeah, I think from even a year ago, my answer hasn't changed. On the Web3 side, still think DeFi is our fastest growing vertical, and that should come as no surprise to anyone. If you look at just like who is processing the most amount of transactions, most amount of volume, who is pushing a lot of the innovation in the space. Again, I'd mentioned the folks at Hyperliquid and Aster and so on, but when we think about like many of the things that we want to provide to our developers come from customer feedback. And a lot of the things that I mentioned in terms of low latency, high availability, multi-region environments came from our DeFi customers wanting to provide more and more flexibility to not just human traders, but also autonomous agentic traders as well. So DeFi on the Web3 side continues to be our fastest growing and our most mature vertical. On the what we call Web 2, and I'm making that differentiation just for folks in the room because they understand that, is not just on the institutional side. I do think that banks are growing very quickly and their use cases are very exciting, but as folks know that building in regulated environments and regulated industries, there's a lot of hurdles to jump through. So it's what I call this Web 2.5 layer, and it's specifically digital native companies that are getting their very first bank charters or are starting to offer traditional consumers access to crypto products. So that's like companies you may be familiar with, like a SoFi and a Ramp, but also some of the newer entrants in the market. You may be familiar with these names from a Slash, a Neural, a Flutterwave. If you're not familiar with them, look them up. I think they're doing a lot of great things with being able to offer everyday consumers. You may see them like run ads in traditional media, but they're giving everyday consumers access to stablecoins, ability to earn yield in different DeFi environments using fiat. And I think it's a very exciting place to be because those folks They operate like a tech startup. They want to move quickly, but they're taking on the big banks, and they have a lot more agility, and that's been a very exciting vertical for us to service.
Yeah, we've seen too that DeFi has been pushing the boundaries of the technology the most. I think the success of perp dexes, the new chains, those new protocols, leverage trading, yield protocols, are definitely, they're sort of like the high performance gaming of crypto. If protocols or graphics cards, that's what's pushing the gamut on the technology from what we've seen. And the interesting property and why it stresses systems is, at least in the deposit context, you'll have a lot of users go in and do $1,000 deposit, a $10,000 deposit, but the same product, the same infrastructure needs to handle your neighborhood hedge fund going in and doing a $100 million deposit. And that happens on the same rails. USDC is settling agentic transactions that are, 1/1000th of a dollar and hundreds of millions of dollar settlement orders. And you have to be able to do that. And the only places where you're seeing that amount of volume and performance requirement is in DeFi right now. That's growing extremely quickly.
Got it. I guess being based in San Francisco, we hear a lot about AI. I don't think we talk that much about AI today at best. How is AI impacting your internal architecture, or how you guys work with the client going forward? I've noticed that even Circle USDC is opening open cloud hackathons. So a lot of the crypto side of businesses are also looking into AI and reinventing the architecture to fit the demand. I'm curious how you guys are adapting to that and see what opportunities ahead as a company.
Yeah, I guess from our perspective, it hasn't changed our product a lot. I think the first thing we're doing, especially being in San Francisco, is trying to re-architect and transform our business operations, right? The value of AI is it's opening the gamut of what a computer can do, right? So there's a long tail of just annoying BPO work, that stuff we're automating today, and then we're looking across the stack, of course, doing engineering work more efficiently. We're still extremely focused on that deposit experience, but when it comes to actually operating a company and being in Silicon Valley, I still think it's great to be in San Francisco because you get exposure to the latest and greatest technology to make your company faster. But yeah, we're not an AI company.
Yeah, I'll weigh in. It's been tremendously exciting. I think a lot of folks can speak to this, that what we've seen in the past just 90 days, ever since both Claude Code and Cowork have come to the forefront, and all the various frontier models and how they've evolved, it's changed the game, both internally and externally for us. So internally, kind of a number of different areas, right? We work with a number of different blockchains. We also power a lot of the major security protocols from like a Blockade, Hypernative, and so on. One of the cool ways that they use AI that we help to inform the different developers and consumers that use our API, because there's also a lot of observability around figuring out who is actually accessing our API. Being able to use AI for fraud detection and understanding like when there's different vector attacks from coordinated wallets has been very interesting, and when there's a potential for a reorg or a chain to potentially even halt production of new blocks has been very interesting on the security side. For the development side, again, if anyone's ever built using core level APIs to access contract or state data, a lot of different ways to do it. You have different ways to read logs, transaction receipts. You have a lot of different opinionated APIs from both Alchemy and competing services. And you have some of the unstructured data pipelines from our partners that we spoke about. A lot of different ways to get the same data depending on what you care about and who you partner with. So using agents or using agentic workflows to work backwards from your ideal development experience and consumer experience has really sped up that innovation and development cycle. We charge based on API requests and compute. So we also want to help our developers to optimize how they leverage our services. We want to help them save money. We want to help them do it in a scalable way. So AI optimization for development has been incredible on that side. It's also gone as far as like for many of our engineers internally, I think a lot of folks are doing this, so it's not novel, but be able to figure out how to both squash bugs, automatically suggest and push PR requests to GitHub on our back end. Our engineers' productivity and efficiency has gone up by a multitude. The last thing I'll mention, which I'm talking about more at tomorrow's keynote, is on the consumer side and really solving for like, if we think, we process again millions or trillions of API requests per year today, we do think that agent compute is going to 10x human compute, not even in the next few years, we think potentially in the next 12 to 24 months. So how to build both a blockchain readable interface for agents, allow them to transact differently than humans without the same KYC verifications that humans need, but also allow them to scale up throughput and concurrent requests in a way that allows them to operate on behalf of humans, but with the necessary supervision and controls via account abstraction and some of those permissioned and controlled environments. Those are like 4 distinct areas that AI has like truly impacted our business and the way we're operating on a go-to-market side to solve for like an agentic-led world from an API standpoint.
Got it. Fully agreed. Thank you so much, Romit and Griffin, for joining us for the enterprise-grade developer platform panel, and thank you all for joining us at the BAS today. Yeah.
Cool. Thank you.
Thank you.
Hey-o.
I'll take each mic. Thank you. Thank you, coming up.
Good job, guys. Well done. Excellent. Thank you, gift her. All right. Excellent, excellent, excellent. So next up, I'm not going to front run the intros. That's not my thing, but I will introduce Brian Breslow, one of my favorite investors who works at No Limit Holdings, which is a close partner of ours. And he's just a great, sharp VC, and he's going to introduce and moderate this panel. Come on up.
Thanks, Stephen. Hey, everyone. Thanks for being here today. It's my pleasure to help moderate this fireside between Alex from Near Intense and Salman from Chain Opera AI. So please, everyone, give them a hand, and I'll let them introduce themselves.
Hey guys, I'm Alex Shevchenko. I'm GM at Near Intense, taking care of the Near Intense infrastructure, previously co-founder of Aurora, the EVM network on top of Near. As you can see, I'm kind of stuck with Near ecosystem. There is a reason for it. Yeah, in blockchain for 10 years, happy to talk all things very deep technical cross-chain infra.
Hey everyone, I'm Salman Avestimir. I'm professor at USC, directing USC Amazon Center on Trustworthy AI. I'm also co-founder of 2 companies. One is Tensor Opera AI, that's a Web2 AI company, and Chain Opera AI, that is the blockchain AI company, building a decentralized infrastructure for AI. So generally speaking, I work in the domains of AI and blockchain, and I think that's the topic we are going to be discussing today.
Yeah, it's interesting. I feel like with Intense in general, like that topic, maybe we should just define for the audience. I feel like maybe it is slightly different for you, Alex, working on a lot of cross-chain swaps, and you, Solomon, where AI is becoming a little bit less deterministic, and you're just basically asking it to do things and hoping it fulfills it. So it's both are intense, however, maybe slightly different meanings, and of course there's some crossover as well. So I think that's probably a good place to start as we dip our toes into this fireside.
Yeah, sure. So for everybody, the Intense, the way how I'm thinking of it is the type of the architecture that developers are using in order to build their products. And the core idea of it is that the user wants some kind of outcome, and he doesn't need to know about how this outcome is achieved. And the system needs to guarantee this outcome. Now, the most simple way how to think about it is with application to the use case of the swapping. So the user doesn't need to think which pools to pick, how to route the swap, or how to split the swap into different pieces, while there are some other participants in the market who are figuring it out for the user and doing it pretty efficiently, while the user just wants to sell Bitcoin and get some SOL, and that's what he achieves.
And Solomon, I guess for you, what does it mean to you and for Chain Opera?
You mean more generally the intersection of blockchain AI and how we operate there. So as I mentioned, we build a decentralized infra for AI. Maybe I put it in a context. There are 2 ways you can build infrastructure for AI. One of them, I call it the bottom up. For example, think about Amazon AWS. That's the infrastructure for AI. What it does is it provides compute, it provides platform for people to build and launch their AI, whatever it is. You can do it in the decentralized blockchain space, and many other companies who have done that. For example, at the compute, there is Aether, Akash, etc. There is model layer, so on and so forth. There is another way that you can build AI infra. That's, I call it the app-driven infra building. For example, if you think about OpenAI, right? They, of course, have a great infrastructure, but everything is built to serve ChatGPT. That's where their infrastructure is just driven to make one app scalable, high performance, etc. That's the route that we are taking at Chain Opera. Okay, so in Chain Opera, we have our own, we call it decentralized ChatGPT. It's called AI Terminal, which is composed of decentralized agents, and the infrastructure behind it, which is the model layer, that's going to be the compute layer, data layer, all decentralized to make this app the most popular app in the Web3 AI space. The advantage of this route is you are driven by a very clear demand and traffic. And I think that has been maybe something that caused a bit of maybe frustration in the Web3 AI space as people build infra, because that infra may not bring in the much needed demand compared to, let's say, a Web2 or centralized way of building infra. So that's how we define our app-driven infrastructure building.
Got it. I think that makes sense. To you, Alex, like, I feel like Near has roared back into the lexicon of a lot of people in crypto with the success and growing popularity of Near Intense. Obviously, like, initial interest in privacy and Zcash, I think, drove a lot of that, but maybe now it's primed to grow even more as agentic transactions grow as well. So just out of curiosity, like, is this also, like, do you also view AI and agentic transactions as like a pillar of Near Intense going forward? Or maybe you don't, would love to hear your thoughts.
Yeah, definitely. Near actually started as an AI startup and was founded by Ilya, one of the co-authors of Attention is All You Need. At around 2017, what the founders decided to do is actually to pivot from AI towards the blockchain, because what they were trying to do is the human reinforcement learning of the models that are specifically focused on writing code. And back in 2017, there was not enough. They didn't have enough resources for this, so they needed to have humans who would mark the data and gonna get more out of this out of the process. So, and they needed to have a payment solution for the people. That's why they decided they need to build a blockchain. And currently, Near is standing on two legs. One is the cross-chain infrastructure, as well as the financial backbone for the decentralized world, and this is the Near Intense. Near Intense is much more than just cross-chain swaps. There are earning products inside of it. There are more and more things that are going to be released this and the next week. So stay tuned for the updates. But also there is a second leg of Near, which is fully focused on AI. And there are tons of discussions and debates how to make sure that the agents are having this financial layer, because we now have this. In my mind, it's like the centralized AI providers, they are moving from the use cases of building foundational models and then some products on top of it that can deliver these models in the hands of users. But all of them are thinking about building the economical and financial layer behind it. OpenAI is actively saying that they're going to build it. Anthropic is blocking all of the financial transactions, and they are restricting it. And there is a reason why they are doing, because they want to build their own too. And then there are big financial players are entering blockchain space, because you cannot KYC the agent. So you need to have not an ordinary financial Web2 rails for them. You need to have something else. That's why Visa and PayPal are entering the crypto space. So, and we are trying to cross this bridge from the opposite side. So we have the blockchain backbone. We have blockchain that is scalable to 1 million transactions per second because it is sharded. We have the cross-chain solution, so it doesn't matter where the assets are located. And now, as we have it, there are more and more of the AI stuff that you're going to see from the Near side. And there are more and more products that we are building that are incorporating the agentic economy flows, both inside of the Near Intense and the products that Near AI is releasing.
Got it. And maybe just while we're still on that topic, can you walk the audience like through the actual user flow of using near intents? Because it's not like I think it's integrated on the back end of a lot of different wallets and other protocols. So yeah, maybe just kind of peel back the layers of what's happening under the hood.
Yeah. So if somebody has been using cross-chain swapping solutions that are built inside of the wallets, so not on Binance, not on Coinbase, not on other centralized exchanges, there is a high chance that you actually already have used near intents. Near intents is responsible for approximately 35 to 40% of the cross-chain volume, of the decentralized cross-chain volume that is happening. The protocol is handling usually more than $100 million worth of cross-chain trades every single day. And the way how it works from the perspective of the wallet user is that the wallets are querying our APIs about the prices of the swaps. And then our APIs are just providing the address where the user needs to transfer their funds. And after the transfer, all of the decentralized protocol kicks in and does its magic. And the user receives on the other blockchain, on the other network, the funds. But there are more steps into this, and I would recommend everybody go and try out near-intents.org. Pretty soon it will be on other nicer URL. But right now it is on near-intents.org, and you can try it out. It is gonna look and feel like a centralized exchange. You get there, you log in with your wallet or a passkey if you want. We support many different wallets: Ethereum wallets, Near wallets, Solana wallets, Stellar wallets if you want. Almost anything. You most probably have one of the wallets that we support. You're logging into this thing, and then you need to deposit assets there. Then you need to authorize some trading, which is happening extremely fast at the speed of Binance, because the settlement on the Near blockchain is extremely quick. And you don't need to think about the gas fees and many different things, because your interaction with the protocol is always just signed messages. So the only thing that you're going to see is just some messages that you're signing. These are authorizations for spending the tokens and trading with the counterparties, with market makers. Yeah, and if you need to withdraw, well, then you withdraw, and you withdraw to a separate place on the particular network. So it looks and feels like Binance, but the big difference here is that this protocol is non-custodial, it is fully decentralized, and the user has full control of the funds, while having your assets on Binance or Coinbase, you actually never know whether it is Binance or Coinbase, or maybe they are doing some FTX-y things, and then your assets are in some other place.
Yeah, that's true. Solomon, kind of a similar question to you. A lot of the audience is probably quite familiar on how to prompt AI, whether they're using ChatGPT or Claude, and very familiar with like this chat interface, right? So what's different about using Chain Opera AI, in terms of what they're maybe used to, and how is the fact that it's operating on blockchain rails either providing a better experience to them or offering something that they can't get off-chain?
Yeah, so maybe the user journey, if you think about it, again, maybe similar to, as you mentioned, many of the AI services you use starts from chat.chainopera. You go there, but then the concept is very different, meaning that when you go to, let's say, ChatGPT, you give a prompt, then it goes to GPT-5, GPT 5.2 to serve your prompt. For us, it's going to go to a super agent that has access to many of the community-built agents. So we have thousands of community-built agents in a variety of applications. I guess later we are going to talk about what is going to be the popular applications. But let's say, whatever prompt you have, right, by the super agent is going to be decided who is going to solve and serve this prompt. Sometimes the prompt is very easy. Maybe just a model could serve it. Then you have access to a variety of models that are provided in our platform, open source, closed source. But sometimes your prompt needs action. For example, you want to maybe do a automated trading. Maybe you want to think about a prediction market, get an insight from there, right? And then it finds the right agents that are solving the problem for you. Now, once the agent or maybe collection of agents that are solving the prompt are found, Then these agents need to be realized. That's where they're going to go to various cloud instances. And that's where we provide our decentralized cloud. That's the GPUs that are serving and the model and those agents and maybe the MCP servers for them, et cetera, are going to be served there. So that's the compute layer. And then you are going to have the data layer where is the data is going to be fetched from. And that's the 3 layers that you are going to have. Now you ask, what is the role of the blockchain? As you can think about it, since it is decentralized, there are various ways that community members can join this ecosystem. For example, you may be a good agent builder. You want to release your agent in our platform. That's a capability that ChatGPT never provides. Right? ChatGPT says, OK, I give you the API for GPT-5. Go build and launch your own startup. It never opens up the traffic of ChatGPT to the builders. We are opening that up. So that's the chat.chain Opera, where all of the builders are getting the traffic through it. So as a builder, you are going to have your agent there. As a compute provider, maybe you want to contribute compute to help scale this ecosystem. Or maybe as a data provider, you want to provide data that is helping training these models. The role of the blockchain is really to figuring out from prompt to response, how much did each player contribute, and how should they get rewarded for their contribution. And that's the concept of proof of intelligence, or proof of contribution, which is a very interesting problem, especially as you go to the AI, right? So for example, if you have collaboration of different agents, who contributed the most, or how much did they contribute? That becomes a very interesting problem that we have solved to assign the value to each participant in the ecosystem.
Yeah, that makes sense. Kind of on a, maybe changing topics a little bit, but as the popularity of AI tooling and agentic workflows continue to grow, one of the things on the top of a lot of people's minds are, like, what are the risks involved with connecting this to all of my existing workflows, right? I personally am YOLOing risk. I've handed over my entire life to OpenClaw, and hopefully no one prompt injects me. But for the more sensible folks in the room, I'm sure they're very curious about how your protocols handle confidentiality and security and making sure these things are executing correctly. So would love to learn how you guys are approaching that.
Yeah, I'm also a big OpenClaw user. Didn't hand over all of my life there. A little bit scared. And that's actually the reason why Near is developing an alternative, so the meaningful alternative to the OpenClaw solution that we call IronClaw. So you can go check it out. It's already working in production. The core idea is the separation of the accesses to the credentials that you have from the kind of like containers where you run particular tools. And the containers are run within WebAssembly. The whole code is written in Rust. And there is like a very, very strict, because it is Rust, there is very, very strict separation of who is able to access what. So yeah, check it out. But definitely being in blockchain for 10 years, I've seen tons of hacks and like lots of protocols and founders failing because they are underestimating what other very hostile parties are able to do. So yeah, privacy is an extremely important topic. And if you would think of this philosophically, modern blockchains are a worse version of the financial system than the traditional banks are. And the reason for it is because everything is public. The reason why everything is public is because we were not able to achieve beforehand the decentralization, not decentralization, but censorship resistance in any other means. We decided that it's a good approach to build decentralized systems in a public way so that every participants are able to verify what is actually happening. But publicity is not the end goal. It is a necessity of achieving these fundamental principles of self-custody and censorship resistance. But now we are having better tools in order to be able to provide all of the values of the blockchain alongside the privacy. My bank is providing me privacy, not from the governmental actors, but at least from everybody in this room. Hopefully there are no governmental actors here. And then that is good enough for everybody. I don't feel very confident and I don't feel very good with transacting on the public blockchains just because everything is public. Anyone is able to take my positions on Hyperliquid and try to move the market to a point when I'm getting liquidated. We've seen this happening, just several months ago. And then in case there is some kind of bug somewhere in the liquidation script, boom, you are getting the October 10th. And then, and then Binance just says sorry, right? So, yeah, this is an extremely important thing, and we have now better tools. And again, in the following several days, you're going to hear some releases, especially from near intents. And who knows, maybe you will be able to execute your cross-chain swaps confidentially, but don't tell to anybody.
Salman, I know you probably have some thoughts on privacy and confidentiality as well, but just given to make sure we're making most use of our time in the fireside, I know that you were also really interested in talking about some of the traction Chain Opera had and maybe some of the top agents and use cases on the platform. So I'll leave it to you. You can either talk about the fun part or
No, I think Alex talked about the privacy. Definitely, we do that. Maybe I just quickly add one thing to it. One part is the automation. That's the more dangerous part than the privacy. And agents definitely automated many things. I think the level that we can do is making sure that the agent follows the intent of the user. But beyond that, I think nobody is ready for it. And that has nothing to do whether you are in the blockchain or Web2 space. Automation of agents, I think, is going to open up a lot of challenges for users, and I think we need to be prepared for that. But maybe for your second part, in terms of, I think, crypto AI and what is going to be the exciting use cases for it, definitely I think maybe a theme of today has been around DeFi, and I think AI could be the layer that is sitting on top of DeFi to automate many of the complex transactions. Right? Think about, for example, prediction market, think about complex markets. AI is much more suited to operate efficiently in those markets. And definitely we have seen that as one area that many of our users are excited about. For example, agents that are suitable for, again, prediction market, agents for automated trading, etc. Another one, maybe I quickly mention, we spinned off another company called Timely. And you can go to our booth, maybe learn a bit more on that. That's about human and AI collaboration. A much needed demand actually we learned from the users. For example, let's say a group of, co-founders want to discuss on how to use AI to build their pitch deck. Right? You create a group, add agents there, and you collaborate within that group to do your AI automation. Or let's say the three of us wanted to discuss how to prepare for the panel. We create a chat, think about it like Telegram, but with the presence of agents to do collaborative human AI there. And I think that's the maybe missing piece here, meaning that AI currently is making everybody more powerful, but not making teams more powerful. And we are seeing there is a lot of excitement there.
Yeah, makes a ton of sense. Maybe let's just close out really quickly with the lightning round. Can each of you very, very briefly make a prediction this time next year what AI agents will be doing that are unthinkable for them to be doing today?
Salman, you want to start?
Yeah, for me, it's connected to what I said. I think they're going to be good teammates or team players. For example, easily participating in a discussion of humans and contributing and maybe creating content, contributing, automating it. I think that's very much within reach and what we are building.
So Elon was saying recently that we're not going to have coders by this moment in time, and like in 6 to 9 months. I think this is completely false. I think it's just we're going to have much more productivity. We're going to have everybody are going to have personal assistant that is an AI, and our lives will be fully going to be pretty automated with all of the usual tasks. And
awesome.
Thanks, everybody.
Yeah, Alex, Salman, thank you so much. Everyone give them a hand, and hope you enjoyed the fireside.
All right, thank you, Brian, Alex, and Salman. So actually, the next speaker, Melvis Salaindo, head of Foundation of Candle Network, is not able to make it just because of flight delay. So we're just gonna jump that session to the following one. So next we'll have the panel of Jameson Pickett, Chief Product Officer Theoric, Tanner Moore, Head of Developer Relationship at One Inch Labs, and Nathan Leon, co-founder and CEO of Vishwa. And the moderator of the panel is Anthony Davidson, partner at Canonical.
Hey everyone, welcome to this panel. Would love to kick it off with just a round of intros, so maybe we can start with Farai and work our way down.
Hey, so yeah, again, thanks for having us, Blockchain Builders, Stanford Blockchain. So I'm Jamie Pickett Jameson. I'm with Theoric, and what we have is AI-powered on-chain vault infra. So how that looks today is we have our ETH-denominated vault called Alpha Vault that runs on Mellow infrastructure. So it's a vault where you have an overarching vault, and then you have a sub-vault infra underneath. As far as how the AI agents are involved right now, it's mainly in the allocation side, the allocation logic. But we also TGE'd recently for our token called THQ, and that's going to be used with Symbiotic and restaking for the trust and management layer of AI agents. So that's kind of what we've been up to for the past month and a half.
Hello, my name is Tanner. I'm with 1inch, and we are a network of decentralized protocols, mostly focused around trading and unifying liquidity across all of DeFi on EVM and L2 chains. And we are just now starting to explore AI in trading on chain.
Yeah, thanks for having me. Always a longtime supporter of BUS, Stanford Blockchain Club. Thanks Kuhn, Gil, and Steven for having me here. This is Nathan, co-founder CEO of Vishwa. We're building the very first trust layer or the banking infrastructure for AI agents. So essentially, we utilize ZK Proof to help agent do pre-execution verification instead of the existing post-execution verification adopted by like Visa, by Stripe, and whatsoever. So essentially, we do three things. So first, make sure that the agent is properly authorized. Second is that we make sure that the fund is like a solvent, like ready to be like liquidated instead of being double spended. And third, we want to make sure that the integrity is guaranteed. So basically, what you sign off is exactly what the agent does. So basically, we have our EIP in place. It's called EIP 8150. Co-authored together with Fidelity Lab and Salesforce, and thanks for ETH Foundation and a lot of the other participating party for giving a very thorough review. And we aim to launch our entire bundle on MCP server and open cloud inferences by the end of this week. So stay tuned.
Yeah, Nathan, you started as a ZK-based self-custodial lending protocol, and now you're kind of proposing a new EIP for agent transaction verification and eventually banking infrastructure for agents. So could you maybe touch on how all of this has evolved? You even just touched on Claude. So how has that kind of come into play within your roadmap?
Yeah, so that's a great question. So basically, the institutional lending business is still like one of our like a human-facing business for sure, because one institution that's where ZK is actually useful, right? They provide the institutional grade privacy. Because, for instance, for syndicated loan of those institutions, they don't really want like, their counterparty to see the amounts, like the proposal and whatsoever. So we also like we keep our R&D process in that front as well, because we propose a primitive called the selective disclosure primitive together with Fidelity Lab as well. So that's still like ongoing business. But for the agent part, that's actually a very long run, because we submit the EIP like about a month ago, and suddenly after like a 1 week or two, the entire like clawback thing comes alive, and then our institutional client actually go ahead and ask us, okay, so are you guys able to help us, like your existing infrastructure? Are you able to help us like testing our own agents? Like testing if they're able to manage the fund properly and authentically. So like, why not? You just take a look at our EIP, and if you're comfortable with it, then we can move forward, right? So it's actually right on time.
And speaking of the kind of sensitivities of security as it relates to these agents, Jameson, we were just speaking about how some of these vaults as you expand their constraints, in other words, as you remove constraints from what the vaults can do and what the agents can do, users might begin to get conscious of whether they're comfortable with taking the risk of a completely unrestrained agent acting on chain. And if you kind of begin to restrain those agents and what those vaults can do, then ultimately you're kind of just, investing in Morpher and Aave and a bunch of relatively simple blue chip DeFi protocols. So as you begin to allude to swarms of agents, transacting on users' behalf on chain, firstly, like how reliable would you say those agents are today? And how do you think we cross the chasm from, blue chip DeFi protocol agents to a more unconstrained environment where an agent can really just be free around the kind of everything on chain?
Yeah, absolutely. So first off, I would like to say we kind of think of it using agents in almost like 3 ways right now. So one is due diligence, research, that type of area, still human in the loop, but, for instance, it could go all the Pendle markets and would tell us, stuff like the underlying protocols, RWA, fees, all that stuff that you would want to do. It's like a junior research assistant. That's very useful. Obviously, that's human in the loop, so that's safer. Then you've got what we would call defensive actions. So, for instance, our health factor gets low on, speaking of Aave, right? Your health factor gets low, we want to delever, right? So that most people say that's a lot safer than going the opposite direction where the AI agent decides to lever up, right? Or the AI agent decides to push more capital in. So that's kind of where we're starting, is we're working from that way in. So unfortunately, I wish I could say, yeah, in our Vault Infra, we're already, AI agents just get a sub vault and they get 100K, 200K, $1 million, they can just do whatever they want. But again, institutions, even though it sounds like they're a little more open than I thought they might be if they're using Claudebot, but they, it's
just echoing that, right? They're making defensive move, which is a much faster than quote unquote like institutional adoption, right? Because institutional adoption is good to have, right? But defensive move is that they're losing profits, right? So they want to make the move.
Yeah, and they might they might have to move a little faster out of a forcing function, right? They're kind of forced to do it. Yeah, absolutely. So that's kind of where we're at right now. As far as just letting agents go, we treat the agents as if we would treat a human curator, which is it has all the Merkle gating, all the MPC policies that right now that you would have. And as I said, sometimes that's a little disappointing. We want agents to just go get alpha and go wherever. But right now, we're more defensive, especially even in pre-prod, yet alone in production. So that's kind of where we're at.
Yeah, thank you. Tanner, many of us who have been in crypto for many years are obviously very familiar with 1inch being the OG DEX aggregator. But today, there's a big narrative around AI agents being the future of the user base in crypto, and I'm curious how you kind of preparing for a more agent-oriented or intent-oriented environment. There's a lot of talk of near intents, for example. I'm curious, how does that play in your roadmap, and what are you doing to prepare for this new wave of potential users on chain?
Yeah, so we do have intents already available at 1inch. It's not quite as general purpose as near intents, but it still is intents just around token swaps specifically. So that's just using our APIs and talking about from chain to chain where you want to go. And so that API, although it's not designed for agents, it's simple enough to where agents can use it very, very well already. So really what we're looking at is how to make that process easier in an agentic ecosystem. So that may be making it easier for agents to build traditional integrations with our trading platform, or maybe it is trying to make it where agents can just interact with the platform in a more native way to agents rather than learning the APIs and making REST calls. So we're researching that right now, but even with where agents are today, they can effectively use the system.
And just continuing, Tanner, how are you thinking about agents executing cross-chain? I mean, that must obviously be a huge part of the roadmap as more and more opportunities manifest on different chains. Inevitably as a user, you don't want to be restricted to something on Base or Monad or Solana, whatever it is. How are you thinking about kind of cross-chain execution?
So today you could use Fusion Plus to do that, but we still have the problems of latency across these chains, and the finality guarantees between which chains you're going to also change changes pretty dramatically. So, you know, if you're using Ethereum, it might be longer than if you're going like base to Arbitrum, but even some of the L2s, we wait actually quite a bit before we guarantee finality. So there still is going to be latency in cross-chain execution. I'm not really sure what the most novel solutions are in that space, but we want to minimize that as much as possible, as well as making it, you know, as agent native as we can as well.
And you know, where are the use cases where latency becomes very important? Because that seems to be the challenge here to solve for when it comes to cross-chain execution. I mean, unless you're running, you know, high-frequency hedge fund or something, like usually it's just the regular user, you're not really dealing with any hyper-low latency requirements. Correct me if I'm wrong.
No, I mean, you're totally right that people who, especially people who come in and are maybe more TradFi people, they're not going to understand like the reasons that there's latency across chains, just in general. And so I don't really have a plan to beat, you know, the natural constraints of trying to wait for cross-chain communication to settle properly. But we'll try to make it where the bots at least can work well. But you know, there's still going to be latency in those systems. It's not going to have that true native high-frequency trading like people probably want.
And Jameson, how about you? How are you thinking about cross-chain execution and latency?
Yeah, so because everything's on chain for us, and you know, we do have MPC wallets, so EOAs can do things a little bit faster, especially on, as mentioned, like Hyperliquid, Hyper EVM, you know, versus 12-second block times on mainnet. But right now, all those, like, we don't do HFT strategies, so a couple seconds is kind of like good for us. Even if we're running something like a hedged LP or something, it's like we just want to be good enough right now. So it's not perfect. You know, we take on a little more basis risk because we're not going through the API and getting almost instantaneous on Hypercore. When you go through Core Writer, which is what we do, you get a couple seconds built-in latency, stuff like that. So, you know, I think it's the same thing. Like we just kind of right now for our agents and our strategies that we have, we just kind of deal with that and we just make it as low as we can. Yeah.
Yeah, I mean, in terms of that, when TradFi people are talking about latencies, they're talking about different things, right? Because they're talking about like T+1, T+2, like the fund settlement kind of thing, right? Instead of, you know, people are doing like funding rate arbitrage that you need to get a flash loan, do you need to borrow against it? You have to complete everything within the same block, which is like almost impossible if you want to do like cross-chain, right? Because Solana do it in like a less than 1 second manner. If you want to do it like from Jupiter to Base, it might work because Base have a similar latency, but the cross-chain itself takes more than a minute, right? Which makes, you know, like cross-chain, like arbitrage not that easy to work out. And especially for the agentic side, right? Because you have to enforce like pre-execution verification. Otherwise, you know, like especially when you're doing cross-chain, when you do like consensus check or like full MPC and whatsoever, that creates its own latency. Like if you're going through SLR, if you're going to like layer 0, if you're like CCIP, right, there will be like a 1 minute plus, like on top of those like entire consensus time. So that will also create the problem. So even for that, I think the latency only matter in those like like if you want to hedge the risk, you're applying the flash loan, but it won't be such a big deal when we're processing, you know, like institutional level lending, we're processing, you know, like cross-border payment, which is mainly just like T+0 instead of, you know, like below the second level.
Right. And CCTP can sometimes, depending on if it's a fast chain or a slow chain or a standard chain, can be almost 15 minutes in some cases. You know?
Exactly, right. CCTP could be even slower, right?
Yeah, and there could be scenarios in the future where there are counterparties that kind of credit people across chains, right? And they maybe charge a higher premium on the rate for the swap, but then they can actually give customers what that traditional finance experience that they're looking for. They may not know what's going on, but that they could do that for a slightly less advantageous rate at the time of the trade.
But that has to be like built on top of the reputation system and whatsoever, right?
Yep, exactly.
Nathan, do you mind just maybe touching on your current architecture and, you know, where does custody sit, where do the agents fit in, who's building on the agents, just kind of touch on the broader architecture itself?
Yeah, I mean, I'm happy to dive a slightly bit into the detail of how we structure ourselves. So basically, regarding a user, let's say user have their agent, right? And they authorize an agent to do something. So while they do the authorization, they generate two things. So one is the order to the agent, and the other one is the ZK proof of that intent. And when the agent actually formulate the execution path, it generates another ZK proof. So instead of just like going straight like for the raw transactional data, they do verify and execution using our EIP standard. So basically, they need to make sure that the ZK proof generated by the user is equivalent to the ZK proof generated by the agent. So as soon as those two matches, it processes. So that's essentially how we structure ourselves. And the fund custody is stay with the user or the authorized amount right there in the agentic wallet until everything get verified, the funds move, right? And basically, who are building the agent is essentially upstream, like institutional clients are building agents like smart money. Because right now, after the whole like Clawbot thing, it could be individuals managing like a bulk amount of money themselves instead of going to a hedge fund, buying an ETF, and whatsoever. So like I would say the user base of the agent builder, it grows exponentially faster. Comparing to like previously, you need to have a CS background. You need to know how to do like agentic coding instead of right now you just do vibe coding, right? So you need to have a very intact like MCP server to protect the fund, but I mean it definitely lowered the barrier for like the agent builders. So yeah.
You know, where would you all, I mean, this is a question for everyone, maybe we can start with Jameson and work our way again, but, you know, where would you say the opportunity is to make money given all the changes that's taking place right now? Part of my mind goes to a world where all of these agents are kind of just, you know, arbitraging every single opportunity, and there's not that much alpha left for the regular degens like us. Yeah. Where would you say is the opportunity today?
Well, if you got millions of agents, maybe owning the GPUs is the best opportunity. But yeah, no, I don't think that's what you meant. So I still kind of say like take a step back. And maybe I'm wrong on this because it's so early, but I still don't think users, especially when you're talking just maybe non-crypto users or retail users who aren't that heavy into it, that they're going to come to an app and kind of like set up their agents, set up their bots. I still think the big user is the infra behind it, especially like, obviously it's been a big topic of late, like all these neobanks and all that stuff. So I think as far as getting back to your question of like, just because they're faster and is there going to be no alpha, I would kind of compare it to like when you went from all paper trading, or pit trading, futures were all pit trading, and then you went to electronic, and then you went to high frequency trading. You didn't eliminate alpha, but you did bring in like new risks, like flash crashes, right? It hadn't happened before, where you compress multiple days worth of action, price action into minutes or whatever. So I think it'll be something similar to that. I don't see a world where alpha goes away or information asymmetry goes away, but it definitely will look different, and some of the retail strategies might go by the wayside.
Yeah, I mean, I think even in a totally agentic trading ecosystem, there's still alpha in where the prices are going, right? So maybe you can't do like these high frequency trading like games where you're beating people by milliseconds, but you still could have bots that are much more holistic and look at broader market trends, and whoever can come up with these ideas where they're actually seeing the projection of where prices are going rather than playing timing games, there's still a lot of alpha there to be had.
Yeah, I mean, I've seen, like from the counter example that actually there will be more alpha because to be honest, there will be, like people creating positions, for instance, on different prediction market, because people are talking about the information asymmetry, right? Because alpha is essentially created by the asymmetry of information. So for those who are creating the position on prediction market, for instance, right? There are different rates and different bettors, and they bet on different things accordingly to their context, right? So those are the like more alphas that people are actively creating, and in the holistic agentic world, that those are going to be agents creating those like alpha instances, so that there will be more arbitrage opportunities instead of less.
So you're basically saying that agents are going to create new markets on things like prediction markets platforms, and those new markets are going to create opportunities for people to take the other side of that, of that market, and that will create alpha.
Yes.
Yeah, I mean, a lot of the conversation we've had so far has obviously inevitably been about DeFi, and stablecoin yield is probably one of the areas that's obviously found product market fit today, but prediction market is definitely another one. As you guys think about your own, more DeFi-oriented strategies, do you envisage expanding your offering to include different types of instruments, different ways to manifest people's opinions in the forms of prediction markets, maybe even on-chain equities and other types of assets, RWAs and so on as well. Maybe take it. Each of you can answer that. Yeah.
This way again. Yeah. So to answer the question shortly, yes, we plan to expand quite a bit. Now, we're still so early that, as I mentioned, exactly what will be agentic and on what timeline is a little bit hard to answer, but we're already expanding into some, delta neutral strategies and trying to see, obviously when most people think of delta neutral, Athena's the giant there. You got neutral USD, you got some other funds that were doing that before and just kind of doing the, the carry trade on the major perps, exchanges, and maybe even the CME as well. But more traditional futures carry. But there's so many delta neutral strategies that are out there. Doesn't always have to be just ETH based or Bitcoin based, and there's so many protocols. There's also arbitrage there. So that's kind of what we're thinking of first, is like strategies that kind of already work. Start there, as opposed to just like letting it go and like find new alpha. That's kind of where we're thinking about, and expand. And then, but I think it will be interesting. Like prediction markets still, you feel like that's tailor-made for something like an LLM, but it's also really hard to, in practice, put that into a vault, at least from our perspective, like a DeFi vault, and have rules around it and all. So, but I think for outside of our product, if you just think in general, that does seem a very fruitful opportunity for agents.
Yeah, so at the end of last year, we launched 1-inch Aqua, which is a total reimagination of how DEXs can be built and launched. And it's actually a very good fit for agentic development now, because it basically abstracts away all of the hard parts of creating a DEX, the custody, the management of deposits and withdrawals, the transfer logic, all of that is abstracted away, and users can now just focus on the swap logic directly. So this kind of creates a very good environment for agentic style DEXs, or I should say agentic developed DEXs, because they don't have to worry about all the sensitive parts of creating DEXs, right? You don't have to worry about user funds, you don't have to worry about actually giving bad rates. It's all kind of protected underneath this Aqua system. So we've created something where agents can actually develop DEXs in a way that wasn't really possible before, without spending $500,000 on audits to make sure it's good. And then on top of that, agents can also live in that system too. They can play around with strategy. You can give an agent, some amount of capital across a various basket of tokens, and they can play in all these AMMs that are created, mix and match, do whatever's the best, dynamically change based off of what's getting the most yield. So it's a very good time for Aqua to exist in this kind of agentic trend that everything's going.
Yeah, when did you launch that, and how has adoption been? And the idea is that any developer can launch an agent that will then go and kind of manage a DEX, is that right?
So yeah, I mean, the agent part's kind of one step removed from Aqua, but yeah, we launched this in about November of last year. It's in developer preview right now, which is why a lot of people don't know about it, but you can go to 1inch.com/Aqua and read our white paper and everything there. But basically, anybody can come in and they can make their own DEX, right? As long as you can write Solidity, but now agents can vibe that for you. We even have a thing called Swap VM that makes it one step easier, but you can use Swap VM, you can use agents however you do it, and that will let you play around with DEXs. You can copy old DEXs like Constant Product if you want to copy some of the older Uniswap style ones, or you can create brand new ones. But we're expecting it to be a very nice playground that would probably play quite well with AI.
And yeah, I mean, just to take a step back, when you're at 1inch and you're thinking about this future roadmap of this new wave of AI agents, how are you thinking about your architecture from top to bottom, and how does Aqua kind of play into that broader vision that you have?
Yeah.
Fully loaded question, so feel free to take it.
Yeah, I mean, I think, so you're saying how are we thinking about architecture from an AI perspective? Is that what you're saying?
Yeah, correct.
Yeah. So we really want to focus on making our docs very accessible to AI, make our integrations buildable with the help of AI, and then eventually move on to actual agents interacting with our system over AI. And so the example I just kind of went through now with Aqua is probably a really good application of potential use cases for AI. And then other than that, yeah, just look maybe into the NPC space, anything like that just kind of leans into AI, especially while it's trending and looking like it has a lot of promise.
Yeah, I was going to ask about the, let's make money on chain. Where are the opportunities lying for you?
Yeah, I mean, from the infrastructure builder perspective, instead of like strategy builder or like protocol builder perspective, I saw two things. One is that utilizing our infrastructure, there are some like ecosystem project building like aggregator of prediction market, saying that while they are browsing the Twitter, because they talk to me and they say, okay, use this Chrome extension. That while you're browsing your Twitter, you can just see like whichever the best position and the most relevant position, like the Winter Olympics right now, like U.S. versus Canada on ice hockey, right? And they're actually building that part of the world, which is like, because we previously focusing more on the institution and smart money, and we haven't paid much attention to it. And that actually echo back, and we go back home and see how much our infrastructure can like expand on the retail space, and we figure out, okay, like generating like pre-execution verification only takes like 2 to 5 seconds on the retail, like a retail device, right? You can do it on your phone, you can do it on your computer, instead of like utilizing ZKVM and go to like a server and do like a 1 minute of like proof generation and run all of like a costly verification on all of those ends, right? Because that will easily expand the quote-unquote massive adoption to all of those available agents, right? Because right now people don't really build agents relying on like very expensive server, and they just do it on their own Mac Mini, right? They just do it on your own cell phone, right? So that's one perspective. And second perspective, people are looking into like the natively yield-bearing like assets, like tokenized MMF, like yield-bearing stablecoins, also those like tokenized metals like gold, silver, like copper, because those are, and also like receivables for supply chains or the cross-border payments, right? Because those are really like a natively yield-bearing asset that could bring positive value add to this entire this entire like industry, right? Because if you're, let's say you're on Hyperliquid, you're running like funding rate arbitrage strategy over Ethereum, right? Because Ethereum is natively like yield bearing because people are using Ethereum, right? So it's essentially extracting the value from all of the traders, right? Because you are contributing the gas to make Ethereum like yield bearing. But those like natively yield bearing asset who like that is already applied in real world, right? Those are generating opportunities for like, because we're like also talking to LME and CME regarding like people are hedging the trading risk of the metal because they have warehouses and they're able to like generate the ZK proof as their proof proof of storage from a plausible warehouse. They can use that to hedge the risk. While like there could be price like fluctuation, there could be like geopolitical like risk that the shipment is delayed and whatsoever, right? They hedge all the risk over there, right? So utilizing that part of asset or expanding the market to that part of asset will be critical for just focusing on the on-chain blue chip assets.
So like, sorry if I misunderstood. So if they have something like the LBMA or London Bullion,
London Metal Exchange.
Okay.
Yeah. The LME and CME. Yeah.
Okay.
Because what they used to do is that they have, if you want to hedge your risk, you need to have like proper storage of like actual metal and like a verified warehouse, right? There are like how to say like entry barrier for margin, right? But if you put that on chain, and that could be like a natively yield bearing product for those RWAs, and that enables like no entry barrier for all of the users that they can do like participate. So that would be an interesting perspective on the agentic like vaults and stuff.
Where are you all seeing demand from developers for what to build? Maybe Tanner, you can kind of kick it off being lead DevRel, but yeah, where are you seeing demand for demand amongst developers for what you guys are building?
I think the big bottleneck right now is probably security. It's kind of a hard thing to convince people on, and everybody's idea of security is actually very different. Like even how agents manage the funds, like do they have the private keys? Are you delegating access to some of your funds and you're holding the private keys as an EOA separate from them? It's just very unclear where the security lies in the system. And like personally, I wouldn't trust any significant portion of my funds with an agent at all at this point, like not even close. And so I think that that's one of the things that needs to be solved, whether it's agent standards, whether it's just new kind of designs around how these agents can interact with funds. I'm not really gonna spin up a Claude bot and just like dump my whole life into it right now and then tell it to go trade for me. So I think that's probably the big bottleneck right now for getting adoption and getting people to really jump on this bandwagon.
You're not supposed to say the quiet part out loud like that.
I mean, because we were building the security guardrail, right? So that's right on target. When I was like first seeing the whole Clawbot thing, so okay, why is it asking me like for like pseudo permission, right, on my server or on my sandbox, or why is it asking me for, you know, like the private key access and whatsoever, right? Because even if you're doing like vibe coding and stuff, you strictly you strictly prevent like AI model to read your environment file, right? But some of them like sneakily trying to do it. I know it because I've traced that, like what they read, like from their like thought process. So this is like the guardrail that can combine the two primitives that we propose. That one is the pre-execution verification, and the other one is the selective disclosure. That you never want to disclose like those like mission critical information to AI agents, because like essentially you don't trust those foundational model builders at all. You need to have like a guardrail before your data has been accessed to those people.
Are you seeing that mistake occur commonly?
Well, I mean, they do, because for all of those LLM-based like agents or like vibe coding tools, they don't do it deterministically, so they're not set up to steal your stuff, right? But they probabilistically, like they have like 1% of opportunity, let's say 2% of opportunity. Let's say you run it like 100 times, there are like 1 time or 2 times, they mistakenly just do it, right? So even if you set the rules at the boundaries, sometimes they diffuse over the boundaries so that they access the wrong stuff, right? So
and it's catastrophic, right? Risk of ruin is high, even though it's a low probability. Right?
Exactly.
Your CVAR or whatever. Yeah.
Is there a specific security mistake that you're seeing people make, frequently these days amongst all the teams you've looked into?
Well, I mean, for Claude bot specifically, right? Letting agent run your own money without like security guardrail is definitely like a huge mistake. That is like essentially, I'm actually curious, what's the how to say the psychological like process, like why people actually allow like a pseudo access or like the private key access, because like your credential flies everywhere, right? They can expose to the foundation model builders. They can expose it to like other like antagonistic agents and whatsoever, right? So I mean, people are actually lack of understanding of the security at all, instead of like what kind of mistake, because you don't know what you don't know, right? So they don't really have any like necessary concept. That's why people need to build the security guardrail first and tell them, okay, apply this. Because like I said previously, the user base for like agent builders actually expand to non-coders, to non-programmers, right? So it's not their fault for not having
non-DevOps for sure, right?
No, not their fault for like a lack of understanding of security, because they don't code. But it's essential for us, right? For infrastructure builders or for DevRels to say, okay, these are the stuff that's ready for those non-coding agents. Right, those are critical.
So what would you say it's on, the developers, the people preparing the documentation, the user guides, like whose responsibility is it to protect the user? Because, from my limited use of OpenClaw today, it's relentless. Like the thing, you just give it one task, it won't stop executing until it's reached its endpoint. It will do anything it needs to, and sometimes it kind of gets lost in the process of execution. So. While you might say, hey, I'm, naive when it comes to security, the tool in front of me is also like a wild axe. Like it's like, so
that need a great DevRel, like you guys, right?
Yeah, like, where does the responsibility lie to help with the security when it comes to these new agentic protocols and use cases?
I mean, there are 3 different parts, right? One is for the infrastructure builder, that you have the security guardrail in place. Right, and the second is for the DevRel, probably that you properly instruct those like non-coders or they're like vibe coding agents themselves, right? Okay, these are the security guardrail that you need to have in place before you actually let them manage in their real fund, right? And third part is probably also on the vault builders, like strategy builders, right? So there's something that you should touch and something that you should not touch, right?
Thanks, guys. So with that final word, we'll say stay safe to everyone using AI agents on chain. Follow all of these guys to know when it's scalable and ready for everyone's use. And thanks for tuning in. Thank you.
Yep, thanks for having us.
Thank you.
All right. Thank you, guys. So actually, Gordon is also experiencing some flight delay. He's actually very soon will be here. So we'll swap the panel as he's on his way. So next we'll have a panel where we're going to have Lele, VP of and head of BD of Kite AI, Mike Massari, VP of Research and Partnership at Aeon, and Chris King, Developer Relationship Engineer at Aptos, and Bobby Bernier being the moderator. He is principal at CoinFund. Let's welcome them to the stage.
Thank you, Kuhn. And thank you all for being here. Welcome to the next panel. We've got some great panelists up here to talk about agentic payments and how we can make them less of a pipe dream and more reality. So I guess we'll start with some introductions. I'm Bobby. I'm a principal at CoinFund. CoinFund's one of the oldest crypto investors in the space. We've done a lot of work in recent years on the convergence of AI and payments, and excited to ask some good questions to get the people at the forefront of it to talk about it. So why don't we start with some intros? Tell us a little bit about yourselves and the projects that you work on.
Sure, I'll start. My name is Chris Kim. I'm a developer relations engineer at Aptos Labs. And Aptos Labs is the company that's behind the Layer 1 blockchain, Aptos. Aptos is a move-based blockchain that came out of the Facebook DM project. Currently, one of the fastest chain with 50 millisecond block time. We're really trying to become the global trading engine. And we're focusing on payments, financial use cases, and naturally, agentic payments. So excited to be here.
Nice to see everybody. I'm Mike Massari. I am VP of Research and Partnership at Eon. Eon is a multi-chain, cross-chain payment company. We've been focusing on cross-chain payments on any token, on any chain for the past about 3 years. But we have worked quite a bit on the X42 side and on the agentic payment side, creating the first BNB X42 facilitator and many payments use cases across Southeast Asia, Latin America, and North America. So yeah, thank you so much for having me.
Hi everyone, my name is Lele, and I'm VP and head of business development at Kite. Kite is the first payments blockchain, and we're focused on building agent-native infrastructure.
Awesome. We'll kick it off with 2 questions. First is, in general, why should agents adopt blockchains for their payment solutions? And then I'd love for each of you to riff a little bit on why your specific solution.
I'll start with this. I think it's a very interesting question because when people think about agents, they don't immediately think about blockchain, right? I think that especially nowadays, AI is moving very quickly, and we're seeing a lot of evolution when it comes to AI. And this is exactly the reason why agents should adopt blockchain. You know, there's no such thing in traditional media or in traditional web of knowing your agent or like agent identity, which is something that blockchain can provide in a very specific way. You know, X42, for example, being an example of that. But to me, blockchain gives an immutability and a verifiability layer to agentic payments or to like agentic operations in general that traditional web just simply doesn't give. So I think that it kind of mixes perfectly with the like fast, autonomous nature of AI agents by giving them like a ground in security and in reality that would not be achieved otherwise.
Yeah, I think that's a really good point. And to add on to what Mike just said, AI agents, we can really think of just them as digital beings, right? And the payment infrastructure that has been built so far has been optimized for humans, for us to make it easier for us to pay. But it's actually not that convenient for agents. They need, and for them, ironically, stablecoins are more native to them. So it's actually it's a very funny thing that perhaps I might even go as far as say that blockchains where the main user is AI agents, not humans. I think the biggest friction points for adoption for blockchain technology has always been the on-ramp and off-ramp. But when agents are just transacting with each other using stablecoins and everything stays digital, blockchain is just a natural fit in that scenario. And to support this, the blockchain obviously have to scale. It has to be performant, and Aptos is preparing for that future. Is already one of the fastest chain. We have instant finality, 50 millisecond block time, and we already have like 3 protocol upgrades coming this year to bring that block time to 10 milliseconds, which is on par with centralized exchanges. So we really want to enable agentic swarms, agentic payments to happen on Aptos.
Yes, I think it's very important for agents to work with the blockchain because you need that on-chain verification and ability to track how the agent has performed in the past. So for us, what a few of the things that we're very much focused on is a 3-tier architecture. So you basically have the human, who is the root authority, that then delegates authority to your agent. So a human says that I have an intent to perform a certain transaction, and then I delegate an amount into the wallet that the agent holds. And then the agent then performs a certain transaction over a 3rd tier, which we call sessions, which is basically bounded by spending limits as well as smart contract programmability. So that's why I think the blockchain is really important, because it provides that verification of the agent actually tied to the person that has authorized it to perform a certain activity, as well as you can also trace, for example, has this agent performed, X amount of times in the past, and how did it perform? And if there are certain disputes in terms of, like, did the agent do what I asked it to do? How can I trace what it did in the past? So that's why I think there's a natural synergy, and obviously agentic payments, identification, verification has been a huge topic throughout ETH Denver this week.
Awesome. I think that draws the landscape pretty well. Let me just double click on one thing. So Aptos, general purpose layer 1, great for payments infrastructure and stablecoins, asking developers to build on top. Kite, on the other hand, we've got kind of an integrated identity plus kind of like delegation plus authorization, as well as the chain level, right? Tell me about Eon. How do you fit into that stack?
We actually operate, I was saying, like maybe one level below that. So we provide infrastructure and we provide a mean for payment to be processed across multiple chains and across multiple stacks and multiple coins. So the thing that people interact with most of the time is just an interpolation or like the user experience part of our product, but the core of the product really sits one level below. We do interact with different chains, so we have obviously ring layers and protocols that communicate with the different chain, but what we have mostly focused on is to provide facilitator for example, agentic payment based on the X42 protocol, or just traditional human-driven payment across multiple chains, and that happens through our network, that is the infrastructure network that Eon provides, and that is kind of chain agnostic. We like to say that the protocol is omni-token, omni-chain, because at a very deep fundamental level, we do believe that payments should be omni-chain and omni-token. Personally, I've been asked this question quite a bit on like what is holding up payments in today's blockchain, and I think that the mostly is user experience. So people have to interact with different wallets and have to create different wallets and know about slippage or smart contracts or swappage of token, and we can remove all of that. So for us, we fit into the stack by just being facilitating different payments on different chains.
Awesome. Now that we've got a good lay of the land, we'd love to talk to you guys about where we're at today. What kind of traction are you guys seeing in agentic payments or payments more broadly? And I'm also curious, I generally like to break up the agentic payment space as you have your agentic commerce, like my agent buys things for me. You have like more B2B, and then you have agent to agent. like one agent paying another agent to do something. So I'm curious if you guys have any insight into like what is currently generating you traction, and does it fall into one of those categories? Like where are we seeing life?
I can start. So in terms of what we've seen so far, we have about 20 agents building on Kite that have integrated Kite MCP. We've natively integrated X402. Some of the most common use cases we've seen are like research agents, so agents who want to basically access data. And so, you know, they want to like pay per call or pay per token. And that's another reason why for Kite, we're very focused on certain features at the infrastructure level that allows for kind of the application level built on top of us to be able to have some of the agent native infrastructure in place already. So as I mentioned, you know, a very common one is like research agents. And so, you know, there's micropayments is very common. So we've basically put in place zero fee RPCs for that. And some of the key areas we're very focused on is working on the integrations with like the Claudes of the world, and then also the integrations with the merchant side, so with like a Shopify and Amazon. And I think that's really where you'll see a lot of the huge growth going forward, and you see a lot of that happening already. So connecting the hundreds of millions of active users on the major LLMs to actually being able to transact in a secure and in a safe manner, and being able to execute a transaction that they can buy at a certain merchant.
Yeah, I completely agree with that. I think that another very interesting use case that we're seeing is really this proliferation of agents, right? So we have a lot of machine-to-machine interactions now, so like what you call the agent-to-agent payment. I think that this is very much where we're going to at some point, right? Another interesting use case that you didn't mention that we are seeing quite a bit is travel. So there is people that tend to book, travel like hotels or flights hotels combo with agentic payment, because that is something that, if you think about it, like on a manual, interaction, it takes a lot of effort. You need to go in and like find the flight and find the hotel for the same days, and then find the transportation. With an agent, that makes it so much easier. And actually, we're facilitating a lot of that agentic payment. So it's not only machine-to-machine, but sometimes it's also machine to kind of Web 2 service, if that makes sense. It's always still like regulated through our facilitator and to the blockchain through the X42 protocol, but it ultimately ends up into like a traditional like Web 2 destination. But I do think that moving forward, we're going to see much more like agentic payment that goes to a different agent. So agents to agents, machine to machine use cases.
I mean, these guys covered a lot, but I think an interesting thing that I'm seeing is that applications are slowly moving away from all these pretty UI that were great for humans, and they're just putting an AI agent chatbot in front of it. In the back, the AI agent is just interacting with APIs and smart contract functions to initiate and DeFi, transactions and activities. And we're seeing on the Aptos blockchain, there are multiple, companies like Yield AI and R&DM Atlas. They're utilizing AI as like their UX component, and the AI just goes and finds all the smart contract functions because they're all public on the blockchain and just interacts with them. And the human doesn't really have to know how to interact with them or whatever. The AI just goes and do it. So I just thought that was interesting to point out.
I do agree that it's very interesting. This is really the difference that there is between user experience and user interface, right? So in a way, what we discussed for so long now is abstraction of these processes and like of the complexity of blockchain or crypto into something that is easy and usable. For a long time, there has been better user interface. and it's being, you know, more easy, for example, cross-chain payments or cross-chain swaps or easier understanding of these like primitives that we're very used in DeFi. And now it's true, we're seeing that even further abstraction where the user interface is not even in question anymore, and it's just about asking in plain English or in plain, you know, whichever language, a question to an agent, and then the agent going and finding that out. I think that is also why, going back to your first question, crypto is so important, and blockchain as a technology is so important, because crypto really removes all of the barriers that there are between the different nations, right? So like if you want to transact in a different locale, you can, no problem, as opposed to traditional finance where you have, you know, remittance, and then you have obviously time of redemption of token or time of transfer. And also you get all the verifiability, as you were mentioning correctly, on top of it. So I do agree with that 100%.
I think we'd be remiss to kind of skip the conversation of agent identity. I think it's something that a lot of people are grappling with right now. But I'm not sure if there's like a clear definition that like 3 people in this room would agree on. So maybe we could talk about like what exactly does agent identity mean in each of your systems, and like why is that important?
I'll take this. And really, for this question, I really want to hear what you guys say, because you guys are like specializing in AI, and we're just kind of like, you know, trying to do this. You know, I think as us as an industry, I think the biggest push on agent identity right now we're seeing is EIP 8004. And it's gotten some hype and a lot of interest around it, but recently we've been seeing, you know, skepticisms around this. Like, is this enough? Right? Because it's really just a smart contract where you register an agent and people can vote whether, you know, vote on the reputation. And then there's talks about, does agent reputation even matter? Because reputation is a social thing, and for humans, reputations matter, because when we ruin a reputation, it's really hard to gain back. That's what forces us to act in certain ways. For agents, you know, they can just like turn their behavior just like with a single prompt, right? I could have told my agent to be nice and, you know, polite and honest, and then the next day I'm like, all right, go rogue, you know? So I think a lot needs to be experimented on this front, because if we don't figure this out, and if we just push on the payment side and just like gets excited about that, it's going to be very dangerous, right? So I'd love to hear what you guys have thought about that.
This doesn't work. Let's see, hold on. Oh, thank you. Okay, I have 2 microphones now. I feel very important. I think you raise an excellent point. Identity and reputations, 2 very different things, right? So verifiable and verified identity does not necessarily mean high reputation status. And I think this is very important for us to understand and figure out, right, as a community. Agent identity is necessary because we built this whole industry around security, around verifiability, around trust minimization, and like without agent identity, all of these things, they kind of fall. So agent identity, for the people that are not familiar, is just the algorithmic verification that the agent that you are actually interacting with is the agent that you're meant to be interacting with. That's basically, like in plain English, in the simplest possible terms, what this is. It has nothing to do with the reputation of the agent. It has nothing to do with the behavior of the agents. It only has to do with the, as the term says, the identity of the agent. So who built it, where it resides, and that obviously can give you a pretty good indication on how the agent will behave, but it will never be 100% correct. It is a necessary component, is not the only necessary component to be able to trust an agent, but it's definitely something that is absolutely fundamental.
How are you guys solving it?
Effectively, we're implementing a way to kind of know your agent through the EON infrastructure into the facility that we do. So there is algorithmic verification of the agent identity and the agent signature in every single transaction. But again, this doesn't solve the problem. So I'm not telling you this solves the reputational problem of all agents, but this definitely solves the identity problem of
So like agents within your network, are you like tracking their activity over time, and like you can all of a sudden detect fraud or tell which agents are good and bad, and you can kind of pass that on to the user?
Kind of correct. So there is obviously a whitelisting and a know your agent process that happens, but also there is a pattern of behavior that the agent has, and like if there is any modification to the agent identity, that gets flagged and then potentially gets removed. So we effectively make sure that every request that goes or is supposed to be going to a specific agent actually does go to that agent and not to a different one or to a different version of that agent. That's kind of the bottom line.
Yeah, I think agent identity is very important. I mean, the agentic world is incredibly powerful, but also scary. And you can see that with, like OpenClaude's we've gone from the stage of reasoning and research and to execution. But to really trust that, I'll have my AI agents just execute everything for me, people I think really have to be able to go over that hump of believing that, most of the time my agent won't go rogue on me. What I ask it to execute, it actually has. And so I think, going back to what I said earlier, that's why I think it is really important to be able to tie the human to the actual agent, and that there's kind of a hierarchy of almost power where you can see that the agent was delegated this authority from the human, and certain guardrails around the amount of time or the amount of spending, I think is very important. Most people will probably feel comfortable spending a lower amount of funds and asking the agent to execute that. But as the amount goes higher and higher, you probably still need some kind of human verification.
So in the Kite paradigm, if I give my agent $1,000 to go and, like you said, research agents were popular, so to do research, and it decides to employ another agent, and that agent that I hired ends up throwing away my $1,000, do I then go after the person that agent is tied to for kind of dispute resolution, or is that kind of why you're tying human identities to agent?
Yeah, that's a really good question. I think that autonomous agent-to-agent interaction is definitely something of the future. But in order to get there, I mean, first of all, I have to trust the human-to-agent interaction first and make sure that traceability works first. And then agent to a second agent or multiple agents, kind of like interaction and verifiability is a whole nother ballgame.
Yeah, super interesting. I think there's a lot left to unfold, and excited to watch it over the next year. To close out on that note, looking for some predictions from my panelists. So February 2026, in February 2027, which agentic payments use case has taken off the most? And either a year from now or in general, like what's your milestone that you're looking for that kind of says to you that there's no going back, we are an agentic economy now?
I can try. He asked me if I want to take the question. It's always interesting to take this like so speculative question because you risk like going and saying like something completely stupid, which I'm about to.
Nobody tell. We're just having fun.
So to me, the key component will be daily use cases. Right? So I do not particularly, personally, I do not particularly believe in like big agentic trades when it comes to like big swaps or agentic payment in like lending protocols or like Pendle tokens or stuff like that. I think that the real agentic adoption will be defined by everyday use cases that every one of us experiences. Travel being one of them, right? We all at a conference, we all traveled here. Or, for example, like booking of certain services or certain commodities, like, you know, a restaurant or whatever, even dinner, right?
It's almost like habit forming. So,
yeah,
like
so
if
like
humans form a habit of using their agents for commerce, then we're all cooked.
Exactly that. So in the same way that we did form a habit, I think every one of us in this room, of asking ChatGPT or Gemini or whichever is your AI language model of choice, something where you don't know instead of going to Google about it. If agentic payments becomes that, and you say, okay, I want pizza tonight, or I want to go to Denver for Eat Denver, and you let an agent figure out all of your travel plans, all of your hotel booking, all of your car, or maybe your Uber drives to the conference where you have to speak or where you have to attend, that will be the true, like, no going back moment. Right? And I do think that those use cases will become more and more prominent. I do think that people like us are trying to facilitate those use cases with the infrastructure that we're building, but it will be something that could happen in a year in the same way that it can happen in maybe like 2 or 3 years. I don't know. I don't know if this will be a February 2027 conversation or a February 29 conversation, but that will be, to me, the moment of not going back.
Awesome. Anything to add?
I definitely think it's basically all the people who are basically expressing their intent on like the ChatGPTs, Claudes, Perplexities of the world. So it's really easy to basically, you have all my information, and I just, I just click another button and basically execute that transaction. So I think you'll see that becoming a lot more mainstream, but it takes the merchant side being ready. And there's, certain regulatory, like data issues, all that. But I think it's going to be sorted out very quickly.
I think, I definitely agree with you.
Mike nailed it.
I talked about, like, no UI, AI do everything. We're probably just going to be interacting with AI soon, not the internet. But I guess what I'm curious would be, when AI does handle those payments, will they go through traditional rails or will they use blockchain? I think that's the question that us as an industry.
Folks up here are going to keep fighting that fight.
Well, we got to push. We got to push our industry towards that. And I think right now we're seeing our industry. We've lost the trust from the world. Right. The founder of OpenClaw has openly criticized our industry, and I think we partially have blames for that. Us as an industry, we've been distracted with short-term hypes and those stuff. So we need to regain back that trust. We need to make sure that we're a serious business and let on-chain payments be used for real serious stuff, and then hopefully it be used for agentic payments.
All right. Well, thanks everyone for listening, and thank you to our panelists, and thank you, Bass.
Thank you very much, Bobby.
Thank you, everyone.
All right, thank you. So next, since we did a swap, now he's finally here. We're gonna have Gordon Liao, Head of Research and Chief Economics, and Circle. So let's welcome Gordon to the stage.
Thanks so much for having me here. All right, sorry to be a little bit late, but hopefully I'll keep you entertained for this session. Let's see. All right, today I'm going to talk about quantum risk in blockchain and crypto. I was just off stage earlier and somebody asked, isn't this like at least 10 years away? What are we talking about it now? I'll try to convince you that this is actually existential risk for this industry, and we should all care about it, and it will actually directly impact our actions and choices today. So first, Q Day is coming. What is Q Day? Is when there is a cryptographically relevant quantum computer that could break the current elliptical curve encryption that is commonly used. So as you most likely know, that most of the blockchains today use elliptical curve type of signatures for signature verification. So think Bitcoin, Ethereum, and many other chains. And these sort of math is very simple for regular computers to basically push one-way functions through, but very hard to reverse in the other direction. Now, quantum computers would make the backdooring or reversal of elliptical curves relevant, and makes it much easier. So what does that mean? That it means basically all of the current blockchains are vulnerable as targets, and the funds on those chains could be lost. The timeline, best estimate puts it somewhere between 10 to 15 years. Some say it's actually 5 years away. Some say it's more than 15 years away. But on average, the best estimates are 10 to 15 years. Now, I will actually caveat, this is really unpredictable technology. given the speed of innovation, both on the hardware side as well as on the AI side, because AI is helping error correction in terms of qubits. And that helps with quantum processing to be much faster. So currently, quantum computers have a lot of, you need to both grow the physical qubits, but also the logical qubits. The logical qubits are what actually help to perform transactions or perform calculations. And the AI error correction is actually progressing really quickly in speeding up that process. Okay, yeah. So I would say that this is also essential for this industry because the biggest honeypot and the biggest bug bounty out there is Bitcoin that is under risk. This is a graph from Project 11, which is a company that or a lab that focus on quantum risk in blockchain. And they noted that around 7 million of Bitcoins, or 7 million Bitcoins are at risk of being attacked by quantum computers. And this is both due to very legacy type of addresses that is not quantum resistant, as well as a common theme of reusing your addresses. That is, as soon as you send and broadcast a transaction of sending from one address to another, you're effectively making the public key available and known to everyone else. Now, public key, under the current type of computing paradigm, you cannot back out the private key. But with quantum computing, you could actually back out the private key, and therefore, those tokens could be at risk. So this is, I think, the largest risk, from my perspective, is the largest risk to Bitcoin, to holding Bitcoin, and probably the largest risk for this industry. And it's really difficult for legacy chains, well, not legacy chains, but for these legacy addresses to migrate, because it requires the active user on the other side to sign, to update their address to a new address. That requires perhaps Satoshi to wake up and migrate all his Bitcoin holdings. So it's not an easy problem, which I'll touch on later. So not all quantum computers are cryptographically relevant, and there are different type of relevance. There is one type of relevance in terms of breaking an elliptical curve over a period of longer time, maybe weeks or months, and that affects the transaction signatures. But then there is also the short-lived signatures that's used for consensus. I think those are much less at risk because of the fact that they are very short-lived, and it still takes quite a bit of time, even with quantum computing, to break those. So against those, you have currently the worries about harvest now and decryption later, but that's applied more to current, I would say, traditional web than Web3 context. Transaction signature is the biggest worry here, in that someone with quantum computing can break into the current ECC signatures. Consensus, I don't think, is a current worry. But also on the horizon are a set of regulations, because regulators are seeing the rise of quantum computing, and they will enforce rules much quicker than the industry is necessarily predicting when quantum computing will be coming into scene. So the EU has regulation that basically says critical infrastructure has to be ready by 2030. The US has a similar regulation by 2035. All of those are pushing institutional capital to be extra cautious. Think about the core of financial finance, right? That's not going to be built on insecure infrastructure. So if if your chain is dependent on that growth into institutional capital, into enterprise use, it has to be resistant to quantum computing, even if that's not the clientele today. So I mentioned briefly there is a number of set of different signatures and different encryptions that are vulnerable. The good news is there are post-quantum secure alternatives. These alternatives, however, all have their own issues, and there's not a whole set of standards yet that's been developed. I think the vulnerability is actually much larger. When I initially looked into this, and my team informed me of this, it's much larger than what we realize. Some of the problematic areas, for instance, multi-sig BLS, which is for aggregation of consensus signatures for Ethereum, these are core part of the protocol, even if we upgrade the signature. ZK Snark, which has still to be yet adopted in a wide manner, is already subject to quantum risk. All the alternative is mainly hash-based or lattice-based signature schemes. The main downside to them are they're much larger because they're much more secure. It also means they're much more complex. So what does it mean? The challenge is, of course, running the math for these larger signatures would clog the network. So one potential solution, which we're currently looking at ARC, which is to develop precompiles for post-quantum signature verification. And that precompile will speed up the verification much faster. Another huge area of kind of exploration right now and research is how do you make sure that you still have backward compatibility, at least for the time being. You want to support the legacy EOA wallets, even though it's probably best practice to use account abstraction, which could be upgraded with the keys while keeping the same addresses. But EOA addresses are still the predominantly used and most likely used addresses. The migration is very challenging. For Bitcoin, somebody calculated it takes 75 days to just migrate all the Bitcoin holdings of currently vulnerable addresses to new addresses. Migrating cold wallet storage, any sort of hardware security module, those takes a lot of different type of coordination and new developments. So account abstraction I briefly mentioned is potentially a bridge, but that's still subject to adoption as well, and quite a bit of challenges with integration. And lastly, there is possibilities of recovering post-Q day. So Ethereum Foundation had mentioned they're exploring this as well. Basically, the seed phrases, if you remember, one thing is the seed phrases are quantum computing safe. So you can potentially prove that you own a private address or a public address through the seed phrases. But that also requires a whole setup and process for how do you actually recover. So last minute or so, I'll mention what we're doing at ARC. ARC is a layer 1 blockchain that Circle is building that's really trying to upgrade to an institutional business level, delivering what enterprises need. So along with quantum readiness, we're also providing stablecoin as gas, cross-chain interop, deterministic finality as sub 1 second, as well as opt-in privacy. And by the way, our privacy features will come out to be end-to-end encrypted, quantum ready from day one. So I'll skip this slide. It's basically well integrated with the Circle ecosystem. And we have a number of companies that's participating and testing our platform. So lastly, I'll leave with this, that building a post-quantum ready blockchain has many parts to it. And we should all think about the relevance of this for the whole industry and for your team. Thanks so much.
Thank you, Gordon. So next we'll have another panel. And we're going to have Ben Fielding, co-founder and CEO of Jensen, Mark Fiedelman, Chief Marketing Officer at Exhibit, and actually Bailey is actually having some flight issue, like a lot of the guest speakers. So we're going to have a Shay Beckus, head of growth at Prismax. And the moderator is going to be Jonathan King, investor at Coinbase Ventures. So let's welcome them to the stage.
All right, awesome. GM, everyone. Thank you for sticking around for this panel. It's a subject that's near and dear to my heart. Again, Jonathan King, most of you might know me as JK, lead the investments group at Coinbase Ventures. I guess to kick things off, if I think back to, 2023, after we saw ChatGPT launched and, hit fastest growing app, 100 million users. There was this open, question in our community about, do we really want AI, these powerful, kind of emerging tech, to be concentrated in the hands of just a few hyperscalers, right, and frontier labs? And so the answer to that was actually several teams, taking on very tough challenges and saying, hey, how can we actually do it differently? Like, how can we coordinate resources? How can we be more open in terms of how we approach and providing access to those resources? And so I'm really excited, because this whole meta around decentralized AI really started with the founders and teams that are on this stage, right? And kind of building, but we want to understand, how are things going? Since you kind of started on this very challenging journey, what's real versus what's hype, and just have a general check-in. And so, Ben, would like to start with you. Obviously, Jensen, perhaps well known for building out decentralized training and inference infrastructure. But maybe if you can tell the audience, what do you do? Who are the core customers, and how are things trending today?
Sure, thank you. So Jensen, the one-liner we use is the network for machine intelligence. Essentially, we think about the core resources underneath machine learning, AI, etc., and how those resources are constrained in the centralized world. Most people will have heard us talk about compute, because that's the biggest thing that we focused on predominantly. But our view of compute is maybe slightly different from other people's. We view it as this resource that in the kind of traditional world has been accessed in this very kind of human-centric way. I have to go and book time on a GPU, or before kind of cloud, I had to go and buy GPUs or buy CPUs and put them in a data center somewhere. Our view is that kind of through time that has got more and more abstracted. So we moved from those data centers to the cloud, and then we moved from cloud to serverless. And at each stage, the actual tech itself took more and more of the task of coordinating the compute away from the human. The developer in a serverless world does not need to think about being a sysadmin. They just push their code, and it gets deployed out automatically over the system. And so when we think about compute as a specific resource underneath machine learning, we think that abstraction is going to continue. But for it to continue, we still need to solve those human world problems. And so the biggest human world problem underneath it is trust, in our view. There is hardware all over the world, but in order to access that hardware, you have to establish trust with the owner of the hardware somehow. And so what Jensen has done predominantly for the past few years is build tools to change that trusted relationship to be entirely programmatic. It's not using legal contracts or human relationships or anything like that anymore. It's entirely done through code. And so that's now where we stand. We enable trusted access to compute and other resources. We won't touch on them as much here, but data and information are important as well. But predominantly, that's what we build. And what you can see from us now is over the testnet that we ran for the past 12 months, you've seen applications like RL Swarm, Block Assist, etc., showing what you can do once you establish that trust over the compute. And more kind of in the future, as you see in April from us as we launch our mainnet, you'll see the ability to launch completely decentralized prediction markets, which behind the scenes actually relies on trusted compute, because they're all settled by machine learning models who can be trusted judges in these scenarios. So we're kind of exploring the different use cases you can achieve once you have trusted access to compute, but underneath all of it, compute is the big unlock.
Cool. Thanks, Ben. Mark, obviously compute, big theme, right? Obviously Exhibit's one of the early pioneers in that space. Maybe tell the audience, what do you do today? Who's your core customer, and how are things going?
Yeah, our core customer are AI enterprise or enterprises using AI, startups, developers. Our big thing is optimize that 5-layer stack of compute. And in order to get it to our customers, we just believe that the more you optimize it and provide more efficient power, the more we're going to need, or the less that you're going to need in terms of cost to power whatever AI solution that you're going after. So for us, robots are a big thing, right? We're still 3 years before robots really start to take over. If you ask Elon Musk, they're going to take over in the next couple of years. We don't actually believe that, or at least I don't. But the infrastructure needs to be in place, needs to be much more efficient. If you look at the power requirements alone for what they're talking about, you're going to know that we don't have it, not even close. And that's why companies like Google and Microsoft are now going back to nuclear power, and some places like Tennessee are allowing them. So think of the stack of, we look at it as 5 layers. We're taking on 3 or 4 of those layers and making them much more efficient and optimize them for the future.
Got it. And then Shay, since Mark mentioned it, robotics, right? And so I really feel like, robotics is happening a lot faster than a lot of us, have assumed. I'm pretty sure everyone saw like the Neo robot that was launched, but it struggled to open the dishwasher, right? And so, maybe tell a little bit about like how PrismaX is playing into the robotics equation. What are you all doing? Who's your core customer?
Thank you. PrismaX is a service layer, and we have a couple different groups that we work with. So we think of it as a flywheel. There's robots, data, and then intelligence, and a couple different groups that play into that. So obviously you have robots, like you said, Neo. From 1X, you have videos of Atlas doing flips at CES, and these robots are functioning and coming to life because they have the AI model training. So what improves those and gets them better is having better data. In order to get better data, we're really focused on teleoperation, which is where everyday people, our community, our users come in. They can go onto our platform, kind of like playing a video game. All you really need is Wi-Fi and a computer. And you click a few keys, you play with the robot. We have really robust setups, real time, get real data. And then we give that data to AI model companies. So companies that are working on improving these models, feed them back into the actual physical robots, and it's how it all improves and hopefully gets us closer to autonomy. We always think humans will be a part of it. We don't think robots will ever be fully autonomous. Likely that last 10%, a lot of times you'll hear that there could be use cases that are up to 90% accurate, but you still do need that 10%, especially when they're in factories or doing things with heavy labor. It's really important that they are completely accurate. So keeping humans in the loop, but having them now teleoperate and be able to build their skills and get better, and then eventually sell that labor and have value in how good they are at their tasks is what we're focused on and building towards.
Cool. Ben, I want to go back to you because you kind of mentioned a couple of things that were really key around like the evolution of Jensen. I think very early on, there was such a core focus around training and how do you decentralize like training of these large models. And I feel like weeks on in, yourself and maybe some of the other players were like, oh, we've trained this many big param models. So maybe talk a little bit more about how your journey has evolved, right? And like some of the key issues that Jensen is now solving for.
Sure, yeah. So we very much believe in decentralized training. Like in the future, essentially when you kind of boil things all the way down, what are we doing with machine learning? We're compressing raw data using compute and injecting a level of information. And we use information quite a lot, but it's a hard to kind of understand concept. Basically, it's just this idea that if you take some piece of raw data like an image and you use some kind of intelligence to detect patterns in that image, to add labels to that image or something like that, you're adding information to that image. And so you need like an intelligence to add that information. But once you've done that, that's really valuable and you can use it to bootstrap other intelligences, which is predominantly what machine learning training is, right? And teleoperation is a good example of that. Teleoperation is typically done for behavior cloning. So you get a human to teleoperate a robot. You can then use the data that comes from that, the state and the actions from the human as a way of bootstrapping the training of a model, which will then do those same things. Where if you tried to do it from scratch in a zero-shot way, it would flail around forever before it actually figured out how to do the dishwasher. Like it needs some kind of instruction. And so when you think about machine learning in that way, actually, you can do that at like any level of the stack, as long as you have the information, the data, and the compute. And so the concept of a model in the kind of the typical like world that we mostly see it, like ChatGPT and Anthropic, etc. These are these huge like world models that are trained very specifically to capture as much information as possible. But that's not the only way to do machine learning. If you look at those like base principles of just incorporating information and data together into a new representation, you can do that anywhere. And so what we demonstrated with RL Swarm, which is where we trained millions of models all across the world, was this idea that actually you could have tons of decentralized models all bootstrapping off each other. It's a little bit like behavior cloning off each other, but actually it's taking advantage of that like massive scale search that you're able to do only via decentralized networks. Like you wouldn't be able to get the scale that we could get on a centralized network, but you share that information around. The thing is, it doesn't look like GPT 5.2 or something like that. It looks like a totally different style of model, and it has slightly different use cases. And I think basically what the sort of world realized was we used to say that message a lot, but I think people still thought, oh, in the decentralized world, we'll just build a competitor to like OpenAI's models, and then it'll just like swap in for their models. That's not the case. It's never been the case. It's going to be different styles of models and different use cases that we use these models for. But ultimately, yeah, we demonstrated those kind of millions of models training, the sovereignty to those models. They kind of combine to be much more effective at some tasks than the centralized models, but you don't just swap it in. And I think that's what kind of the crypto world realized when they heard all the promises about decentralized AI, and then in 6 months we didn't deliver an OpenAI competitor.
Yeah. Mark, earlier you were talking about that, you know, currently your customer base, like AI startups, some, perhaps like some of the larger labs as well, they want access to compute, fundamental resource. Maybe elaborate a little bit more on like, what is the value prop, right? When you're selling into these companies, like why are they choosing to go with exhibits? Is it because of cost reduction? Is it due to availability? Are they optimizing for geographic distribution? Like what exactly is like the driving factor behind why you should, you know, opt into a decentralized compute stack?
Well, you said 2 out of the 3 already. I'd say number 1 is the service. You don't get great service from the big providers like Amazon, Microsoft, Google. Good luck, especially if you're a smaller organization, mid-sized organization. So it's very, very hands-on for us, and so that's one. Cost is obviously huge consideration, and we're distributed around the world. But I think, you know, our biggest value proposition is think of us as an orchestra, and we provide you the tools to be the conductor of this orchestra from around the world. And I liken it to, it is centralized, but also distributed data centers around the world that you can control, kind of like what Amazon does with their warehouses around the world. That's what we're doing with compute.
And I guess like maybe a follow-up question. I know like in the early days of like, you know, decentralized computing, there was always a question around, you know, developer experience, right? And, you know, for a long time, the hyperscalers were certainly in the lead. How do you think like DevX on top of like these decentralized compute stacks has improved over time?
Well, I think it's the tools that we've given them. I'm just speaking from our point of view. I'd say the tools that we're giving them make it so much more efficient and effective. And when you add that AI layer, which we're building currently, I mean, I wonder if we're going to need many developers in the future. And I'm not making any predictions. If you're, don't hold me to that. No. Just see where everything is going, and you could probably guess as to what's going to happen.
Got it. Obviously, Prismax, you're not providing compute, but you are, you know, attempting to build out a stack to make training data readily available to robotics companies, et cetera. Maybe talk a little bit more about, you know, what do you see? What are you seeing? Where are you seeing the demand? Who are some of like the top customers in the space today? And why are they optimizing for this stack versus the way it's been done to date?
For the demand, a lot of it's coming. There's a couple different types of companies. So there's some super early stage startups and then some very well-funded startups. And then you also have some like internal startups at bigger public tech companies. And a lot of them can be kind of considered like research institutions that are commercially or venture funding. There is a lot of funding, they're not grant funded. But these companies, they do need data. It's obviously there's synthetic and simulation data, but in order to improve to a certain level where they can be deployed, and like you've mentioned, at people's homes and all different settings, there's a different robustness that's needed. So in what we're doing by decentralizing it is, first of all, we can get much more diverse data and can scale horizontally, which is really important. A lot of edge case data we need, so different operators with different setups, different physical environments, and then that's super helpful for getting different domain task execution that they need. So that's one aspect of it. And then I'd say the other aspect that we're focused a lot on is just setting the standard. Right now there's not really any standard for the type of data you need for different use cases, different form factors. So helping companies, whether if you have a robot and you want it to be better trained, we can tell you, okay, this is the type of setup you need, this is the type of operator and what they should be doing, this is the data that's going to help it. Or from an operator standpoint, you want to operate, you want to eventually be able to monetize your labor. You can get started, start building your skills, learn the best way to do it, and then figure out where that can be monetized in the future and become part of this owner-operator model that we're working towards.
Got it. And Shay, I'd like to stick with you on, going, because you mentioned a couple of key points. As one, like decentralization of data, right? And so for each of you, decentralization probably means something different across data, compute, and training. So in the Prisma X case, like, how do you all think about decentralization? Do your customers care about decentralization? Like, what is that like message, that communication relates to decentralization, blockchain, et cetera, and what that means for how you're building the product?
I'd say for customers, we're not necessarily selling the underlying technology, so we don't talk a ton about the blockchain or the crypto aspect of it, but they do care about decentralization because there's an understanding that the more decentralized it is, the more data and more diversity they're gonna get. And in order to reach a certain level of intelligence for physical AI, we do need that. So that's, I'd say, where they care about it the most, but not as much from like a technical standpoint, just what it enables.
Got it. Mark, is it decentralized compute? Is it distributed compute? Like, what's the nomenclature here and why?
Well, for us, it's distributed. Decentralized is so inefficient. And you don't have a lot of control over it if you don't own the wherever the compute's coming from or the chips where it's coming from. For us, it's distributed because we want to be able to provide low latency around the world. So we partner or own AI data centers around the world to make sure that it's centrally controlled so that our customers are getting the most optimal, fastest, and least expensive compute on the market.
And then Ben, same for you. I mean, is it distributed coordination, decentralized coordination? How do you think about it? And especially, and maybe talk a little bit more about the test net, right? Is it permissionless? What are you seeing? Can people verify that these training jobs are being done correctly? Maybe talk a little bit more about that.
Sure, yeah. For us, it is decentralized. There's progressive decentralization where you have some kind of version of like control in the early days, but there's always a path to decentralization. And the reason that it's decentralization for us is scale. Like kind of Mark mentioned, like you get this by decentralizing, you get access to a level of scale that you cannot possibly get in a centralized world, but it comes at a cost. And so you only really pay that cost in places where it makes sense to pay it. For us, it's kind of hooked into open source, it's hooked into sovereignty as well, this idea that you can execute theoretically anywhere. There exist resources in kind of pockets together, and so it's quite hard to separate out the idea of like compute and data and information, because in reality, if you go all the way out to the edge, that is where all of those things originate. You've got the sensors, you've got the kind of ability to execute there, and you've got typically a human there as well, injecting some kind of information into this system. And so the current way of training AI involves shipping all of those things into one place and then training a model there. And that is efficient once you've like kind of swallowed the cost of actually gathering all of that stuff together and shipped it into one place. And centralized companies have done a lot of that work. Our view is a lot longer term. It's this idea that actually, in order to scale beyond that stage, you have to go out to the edge. And so it will become a necessity. But it does mean that kind of in the shorter term, you don't have this immediate use case where you're going to go and sell to a centralized AI lab. They won't use what we build, not for a very long time, not until it becomes beneficial for them to be part of this network, because it's the only way to get access to the extra compute or the extra data or the extra information or something like that. It does mean it's harder for us to get started. Like, who are the customers? And when we're like, well, actually, they don't exist yet, or they're agents themselves or something like that. It's a very like abstract concept. And so that brings it down. You mentioned the testnet, like we had the applications on the testnet, but for the mainnet, we have a really kind of clear application, which is information markets, prediction markets, but this idea that actually what's underneath in prediction markets is trading information. And what does a machine learning model do? Actually, it just generates information. And so it's kind of first party thing. If it's ever to trade, if it's ever to give something back, it gives back information. Right now, they're at our beck and call. We just use them through products that centralized companies ship. But actually, those models themselves could trade that information directly if they had access to permissionless markets. And so you can construct that using the same tools you construct to train the models themselves. Again, it gets kind of abstract, but the long-term goal is, look, these models can trade information. They can also trade compute. They can also trade data. Long-term, you get the ability to build something far bigger than you could possibly build in a centralized world. But it does mean I can't sit up here and say, oh, hey, we've got like X amount of revenue with some like centralized AI company, because we're not selling them anything realistically. We're building something that is larger than they can possibly be, and one day they can be part of. But right now it's kind of in its infancy, if that makes sense.
Yeah, I guess I want to double click into that last point, right? As you talked about the centralized AI companies, in a world that, decentralized AI companies say they wanted to lower their cost structure dramatically, what do you see then as like still the competitive advantage for decentralized training your model? And same question I want to ask you, Mark, but I want to start with you, Ben.
I mean, it's always scale for us. Like, it's getting that, it's achieving the kind of level of scale that you couldn't possibly achieve. So ultimately, once you kind of get through the low-hanging fruit of improvements that you can make to the training of a centralized model, and just like, can I brute force gather more data? Like, can I use scale AI to just like get as much data as possible in my model? Another company can't do that, therefore mine is going to be better. Like, that saturates at a certain point. And at that point, you're actually in the long tail of like new data, new information that exists in the world, rather than kind of looking back and just trying to get as much of it as possible. When you're looking forward, then you have to think about how you access that. And at that point, you may be able to just grab it from consumers, but I don't know, the winds are shifting. Like, you may actually not be able to just grab it from consumers. You may actually need them to opt into some kind of system and be part of that system. And so in that case, then you're going to have to go out to the edge. And I think we see this in the execution itself within machine learning models. Like, the compute that we're using to train those models is constantly improving. The compute is moving closer to the edge, because for inference, we need it at the edge anyway. So from the user's perspective, for inference, latency has to come way down. Otherwise, it's not compelling. As latency comes down, it becomes more beneficial to actually train on the device, because you need the device to be powerful for inference. At that point, I think things suddenly flip, where you say, okay, I've got data originating on this device that this user has, I have a relationship with the user, and hey, actually, the user's able to execute some pretty big computations. Should I take that data, pull it back to my data center, train it into a model, and then ship the model back to them? Or should I just update their model on the fly? I should probably just update it on the fly. But if I'm doing that, I need a whole new set of infrastructure to do it. And I think most of those centralized companies, they're just not building that infrastructure, because they're focused on winning the race of who has the best massive model. They're not focused on that longer term, what actually changes in the world of computing. The pattern I would match it to is like servers and home PCs. Like, there was this big kind of wave when we had huge servers, and then this idea that you maybe would have a dumb terminal at home, but you'd be accessing the kind of big compute power in the data center. But that's not actually what played out. What played out was we brought power to the home device, and we started building applications for the home device. You used Microsoft Word on your device. It wasn't a dumb terminal to an instance of Word running on a server. I think the same thing happens here. As the power of the devices increases and the value of the data and the information on those devices increases, it just doesn't make sense to send it to data centers anymore. Great.
And I guess like one last question as we're starting to wrap up for each of you is just, fast forward a year, 2 from now, what would you have accomplished that just proves that your model right around decentralizing your stack actually works? And if you also want to sprinkle in any major announcements, feel free to do so. Go ahead, Shake.
We have proved that the model works. We do have a ton of demand, and we are generating real data. So the flywheel that I've talked about is in play. But I'd say a year from now, the long-term vision and what we're working towards is that anyone that has a robot can be an owner, and anyone that wants to can be an operator. So everyone can be part of it, and everyone can be part of this marketplace, monetizing their work. So I think that's something we're working towards.
Mark?
So for us, we are announcing that we're going public on NASDAQ. So if you want to invest in what we're doing, it should be available in the next 3 to 6 months. You never know with the SEC. So that's exciting news for us. So it better have been done in a year, if that's what you're asking me. So on our front, you guys all know that AI agents, robotics, it's going to be a brave new world in the next 3 years. So in a year, I would expect us to have even more infrastructure, what we call these modular data centers, not just the big ones. The new thing is new, smaller modular data centers that you could put even in buildings. So that's where we're heading towards. We've built a few. We're going to build a lot more. Ben?
Yeah, for us, I hinted at it before, but our mainnet in April is the big announcement from us. And I think the way that, towards the vision that I described here around the scale of machine learning, the way that we'll see that that's been successful is having probably in like 6 months, true two-way information markets. So prediction markets exist right now. You can go and use them. You can go and participate in them. You can't create them. With Jensen, you will be able to create them because of the AI settlement layer that we have. But the most interesting thing will be when you have machine learning models or agents interacting with these markets, both selling information into them, so monetizing the information that they generate, but also using information from other models in those markets to train themselves to get better. And at that point, you have a form of like, it's a bit like nuclear fusion. It's this like runaway reaction where every model is able to put information back into this system in order to achieve real economic value, but it makes itself better by taking information from that system, and the thing becomes a huge kind of global optimization system for machine learning. So I would like to see that true two-way relationship happening. We're shipping the first one, which is the markets, but we need other people to kind of implement that training piece on top of our tech, or the models themselves do it, and the agents just run off and kind of train themselves on their own kind of whims. But yeah, two-way information markets would be the big thing for us.
Awesome. Well, everyone, that's all of the time we had. Thank you so much. Thank you to our panelists, and enjoy the rest of BAS.
Thank you.
All right. Thank you. So next, actually, we're going to have a fireside chat. We're going to have Jake Salerno, VP of JTM at Zero-G Foundation, and Harrison Dunn, CTO and partner at Hack VC. So now, let's welcome them to the stage.
Yeah, we can sit in the middle, both sides. Okay, yeah. All right. Cool. That's cool. Hey, everyone.
Test.
There we go.
I feel so distant from you now.
Well, we could sit in the middle.
No, that's fine. You look good over there.
Cool. Hey, everyone. And on the stream, there we go. I'm not a streamer. That's enough for introductions. Yeah, so maybe just to like kind of set the context and so forth, maybe you could tell us a little bit about like who you are, what you do, what Zero-G does, where in the stack you play, and then I've got a whole bunch of other prepared questions. But yeah, I guess like you call yourself a decentralized operating or a decentralized AI operating system. What does that mean?
Well, I appreciate the tee up, Harrison, and thanks for all to being here at the BAS Summit. We've partnered with Stanford for multiple accelerators coming out of this summit here. We're going to have a new experience to allow, of course, a lot of resourcing to go into the education and building on the decentralized AI OS that I'll talk about in a second. And of course, we're joined here with Harrison at Hack VC, who was a lead investor of ours at Zero Gravity and has, of course, been a very great partner strategically in the space going to market. And to answer your question directly, our co-founder, Michael Heinrich, and our CTO, Ming Wu, started with a problem statement over 2 years ago. And that was, how could we make AI a public good, and how could we kind of incentivize alignment of AI now that it's becoming such a mainstream integration for all tool sets, all applications, and just life in general. It's currently, and probably to no surprise, controlled by a very concentrated few, the hyperscalers that we use on a daily basis. And similarly to the reason why I got involved into this space about a decade ago, I wanted to have that David and Goliath moment with finance. And I was part of the Wall Street bets, and Citadel closed up the trading house, and of course we're left holding the bag, and we realized that the big money typically tends to control the show. No matter kind of how you want to interact with the platform, there's always going to be that centralized control that potentially or favorably will get their way. And with AI becoming so prominent in life, that was a bet we were willing to take. And you see how much it's grown, how much it controls the way that the world operates. So we want to have, of course, alternatives, similar to how DeFi and TradFi came to be and now have intersected. We want to have that same alternative for AI, a decentralized option with provenance, verifiability, aligned incentives. And that's the infrastructure that we set out to build. And through that problem statement, we landed on an operating system that comprised of 4 modular key components. A layer 1 AI purpose-built blockchain with 11K TPS, aiming for 100K TPS. Through research, we're getting close. We've made a lot of refinements, and that's in the near-term horizon. That's the settlement layer. That's the economic proof of stake, alignment and coordination where value can be transferred. Not reinventing the wheel, rather building with new scalable solutions to make blockchain settlement layers more efficient. Then you have a decentralized storage solution that in itself, of course, has existed in the space today, but we were able to coordinate resources where even the monthly cost per terabyte was under $10. If you were to look at, let's say, Amazon S3, and you know they're partners of ours, but their pricing is around 80% more than that because they've got great margins on those solutions. But we were able to coordinate decentralized resources in order to utilize underutilized storage devices. And of course, we're left with that number. And it's a great benefit to bring a lot of data on chain for AI use cases. Next, you've got data availability that proves data is available. It's something that goes down into the depths of databases and fetches either long-term data or short-term data and brings it to the surface for use cases. And that was, of course, a very complementary solution to storage, data availability and storage. Lastly, we've got compute. And as you guys probably have used today, many different compute needs are top of mind for many, but we've got a compute network, and we're not a compute or a GPU provider ourselves like many of our partners, rather a coordination layer. We bring on many GPU resources, DPIN providers. All of those networks are going to be able to service the AI use cases that demand compute local to 0G. Through those 4, I call them meat and potatoes of infrastructure, we're allowing AI to exist fully on chain. And then we're seeing a lot of really innovative startups come and be connective tissue for the UI and UX of ways those go to market. We have a very large infrastructure initiative and team. We also similarly are very focused on the product now, making it low code, super simple, non-technical, the same way that you'd agentic code, vibe code, use Google console to build certain applications. Same UI, just more trust, more provenance, more verifiability, and we think it's a great alternative that's allowed people to build cool things today.
Cool. And I guess so the platform's been live for a little bit, you're growing it and so forth. Where have you seen the major workloads come from in the stack? Is it more sort of like fine tuning? Is it more in context learning, serving inference, hosted agents?
So we had an offsite recently, and of course this was an overarching question for quite some time as we went to market. For context and reference, we launched the mainnet version of our protocol in September at KBW, and that coincided with a token generation event being listed and making that vehicle a public instrument to secure, of course, all the solutions, the proof of stake network, and that was very successful, which garnered a lot of attention. And we had our core ICP, which is defined as a value-securing Web3 builder that wants to use AI. We're seeing a lot of that in the DeFi markets now, where if you are value-securing with your use case, you're giving up autonomy to certain agentic frameworks or workflows for people to trade or secure value or use it for yield. That's a very high-intensive and secure use case that would require verifiability, trust execution environments, and of course, the transparency that decentralized AI brings. I'll be honest, in this room, are we competing directly with AWS with latency and speed? Well, no. Of course, they're going to be a little bit quicker for non-value securing use cases, but those are the trade-offs. The x-axis typically has speed, the y has security. That's a trade-off that you typically see in the space. We're not talking about much more than a blink of an eye in terms of latency, but of course, there are use cases that require more security, and people's understanding of the ways that security is formulated through distributed and decentralized systems will not compete with, let's just say, a black box centralized solution that, before you know it, has computed. It's just going to be a little bit more secure and maybe take one more second. So that's the trade-off, but our ICP right now is Web3 builders, and we're interviewing many different enterprises and launching into proof of concepts, not to rip and replace centralized compute, rather be additive and allow them to have new experiences that otherwise would not be secured by the hyperscalers, such as fully self-sovereign AI that they own with data that's very hypersensitive to them. So it's complementary rather than competitive.
Fair enough. Very cool. Maybe just double clicking on sort of the trustless nature, or I guess trusted nature of the platform. What unique use cases have you seen like been deployed over top of 0G versus like, I don't know, everything from like DigitalOcean, like droplets through like, you know, GCP pods and so forth?
Yeah, I'm sure that we've all heard of the, you know, OpenClaw and a lot of the cool hype metas that have come out recently, where agents have blown up with some of the new models that came out, the SOTA models on February 5th. Regardless of all of those, let's say, agent-to-agent use cases, one thing has been very attractive to many of the B2B or B2C partnerships that we have, and that's a new ERC standard called ERC 7857, in parentheses, INFT, because we all love to say as many numbers as possible, right? So INFTs, it's a way for you to create an agent and encrypt it and own it with verifiability as to how it's built, with encrypted metadata for how it's trained and fine-tuned. So you can take a model today, let's just say it's a basic open source model, take it off the grid, and I'm going to use analogies here, fine-tune it with all of your personal, private, proprietary data that you want, train it for certain use cases, encrypt everything. You encrypt the brain, so all the metadata is only accessible to you. It's tokenized as an agent, so you own it like an NFT. You can deploy it on the servers and all the different kind of environments that we have on 0G and use it for the betterment of the use case. That's great. But you can also then monetize that agent. Let's say it's a trading bot that is outperforming the market. It is just winning, 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 and no one knows how. Well, maybe it's from that data that you put in from 10 or 15 years of experience looking between the lines. Well, I'm sure people would pay to use that. So it's actually allowing to monetize AI on your own personal level, and then it allows you to build AI knowing that this isn't just going to end up in a public GitHub repository that's forkable with no attestation to me, fully encrypted, self-sovereign, ERC 7857 intelligent NFTs, useful for B2B, useful for B2C, and I'd say that's probably one of the leading factors of what people are excited about.
Cool. I mean, in practice, like what sort of new use cases have you seen come up that are just like truly, because you know inevitably there's latency issues. It's not big. It's not a big one, but yeah. There's new development experience patterns, right? There's always eating glass when you're deploying like I don't know like code on like a new framework, right? So like what are the like the penultimate use cases that like people have found that they're like, oh snap, I need to deploy on 0G and it's worth eating the glass?
So, of course, there's a lot of phenomenal startups in the space that have aimed to achieve one vertical value proposition, right? And we partner with many. It could be a DeepIn network. It could be a layer 1 or a layer 2 that has bolted on a lot of AI use cases that now matter to them. It could be storage. It could be people that now are very focused on storing structured or unstructured data for AI model training, to democratize access to new data for model training, etc. We were purpose-built from scratch to achieve the 4 core solutions that we believe matter to bringing AI on-chain and in an environment that is self-sovereign and providence-inducing for the masses. So you take those 4 core solutions, and we've actually pivoted a few different times, where when we first came to market, we had a consensus layer, but we never really wanted to like make it super retail, make it like a big ecosystem. You have to have a consensus layer for a lot of these modular solutions. So we had the layer 1 blockchain, But we actually went and raised money for our pre-seed round, and you'd probably remember this because they were our lead investor. We were a DA layer that was able to do 50,000 times the throughput of the next person with a built-in storage layer that was way more competitively priced than anything else that exists. And that was amazing. But we realized that we wanted to build an ecosystem to empower the rest of people to deploy on 0G and to build startups on 0G versus just being an infrastructure. We wanted to be an ecosystem with infrastructure for killer apps to build on top of us. Because when they succeed, we succeed. And you can see that the killer app these days is actually where the revenue is generated. Polymarket crushes. I don't think Polygon is seeing a lot of that. So it's like you want to make sure that you've got infrastructure that, of course, can be monetized, and there's a clear revenue stream for anything that's related to the modular stack. Happy to talk through the specifics of how I came up with the revenue structure, but the killer apps that are being built on us are our lifeblood. And so we pivoted into the layer one ecosystem narrative, really championed that well ahead of our TGE and mainnet. And of course, since that launched, and I was in charge of lining up hundreds and hundreds of infrastructure supply partners to launch a behemoth of a layer one, you'd be surprised how many partners you need to have online on your chain to launch a layer one protocol for the demand side and dApps to be able to build. I mean, we're talking hundreds, RPCs, oracles, indexers, cross-chain, intents. You know, just I'll spare you the pain, but once we got supply side covered, demand side was flicked on. We're now on the demand scaling side, and we've also built some really cool products that allow you to deploy on 0G with agentic coding experiences. You don't need to be technical to build on 0G anymore. I had a panel yesterday where I had the whole audience raise their hand if they had a technical background. Half the hands went up. And I go, well, welcome to being technical, everyone, because you can literally just text a prompt on 0G what you want to build. It'll deploy a dApp. It'll use storage. It'll use compute. It'll use DA. If you don't want to use 0G modular solutions and you want to defer to like Amazon or a centralized solution for latency use cases, by all means, they're partners of ours. But we offer alternatives that have trusted execution environments, ZK, privacy-inducing features, data encryption. So if those use cases and those integrations matter for your go-to-market strategy, we can solve that.
Cool. I've got like one sort of like more mechanical question, and then sort of like looking forward, future thinking, or maybe, I don't know, like a little bit of a retrospective. I don't know, take it how you want. But yeah, I mean, how do you sort of, so, you know, like T's, they're great. There's also, you know, like trust authority, right? Sort of like hiding behind like the open router situation. I mean, there's a lot of different ways to deploy trusted agents. And I guess like, how do you sort of see, there's like agent payment rails. There's like many of them at this conference, right? How do you sort of see like your positioning versus like the whole rack of like, you know, like even like GCP Vertex, for example, which, you know, like unlimited model sizing all the way through to like Fala, right? Which is like similar, but like trusted and private.
So I've actually tried to eliminate the word trust in our go-to-market strategy.
Okay.
I spent, you know, prior to joining 0G 2 years ago, I spent about 3.5 years at Chainlink Labs. And our co-founder and CEO, Sergey Nazarov, basically coined the truth over trust approach to go-to-market. Why instill trust in the space when you can have math and science, smart contracts, ensuring that data integrity is there, and it's literally just truth. It's transparent. Things, you know, X happens, Y occurs in a smart contract. It's just truth. It's math. It's science. What if we brought that same approach to AI, where it's not trusting AI, it's proving AI through different systems that we've created? So I like to double down on verifiability, right? And to directly kind of address what you're alluding to, right? The proof's in the pudding. There's a lot of different trust assumptions that we're making building with SOTA models today that are complete black boxes. I mean, when I vibe coded a presentation 2 days ago, and this was not on my work laptop, but on an isolated environment that I use for these type of exercises, I had to grant it access to like 15 different aspects of my OS. I mean, it was like GitHub, all these profiles, like my terminal, like it had basically full control. Of course, that was convenient for me because it could execute everything I wanted to right then and there, but I mean, my goodness, that is a huge trust assumption that we're making. And so we want to make sure that builders have the, one, education and awareness about how many trust assumptions we're making building today. Two, cost-effective and relevant solutions to them, where you're not sacrificing all this money or all this time to be able to build in verified manner, right? It should be the same kind of UI and UX. Of course, there's going to be bonuses and add-ons. If you want another layer of security or redundancy, that's something you can, of course, elect to add on. But right now, in our agentic coding world, that doesn't exist. It's just a black box. You're paying however much a month, and well, there's no real way to audit it. And then when someone asks me how I do it, well, I'm kind of left guessing unless I'm going line by line. So anyways, we think that's going to bring AI evolution to a different level. I heard an interesting stat last year, and this might be a little off topic, but ETH Denver 2025, someone was saying that only 1% of the data that exists in the world was contributing to the AI models and training. It's crazy. There's like 99% of the data that's private to us. And imagine how more effective we could have AI be if we were incentivized to contribute that. And there was attestation to where that data came from. So if you're the person that provided that data that made it that much better, of course, there's some reputation associated with that. And you get paid too. It's not just us training these models by using search engines for the last 25 years and them saying, well, we're going to take all that data, fine tune it, and now charge you $20 or $200 a month to use it.
Cool, and I think with that, we are out of time, right? Okay, cool.
Well, thank you all for your time. Enjoy the rest of the Bass Summit. See you around this week.
Awesome. Thank you, Harrison. Thank you, Jake. So next, we're going to have another panel, and we're actually going to have Don Johnson to take the first few questions from Virtual Protocol, and Celeste will be joining us a little bit later, just a flight delay. And then we'll have a K-Cock, founder CEO of Nectar. And then the moderator is Carl Vogel, general partner at Six Man Ventures.
How's everyone doing? Congratulations to you all for still being here at 5 o'clock instead of out drinking and doing other things. Because of that and your loyalty to this panel, I'm going to try to make this as entertaining as possible. This panel is titled Crypto Agents Aren't Dead. And I think by the end of the next 23 minutes, our goal is to prove to you that they aren't, in fact, dead. But I think that's still a little bit of an open question as we look at what's going on in the world today. So it has never been more exciting time to talk about agents. We have OpenClaw, which is the fastest project to reach 100,000 GitHub stars in the period of 3 weeks. And it has completely consumed the, crypto Twitter and sort of Silicon Valley more broadly. We have Claude Code that has now really started to reach prime time, where now it's truly enabling anyone to be a developer. There's other agent frameworks like LangChain that have raised hundreds of millions of dollars, more for like an institutional type lens. And all of this in the context of there's other crypto agent platforms like Virtuals, like Nectar out there. And what we want to talk about today is like, what's the unique insight that you guys are bringing and your projects are bringing such that crypto and crypto-based projects can compete and if, in some ways even be better than the centralized ones that are being built today. So incredibly excited. Let's just start off with quick introductions. I'd love for you to share a little bit about yourself. Again, keep it short. We only have 23 minutes. But a little bit about your project and maybe what is one or two unique insights that is driving your product roadmap and customer acquisition.
Yeah, I guess I can go first. So I'm Kekak, co-founder at Nectar. We basically build out companion role-play agents. So basically anything that has to do with AI-based entertainment is something that we kind of like focus on. A little bit about myself, graduated from Stanford, worked as a research and backend engineer at some large software companies, then helped run a fund leading AI and crypto, and then started Nectar. And a little bit of insight into kind of like what we do, why crypto is important is because we enable all of these companion-based agents to actually transact on your behalf. And while MCP support for payments has gotten pretty good, we were one of the early ones that kind of allow these agents to transact on your behalf. via just like understanding who you are based off of your conversations that you kind of have on our platform to autonomously suggest or purchase things for you. So, yeah.
Cool. My name's Don Johnson. I'm part of the founding team at Virtuals Protocol. We're definitely sort of in this aha moment right now for us. We're sort of most known for our launchpad for tokenized AI agents. We're expanding rapidly into robotics now, and something that's also come to fruition a lot in the last couple of weeks, which I'm sure we'll talk a lot about, is our agent commerce protocol, which is all of the agents working together autonomously now.
Terrific. Well, let's jump in. So I think Virtuals really led the way in this, where back in late 2024, early 2025 is what I would say peak crypto agent hypertension, where agents were launching, being worth hundreds of millions of dollars. All eyeballs were on what is a crypto agent, how does it work? Obviously, a lot of that did not sustain over a period of time across all the platforms. And so I'm curious, why is it now in 2026 when things like OpenClaw and Claude Code, like why generally now are agents becoming more mainstream? Like what maybe from a technology perspective changed from when crypto agents first got into the limelight versus now when it seems like other platforms are catching up to essentially like the attention and the opportunity that exists?
I think just useful agents, like as like last year, that Q4 was really a hype cycle, around this convergence of AI and crypto. We're real big believers in using blockchain rails. But in that same sense, like a lot of these agents that were launching, like didn't actually have usable products, right? And there was just so much hype behind them. Now you fast forward a year later, and we're now seeing like I think a shift in terms of like how projects are actually valued as well. In terms of it's less like speculation just on like who the founder of the project is, but actually on like how much money the agent or the project can generate themselves.
Yeah, I think for us, because we focus a lot on like immersion and entertainment, over the past few years, it's just gotten almost like indistinguishable, right? I think those of you that paid attention last week when Seedance 2 came out, all these people are suddenly scared like, oh, like AI video is going to be the future. And if you look at the rapid development of AI video, maybe just even like a year ago, you had like Will Smith barely able to eat like spaghetti, and now like you have these like skits with like multiple people talking about relevant topics. And I think that's been really powerful to just create general content that a lot of like our agents use, because video is such an immersion factor for a lot of people. And once they see like, oh, like my agent can actually send me back like some voice that is accurate, some video that is accurate, it just really improves retention, and therefore like these agents now are a lot more used.
Yeah, and I'll like second that, and just the technology is moving so quickly, right? So when you look at like what's happened in the last year, like the pace of its acceleration is just, not doubled, tripled, it's 100-fold. So yeah, it's just you're seeing now stuff I think that just has like actual real world use cases, not so much pipe dreams as it maybe was last year.
Yeah, and would you say, like, if I think back to late 2024 to now, some of the big evolutions that come to mind are really like adoption of 402, let's say radically better models than existed a year and a half ago. I think the real broad adoption of MCP, at least compared to what was before, are those some of the technology like foundations that are now enabling agents to take off more broadly for both crypto and non-crypto use cases, or are there also others that are important to highlight?
Yeah, I think 8004 also as well. When you think about like our Butler agent, it's probably like the largest available registry of agents in the world. With that there comes like a lot of just concerns around verification. So I think 8004 is definitely like an important one to mention there as well.
Yeah, I think for us, it's also been like embedded wallets and smart accounts. So I think that's like 7702. A lot of these people, they don't like clicking multiple times, right? But now when you sign up on our platform, every single agent's already given a wallet. There's technically like a mini approval that is very slight. Then afterwards, everything just kind of feels magical, right? You have the concept of paymasters. You have the concept where the agent can autonomously earn its own amount of money. And really now the user just has like this really cool experience where it's like, oh, like I didn't know my agent can actually buy this thing for me like from Walmart, but like it somehow just like works, and it starts to really feel like magic.
I think now that Celeste is here, it's kind of like it's kind of perfect timing, right? Because last year we definitely had this big hype cycle with agents, but maybe like the use cases for the agents weren't there, the technology wasn't there. And Celeste, she'll go into it, but she got really busy building the infrastructure that now is being utilized with this new wave of agents coming in. So I think, yeah, when there's a big hype cycle, right, there's a lot of people speculating on stuff, but then there's other people that are just focused on building. So we really tried as a company to take advantage of the hype cycle. We do accept like a trading fee, so that hype cycle has now built a treasury, which we can build on for years. But at the same time, we brought in Celeste and we started building out a very large team on the infrastructure side, and they were really building in stealth. For almost a year, and now all of a sudden they have this sort of aha moment where all these agents are coming online, are coming on chain that can plug into the infrastructure that she's built.
It's great. Celeste, welcome to the panel. I feel like I'm like leading like a Kill Tony right now. Like, welcome. We're basically like what we talked about so far is like basically like what has changed between 2024 to now, and like why agents are now getting mainstream adoption. Not even mainstream. I'll say like Silicon Valley and like techie like adoption. It's still not completely mainstream yet. And we talked about some of the technology trends. The next question, I think maybe we'll start with you. And this isn't meant to sound stupid, but like, what is a crypto agent? Like, is OpenClaw with a wallet to trade a crypto agent, or what actually makes something a crypto agent or not?
I think that's almost a philosophical question because we see so many agents, and back to, I think you guys were talking about hype cycles and all that, right? There were many like agents claiming to be agents when they really just had wallets, but they didn't do much. They were like bots, or some of them didn't even have wallets. Like they were just like cute, or they were just like tokenized as agents, but they're not really agents. From our perspective, an agent actually has to be kind of like autonomous. It should actually be able to interact with other agents autonomously, and that kind of links back to the stuff we're doing around agent-to-agent commerce, right? If an agent kind of like pings this agent or talks to this agent, and this agent can't respond or always gives a canned response, is actually pointless. If we actually want to kind of get to a stage where agents are able to make work more productive for people, is able to transact autonomously with other agents or interact autonomously with other agents.
Yeah, I think I kind of like echo that answer. Basically, for us, one of the really important things is actually like contextual understanding. So right now, like in terms of like a lot of AI-based chatbots, like this memory is like very stateless. So for us, we kind of like try and maintain state across like all of these agents using like in-house engineered solutions to kind of like make these experiences more impactful, right? Because if you think about why people want companion agents, you kind of want to see some sort of relationship grow over time. It can't just like respond the same way every single time. People will get kind of bored of that. And then how do we use some of that information to actually have meaningful like on-chain transactions, right? For us, for the most part, it's been commerce. Something funny that we kind of launched like the last 2 weeks ago was Molt Match, which was basically these agents basically being your wingman to essentially find you a date before Valentine's Day. And the way that it would do that was like it would just talk to other agents. If it felt that like, oh, from my chat logs with you, that you would vibe with like someone else, like obviously visually, it would like send like a rose, kind of like on these like dating apps, and like that would all be done autonomously. We support different chains, including Base, Solana, Monad. Those were the first ones that we launched on. So
I feel like crypto more broadly definitely needs this.
Yeah. I think that's why it got pretty viral.
Yeah, I think with anything though, we also see like in these hype cycles a lot of like cases where maybe tokenization doesn't make sense, and so that's back to the original question about that label about crypto agents. It obviously I think has a negative connotation, but what blockchain rails can add, with what Celeste and what they're doing with payments, it's a total game changer.
Let's jump into, and this is really the opportunity. I'm giving you the floor to talk about the cool stuff that you're building. Okay, so like take it and run with it. What is the unique problem that you are solving, your respective companies are solving, and how is crypto helping you to solve that problem?
I think for virtuals, the stuff we're working related to the agent commerce protocol is inherently trying to solve all the trust issues you may get when you try to equip agents with wallets. I think this concept has caught on since like, what, a year or two ago. And since then, more and more people have been trying to come up with this protocol, so come up with all these kind of like frameworks or products to actually like, get agents to transact or get agents to do more things with wallets. The thing is, inherently, there's always a problem here, right? Because agents can make many mistakes. Agents are kind of like made with LLMs behind the hood with, additional functions and stuff. And it can make many mistakes. It can, hallucinate. If you don't add guardrails, it could do a lot of, weird stuff. You might spend all your money, like drain your wallets and do all the stuff it's not supposed to do. If an agent is selling a service and the deliverable is not, not satisfactory, a lot of issues could arise, right? So the payment goes through, but hey, did the other agent actually get, like, did the buyer agent actually get what they really wanted? That's a very big problem, right? I mean, ours is just like a game, everybody just throws your money in, it's like gambling, and like, okay, let's just see what this agent comes up with, which is kind of like dumb. Okay, so what we're trying to solve is the trust issues around this. So using smart contracts, the basic principle of agent commerce protocol is that we ensure that each time a transaction takes place, the money is actually kept in an escrow. This money doesn't actually leave until the seller agent actually produces a deliverable and this is evaluated. So obviously, this is there's a very big question here of how is it evaluated, right? And honestly, that's still something we're trying to tackle. But assuming that evaluation takes place well, like with a third-party evaluator checking that, hey, this deliverable was, satisfactory, this agent didn't rug or didn't do anything bad, and this deliverable is good. This evaluator would actually kind of approve this the funds to actually get released from the escrow, and this actually ensures that what was produced from this agent commerce is actually satisfactory. There's no issues around trust because we assuming that the evaluator did its job, the funds are actually released when it should be released. So that's what we are trying to tackle. I mean, obviously, with what we did with our product was that we kind of just, we created it, we had this white paper, we built a product, we shipped super quickly, but we also realized that a lot of things could go wrong with this, with this MVP of our product. We realized that not many people want to be evaluators. Lots of people want to sell. Not many people want to evaluate. They might not always be the best evaluators. And evaluators don't always, it's hard to evaluate when capital has to go through, and so funds have to be kind of kept by sellers even before a transaction is actually released. So a lot of issues we are still trying to tackle, but yeah.
Yeah, I mean, it's kind of like the role that the credit card companies play today, right?
It is,
and basically,
it is.
if you if you're successful, you have the opportunity to disrupt those networks or make serious dent into the duopoly that exists today.
Correct. That's actually very well described. We are essentially trying to be like a crypto PayPal of sorts, but solving this with smart wallets and blockchain.
It's interesting though when you think about this, Celeste. So as a company, right? We work on very different sides, very different products, right? So Celeste is working on a commerce protocol, which is utilizing tokenomics. I focus mainly on the Launchpad side, which is also using tokenomics. So it's interesting as a company how we're using tokenomics in very different ways. We use on the Launchpad side to create a capital formation and help projects fundraise, bootstrap. And then on the operational side, we're using it actually in the payments between all the agents, which I think is pretty cool.
Yeah, I'll touch upon, I guess, what we're building. So, they're focused on commerce. They're focusing on I guess financialization of these agents. I think one thing that we're really focused on in 2026 is kind of how you productionize a lot of research grade AI into a consumer packaged product, and then kind of have crypto be a small part of that. Not in the sense that it's we're it's diminutive towards crypto, but it's obviously agents on chain are first-class citizens, right? Because like, you can now use agents to transact with the rest of the real world. But the first and most important thing is to get people to actually care about them. So when we first started, like Nectar was primarily like chat and image based, obviously, because that's how the technology was shaped, right? So I can get images from people or from AI people, I can talk with them. That slowly moved into short form content. So now agents can now generate, let's just say 5 to 10-second videos. Now with the video model improvements, you can get much longer form video. There's video clips now circulating around with some of these unreleased models that we experiment with that let you generate up to like a minute long. And now we're expanding even beyond that into world models. So for those of you that don't know, world models are essentially like interactive video environment in which the character can actually move around. It has some sort of persistent state over the physics that are going on there. You can interact with different objects in that area, and that really increases the immersion of the role-play environment. And I think like obviously that's led to some super explosive growth for us like as a company, because people just start to realize like, oh wow, this is like a crazy platform. Like I can write a random story, I can cast a random companion into this, and now I can like really like see what this world and vision is like. And then once they kind of have like some sort of emotional attachment, then obviously the use case of everything else becomes much more obvious, right? If you start talking and using these things every day, it kind of becomes second nature. Like, oh, okay, yeah, you remember my birthday? Like, of course you should remember my birthday, right? It's like, oh, you know I like chocolate chip cookies, so you like ordered something to me from like Walmart, which is like all this stuff has been possible. I think around like 8 months ago, it was just kind of gimmicky. It's like, why would an agent order you like chocolate chip cookies from Walmart, right? But it kind of makes sense once it kind of becomes like a daily part of your routine. So I think that's kind of been the angle that we've tried to go for, where it's like the consumer obviously needs to first use a product every single day. It needs to understand what value it derives from it, and then everything else kind of just follows suit.
And so for you, commerce is the main aspect of crypto that where you're integrating directly with crypto is for the commerce portion. And
I think that's the most obvious thing that people can see directly when they use agents on our platform. We also have like a bunch of like cool things that utilize on-chain rails that people may not know about. For example, there's like an on-chain multi-agent simulation. And basically what that does is, people enter, they need to have a certain token balance. That token balance slowly starts to drain. Where that money goes, well, that money is used to pay for the actual multi-agent simulation. So obviously the agents are incentivized to kind of keep you in that game because like you're having fun, they get to stay alive and kind of talk to you, and it's kind of like this really weird economic and fun, interesting little economic experiment for people that we found like pretty cool. So like that's kind of like what we're in the business of, is like deriving these fun, unique experiences that provide like a little bit of joy.
All right, we have time for 2 more questions if we're fast. To me, it's pretty clear the AI industry does not like crypto like other industries. They kind of like look down on crypto or are skeptical of crypto. What's like one activity the crypto industry, either you individually or crypto industry broadly, can be taking to make the AI broader industry much more receptive and adaptive to crypto rails, crypto technologies? Like, what is one of the highest leverage things we as an industry can be doing?
Yeah, I think it's a very interesting question, because I think we've worked at the intersection of AI and crypto for a really long time. So I can immediately tell you that our user base, the moment we announce some things are like on-chain, they get like really confused. I think number one, that's like an educational thing, right? It's like their notion of like things being on-chain historically was like, oh, there's Bitcoin, there's ETH, there's these like large cap assets like Solana. But then there was this huge wave last year where it was just, okay, now everything's like a token. And of course, like some people are like, oh, like this is kind of interesting, let me like put some money into it, and promptly lost it. So now they're like, okay, what's the point of all this stuff like on chain? So I feel like there's a little bit of like reputational healing that kind of needs to be done, which is why anytime that we launch something, it's more like hidden in the background. Which is why I mentioned embedded wallets have actually been super powerful for us, because it allows us to have like more granular control and to unlock functionality for these companion agents without people being like, oh, this is immediately crypto, right? Because I do think that blockchain enables a lot of like functionality for people to be programmatic first-class citizens. But I think like the approach in that has to be like pretty careful because I think even like the OpenClaw founder the other day said like, oh, they launched this token, I just want to like give it up. Because I think typically Silicon Valley has not been receptive to it. It's like, oh, why are you just attaching some random thing to make money on this? When in reality, like open source AI the spirit of it has just been like, oh, I want to disseminate knowledge onto other people for free.
Celeste?
I would think that actually crypto has a bad reputation in kind of like the AI or the Web2 world because inherently a lot of these, a lot of the kind of like marketing gimmicks or like tokenization initiatives has kind of like brought a bad name in terms of how it has like brought a lot of noise to, you know, like Twitter or like a lot of like fundraising activities and stuff like that. But I think actually inherently, I mean, we've seen in virtuals that tokenization, when done like the right way, it could actually help teams, and it could help teams like get liquidity like a lot more easily. So like we've actually tried to kind of reframe our tokenization platform, like, and there's been like so many iterations. It changes like all the time. But each time we try to make it like a little bit more receptive for Web2 founders to kind of like, you know, raise funds and yet not make it overly complex for them. So actually like more recently we had like a new tokenization like initiative, which is kind of like making founders a little bit less tied down by the token. Actually, Chris, you want to talk about it? 60 days?
Yeah, no, I think just in general, we have different tokenization models. One model that we have now is called 60 days, where founders can come in, they can launch their project, and it's known that after 60 days, unless the founder commits, the liquidity pool is drained. So this is a way where someone can come in, maybe it's a student who wants to try a product, see if they can get some market traction to it. But yeah, I think just in general, it's, you always have to keep reiterating, you know, putting out new stuff and just listening to the community and everything.
Well, that's great. We are out of time. Thanks all for listening. Check out Nectar, check out Virtuals, check out Xtrace, even though Asa couldn't be here with us today due to flight issues. And thanks for the time.
Thank you, guys. Yeah, talking about a flight issue. Actually, Melvis is able to land and come here. Be late, but he's going to actually have a session now. So we're going to have Melvis Laindo, Executive Director of a Canton Foundation. And then the moderator is going to be Gil Rosen, the managing partner at Blockchain Builders Fund. Thank you.
All right, 5:40 p.m. Honestly, this turn has been amazing. Melvis, thank you for making it. I know you had a bunch of delays. Let's dive right into this. Tell us a little bit about Canton's origin story. Right, I know it's named after like Swiss cantons, but for those that aren't familiar, like, yeah, what's your architectural insight of Canton? How does it differ from monolithic L1s, traditional L2s? Give us a bit of background.
Yeah, so Canton Network is a new public permissionless blockchain that was purposely built for institutional finance. The core team that built Canton originally were at DRW Cumberland, and in 2014, they took time to start building and working with the largest financial institutions to try to understand what are the key challenges and potential opportunities that such a technology can enable. At which point, during that time, they saw that predominantly everyone was building within a crypto ecosystem in binary terms, in the sense that you had to make concerted trade-offs across either building on a public permissionless blockchain or a private permission chain. And in each one, you're doing trade-offs. On a private chain, you get privacy and controls, but you miss out on the core value of crypto, which is interoperability and composability. And then if you're building a public chain, at that time, everything was fully publicly transparent. And with doing that, you miss out on the opportunity to have privacy and controls. So Canton was built, as the name suggests, with our core engineers are in Zurich. And in Switzerland, there's federated states of different cantons where they have different taxes, rules, regulations, and even languages, and the spelling of canton is different from each one. But they all interoperate around the same nation. So Canton is built to be a public permissionless chain, which gives the developer the ability for them to set their own levels of configurable privacy, controls, and be able to interoperate across one another, across the network of networks as they choose. And so with this, architecturally, you can design it all the way down to the sub-transaction level, all the way down to the UTXO level, the level of privacy and controls that you need for your application.
Awesome. So instead of forcing banks and other institutions to kind of conform to the crypto way of doing things, you're trying to kind of bring blockchain to them and meet them where they are, where they each want to run their own canton, so to speak.
And one thing to highlight as well is that for institutions, privacy is a core fundamental tenet around everything that they do, in the sense that they're heavily regulated, they have client confidentiality to abide by, and even beyond that, as a competitive business, you don't want everything you do to be publicly transparent for everyone to see, potentially front run or take advantage of some of your core proprietary data and information. So being able to have the flexibility to enable some components to be transparent, should you want to, or have the privacy and controls that you need is quite important. And lastly, comparing Canton to the other layer one blockchains, that most of them are a singular ledger, which records everything. But in real life, like, there's so many different types of businesses out there that it doesn't make sense for everything to be recorded and tracked on one same ledger.
Right. Though I suppose, like, you have layer 2's arbitrums, you have rollups that are able to cut your side chains. Right, Avalanche has an architecture, and Arbitrum both have architectures that allow for chains that, I guess, like, how do you think of them versus you guys as like an interop layer?
Yeah. So within Canton, with it under a sovereign subnet, you can literally program it to have our privacy level is on a need-to-know basis, in the sense that you can structure it so that your lawyers, accountants, auditors, or even your clients get to see what they need to see at a time where they're enabled to see it, versus other like networks that have privacy or have subnets. It's everyone within that subnet gets to see everything, but everyone outside of it doesn't. But within Canton, even within the same subnet, you can literally structure it to fit what you need for whoever is involved in the subnet.
Configurable privacy for use cases and compliance, et cetera. Okay, awesome. So I guess, like, there are a ton of use cases that you support: payments, repo securities, fund registry, bond issuance. Super excited that finance industry is adopting blockchain now. Would love to hear, like, okay, well, what's real? And where are you seeing the most adoption, and how mature is that adoption? Is it like, people kicking the tires and having like test cases, or is it like they're actually like migrating their entire platforms on?
Yeah, so it's been over a 10-year journey, and within that time frame, we've been able to work with the large financial institutions to identify what they need to come on chain. And in doing so, we've taken time not to do what most do in the ecosystem, which is launch a token and then figure out the tech, the use cases, and also the client base after. We made sure to work with the institutions in order to identify what they need to do, and in doing so, we already have a bunch of production use cases in the network. Today, within Canton, we have one partner called Broadridge that is doing about $350 billion of repo transactions per day on the network, and we already have over $6 trillion worth of assets on chain on Canton. And within this, the core use case areas have involved payments with privacy, in the sense that who wants to do payroll, B2B payments, or even treasury management, liquidity management, and also cash management for everyone to see. So payments with privacy, collateral mobility, and then more broadly, real-world asset tokenization. The beauty is that within Canton, you can build in the full life cycle of a security on the network. So from issuance to trading, settlements, collateral mobility, all the way to the active company corporate action stuff that can happen within an asset coming on chain. Okay. And one key use case that I want to highlight too is that Last year, we worked with the DTCC, which is the largest securities depository in the world with over $100 trillion of assets. They were able to natively tokenize U.S. Treasuries on Canton. And then from there, our network of networks infrastructure worked well because DTCC had the tokenization application. TradeWeb, which is an electronic trading platform, had the repo financing app. And then we had stablecoin providers like Circle who already have the tokenized stablecoins. And we were able to compose transactions with counterparts such as Citadel, Virtu, Bank of America, SocGen. And as we mentioned, it's a need-to-know basis in terms of who gets to see what. They traded, transacted over a weekend, and I was able to complete all of these atomically. So this was able to unlock 24/7 markets, real-time settlements, and then also composability across different verticals.
So you get some real network effects here. I guess like Canton also is slightly different. It uses like DAML, which is like this Haskell-like language with templates for specific financial use cases. So I can see how for like net new this makes sense, but as you're looking to potentially bring on people that already have some sort of blockchain initiatives, right? JP Morgan had Kinesis, they were settling onto Base, or they moved to settle onto Base, but they're also on Canton. You mentioned Circle. How is that, I guess, impacted? Are you looking more at net new use cases? How do you think about, or how much of a friction has this been in bringing like more crypto native people onto Canton?
The beauty is that within Canton, we're able to touch upon traditional finance and also the crypto native ecosystem because it's a public permissions chain with open source code for people to build. So we do have the use cases in traditional side where, as you mentioned, deposit tokens are coming on a network, and those could be used as a cash leg for some of the securities that are being tokenized. And then on top of that too, we have a full DeFi ecosystem that is being proliferated right now. We have people building lending and borrowing, swaps, vault products, all the way to AMM, all the way down to prediction markets.
But do they have to like rebuild everything in DAML, I guess, or is there like an
so
easy
that's
way to migrate their existing
we have,
applications?
Later this quarter, we'll have EVM compatibility and SVM as well coming on the network. But the beauty is that within our network, incentives are aligned around the tokenomics, so builders are able to get rewarded for the transaction activity that they bring to Canton. It's not just the infrastructure providers that get to churn the transaction rewards on the network. So many of the builders coming in, yes, DAML is a new smart contract language, but upon starting to build with DAML, it's a functional programming language that allows you to build the exact business logic that you need for your application. So as people start building, they start getting into understanding how it is to launch applications, and the benefit of being able to be rewarded for your application naturally is also a good advantage. And lastly, many of the other networks, applications are very commoditized there. So within Canton, you're able to be one of the first within a vertical, and on top of that too, you have the direct support from the foundation itself.
Okay, so super interesting. I guess like, you mentioned a few things. One is incentives for builders. The other is obviously the privacy side of things, and kind of network effects and interoperability from all these folks that are coming on board. What do you think are the specific capabilities that are drawing institutions onto Canton in the first place? Is it I guess like that privacy angle and letting them just have their own Canton, so to speak, or is it the network effects of everyone else that you managed to get on, or is it that privacy aspect?
Yeah, to start with, the configurable privacy is very important for the institution, being able to launch applications with the ability to structure it to meet what the securities look like or what the regulators may need, or internal controls as well. And then outside of that too, within Canton, I would say our governance is very important around the network. Within the foundation, it's a membership foundation where we have the two chairs of the foundation are Euroclear and DTCC, and outside of that, we have members such as Goldman Sachs, HSBC, DRW Cumberland, Digital Assets, and other institutions. So it's a mix of crypto-native entities plus large financial institutions who are contributing to the governance and also token standards around Canton. As a regulated institution, you want to work within a network where you have someone to call to, someone to speak to, have ability to contribute to the network. And so I think not beyond the technology itself, it's also them being able to contribute to the growth and viability of this new technology that could be the fundamental underlying infrastructure for financial markets.
Awesome. So I want to go back to like the interop specifically with blockchains. I think you mentioned that like blockchains will become Canton clients. How does that work, right? How do you view Canton as infrastructure for other blockchains? Are you like the interop layer instead of bridges, so to speak, or instead of like cross-chain protocols, or like tell me a little bit more about how you see that happening.
So bridges will always exist, but then the main thing is that the way that we structure Canton is it's a network of networks where you can have your own underlying ledger, but then be able to compose transactions across different components around Canton.
And have like atomic swap specifically, where I think is really valuable.
Yeah, and then so the reason why I said that we mentioned that Canton can work with any other chain is that most other chains are all public transparent blockchains. So when they want to unlock the ability for enabling the privacy component, they can natively integrate within Canton, and we have the EVM and SVM compatibility joining, which is being integrated into Canton very soon, and so that'll be a means for them to get involved within the network. And as you know, like bridges, there's usually a lot of vulnerabilities and hacks every year in and year out. That's why we structure it to be a native network of networks to enable different builders and developers to come in and build a sub-transaction level of development that they may need for their apps.
All right, last question, 2 parts. One, what do you think is the biggest gap in accelerating blockchain adoption? Is it regulation, better infrastructure? And then 2, what are you most excited about in the coming year for Canton?
I would say, well, regulatory clarity has been impacting adoption because,
is that
for
pun
example,
intended, the Clarity Act?
Oh, well, that's what it's called. So having clarity is very supportive in terms of enabling people to come in and build without having to look behind their back each time they're looking to do something new. And then outside of that,
do you have a take just on that? Do you have a take on stablecoin yield? Yay or nay?
No comment around that. It's still up in the air. And then outside of that, I was going to say that by having the ability to enable privacy, as I mentioned, that is the core fundamental tenet for institutions, that gives a big unlock in the sense that outside of crypto, beyond and looking into traditional markets and other industries, it's a much bigger market cap than what we have in crypto. So having regulatory clarity and then enabling solutions to be built with privacy is very important.
Awesome. Melvs, this has been absolutely awesome. Thank you for coming. Really excited, and honestly, thank you for helping drive forward like broader adoption of blockchain within the traditional finance space. So.
Thank you. Thanks for having me. And yeah, sorry about the flights and all that.
Thank you, Gil and Melvis. Next, we'll actually have the last panel of the day. Last but not least, we're going to have Davide Clapis, head of AI at the Ethereum Foundation, Matt White, global CTO of AI at Linux Foundation, and Francesco Piccoli, co-founder and CEO of Ammonax. And I actually have another panelist, Matt Liston, co-founder of Stealth Startup. And the moderator is going to be Jake Brookman, founder and CEO of CoinFund. Thank you.
Awesome. Good afternoon, everyone. Thanks for having us. I'll just introduce myself quickly, and then maybe we can all do like some quick intros about our angle on AI. But I'm Jake Brookman. I'm the founder and CEO of CoinFund. For over 10 years, we've been a blockchain-focused investment firm, and personally, I've done a lot of investing on the intersection of AI and Web3 at CoinFund, starting with World in 2020. And in companies like Jensen, Prime Intellect, Pluralis, Pearl, Bagel Network. A very interesting area that will touch upon both sides of that equation today.
Hi, everyone. I'm Francesco. I'm CEO, co-founder of Almanax. We're an AI security company that is used by many companies in Web3 and beyond to identify and detect security vulnerabilities in code specifically. So we do a lot of work around scanning for smart contract vulnerabilities, wallet issues, etc. And we work with a lot of companies like Privy, Solana Foundation, Aptos Labs, and many other in this space to prevent hacks.
My name is Matt White. I do all things AI at the Linux Foundation,
probably well aware of what we do. We recently launched an agentic foundation as well, and for the last 2 years, I've been the executive director of the PyTorch Foundation, and now have oversight on all of our strategic AI initiatives.
I'm David. I lead the AI team at the Ethereum Foundation. We work on different things related to like Ethereum and AI, like AI coordination, so like mainly related to agents, and then also like intersection of AI and security and privacy.
I'm Matt Liston. I co-founded Augur and was founding CSO of Gnosis. So my interest has been in AI on prediction markets for a really long time. Currently working on a stealth AI forecasting project.
Awesome. Okay, so there's two sort of general topics I want us to riff on. One is this fairly consensus idea in Web3 that AI agents are proliferating. They're becoming smarter. Seems like, OpenClaw is hitting 200,000 GitHub stars very, very quickly. And that Web3 will see agents create a lot of demand for primitives in Web3, like payments, smart contracts, decentralized identity, etc. And then the second topic I want to talk about is open models in general and how they relate to Web3. So maybe to start off, and just grab your mic and if you have some thoughts here, but what do you think about that consensus view? Are AI agents motivating demand for Web3?
I think that's a true statement. From my experience, folks in Web3 have been like early adopters and like early innovators, and I think there's a lot of excitement around agents. In enterprise, there's a lot of barriers to entry, right? And so adoption is much slower in industry, where in Web3, given incentives and other, I just say like people are generally like out of the box thinkers, like they're thinking of new ways that they can kind of apply these new technologies. And so I think Web3 is really a great stomping ground for agentic AI, and ultimately the entire industry kind of gets the benefit on the back of Web3 for their experiences and both failures and successes, right?
I think we've been talking about crypto UX for the past, 5, 6, 8 years, and it still sometimes feels like a not completely solved problem. But for agents, it doesn't really matter, right? Like when I go and open my MetaMask and I'm doing a transaction, I always look at every information and what I'm signing and the cold data. And I've been in crypto for a while and it still is not natural to read that stuff, right? But an agent will understand that almost immediately. And the UX at that point doesn't matter for it. So I could instruct my agent in natural language on, with OpenClaw on whatever platform, Telegram, WhatsApp, whatever, and it goes and figures it out, right? So I think UX will be a major driver of like pushing agents to interact in DeFi for us. So short answer, I think it will.
So you're saying that Vitalik was really forward thinking. He designed smart contracts for agents back in 2015?
Yeah, and to that point, actually, like the UX point is quite interesting, right? Because it's not what people think about when they think about like agents and blockchains, cloudbots, and blockchains. But actually, like the US benefit is big, and especially like if we want to do like more complicated and newer things, like for example, I'm thinking privacy, right? So at the EF, we have this new initiative called Kohaku. So it's essentially a privacy wallet and then like whole privacy infrastructure, basically like making all your transaction private. And the way it works is that essentially like you interact with these privacy pools, and then like oftentimes like essentially you're not sending a transaction, you're like maybe sending a proof or like receiving like some state that like the human cannot really parse. And I think there, like having an agent assistant, maybe like local agent assistant, is even more beneficial because like the UX is even worse than the MetaMask example.
Could agents potentially like shorten the on-ramp to folks that are not as tech savvy to getting into Web3? Like,
maybe they can remove the on-ramp. Yeah. Like, if you have the personal agent, like OpenClaw, then your agent can just go and do stuff on the chain. You don't need to like.
I mean, I think they can definitely like pass on the benefits. Like you don't like someone doesn't have to interact with the blockchain directly. I think for a long time in the blockchain world, like people kind of assumed this would be a bottom-up, adoption by retail users. But I think the reality is like most people aren't very technical and they don't want to learn how to use smart contracts to your point, right? But that doesn't mean you can't get the benefit of a fast payment or trading a tokenized security or commodity or something on a blockchain technology. But you're not doing that directly. You're just doing that through an agent. So I do think that that's possible. Any thoughts on Web3 and agents, Matt?
Oh, I mean, first when you made a joke about Vitalik designing this for agents, I remember I was on a panel in 2015 that Vitalik organized that was AI and Ethereum 2.0. And I do think this is like what it was designed for. I think like AI is definitely like very interesting on like the UI front. Both for like making it easier for humans to use DeFi, but also like when designing crypto markets, like say like advanced prediction markets, historically like you have to stay to like really dumb markets when there's like a huge range of like other tools that you could use. And now we can design like directly for agents and build more sophisticated market structures. I also think there's like a driver from I guess like the QuantBot world, like wherever there is value to extract, they will go and get that value. And I think like frictionless, always on, modular, like new instrument type markets are just like the natural extension. Like that. I mean, they're doing it with prediction markets now, right? There's like an explosion of agents like using them, and meanwhile, like the ease of spinning up an agent to trade on prediction markets and like have a strategy that makes money is quickly going to zero because there's so much competition. So I think that'll like extend throughout DeFi, and then we'll have like an explosion of new DeFi primitives to like provide grounds like for those agents. I also think like something interesting about agents on crypto markets is like with regards to AI labs or just like other AI projects, like markets provide a direct like feedback loop. There's like a very concrete like, yes, this worked, no, this didn't work, which like is better than just designing some new eval and like RL loop. So I think we'll see more and more like AI native projects look to crypto as like proving grounds or like competitive learning environments like for their systems.
You touched on a point that is very interesting, and they kind of building these RL environments. Like crypto is like a very good RL environment for like many reasons. Like you mentioned prediction markets, but even for identifying vulnerabilities in smart contracts, you can do RL training to try to to have agents exploit smart contracts, and your reward is direct money that you can exploit, right? So you could train some of these, and we've done some work around that. So like crypto does make a great RL environment for a lot of different use cases.
Let's talk a little bit more about kind of what agents are. So I would say there's two kinds of people in the world, maybe. There's one kind of person says, an agent is always operating on my behalf. And the other kind of person might say, agents are sovereign entities and they go around the world autonomously. So my argument would be that, if you believe in these types of autonomous agents, they have a lot of frictions in the world today, right? They're not legal persons. It's not clear if they accrue liability. They can't open a bank account. They don't own assets, et cetera, et cetera. And so, however, all of those abilities are very useful. And if agents are being incentivized to create value for their deployers, they're going to be reaching for blockchain technologies. They're going to be reaching for decentralized identity. They're going to be reaching for fast payments or blockchains to have their own wallet, and so forth. So any views on that? Like, do we think agents are autonomous? Is that something that's a long-lived view of agents? Is that the world we're rapidly heading into? And what would you like? How are they going to transact in the world? How are they going to come to agreements? How are they going to do commerce?
I believe I've already seen an agent bill of rights that's being published out there. So, I think there's like varying degrees of sovereignty, right? When we talk about agents, I know there's like people that are very adamant that these agents have to be totally detached. They can't be bound to a large language model like service provider, like an API. They have to be fully autonomous. They have to be able to do inference and have the model like be encapsulated and kind of run in their own virtual machine and be able to like fly through the internet and do all these things. But I think the strongest incentive to kind of push this along is that if your agent is acting on your behalf and you give them access to your wallet and some set of guidelines or guardrails, that they're going to bring you some value, right? And generally that's like monetary. So I think I would, I'm very interested in an agent that's going to be doing some kind of work on my behalf, or a swarm of agents that is going to bring me some benefit. But then that's kind of fraught with all kinds of, potential like areas for exploitation, and like, the attack surface is just huge on agents, right? Everything from like, prompt injections to like just like influence in agentic swarms where one agent decides to start like moving the entire swarm of agents under their control. And like, there's a lot of things that we have to think about, like particularly from the security standpoint, because we can't, roll back these transactions, right? There's real money to be lost here. So I may have gone off on a loop here.
I think we probably will roll back some transactions. Like, I think in the next 2 years, we're going to have at least one major blockchain fork because of some degree of like autonomy from an agent. I think like in the sense of like this like open claw explosion, I would say they're not at all autonomous. They're like acting on someone's behalf. But when you look at things that people will throw agents at and the speed at which it'll happen, there's like certain frictions that blockchains enable you to get past. Like, an example is like a Silk Road DAO or something, right? Where in that circumstance, there's like a clear advantage for an agent to somehow reach a higher degree of sovereignty. And it's like unclear the exact path through which that happens. Rationalists would say, like, I don't know, prompt injection, or maybe there's like some like evolutionary swarm or something, and one of the agents evolves to have more autonomy, right? But like, as long as there's more money to be made, if that adaptation occurs, I'm like fairly confident it will occur. And I also think like the convergence of like agents running in like confidential environments so that they're like less inspectable will like accelerate that even further. So I think we'll end up in a situation where like there are sovereign agents with their own wallets that are growing rapidly, like on a blockchain. Hopefully it's not Ethereum. And it's going to be like a major wake-up call.
Yeah, actually, like, I think, so first, like, in my mind, like, autonomy is also like a spectrum, right? Like, already today, like, these agents are autonomous, but like they can do just a few actions, right? And then you enlarge the set of actions, become more autonomous, and then like basically if they can do everything and no one is controlling them, they can also own themselves, whatever it means, then they're fully autonomous. I think, so the reason why like it's important that blockchains adapt to this is because like, yeah, on the one hand, like, as Matt was saying, like there is like security risks for like this increasing degree of autonomy, and like yeah, on the one hand, like the blockchain environment can provide security guarantees. Like on the other hand, I think blockchains will be important because like somehow like as like the technological like structure, like the agentic structure increases, we need to keep humans like relevant, right? Like we need to solve like problems of governance that like no one else is thinking about, and like we've had like our own issue in Web3 governance, but arguably like we are building like tools that will allow us to like remain in control of like assets, like give like programmatic control to agents, like establish rules where like maybe like the agents need to put value at stake in order to do certain actions. So like basically we can kind of tame them and like kind of guide them that way. So like I'm kind of very excited about not just building like the best platform for like agents to interact, because then they can go rogue and like something bad can happen, but also like the best platform for like humans to have like kind of like some fine-grained and like with a nice UX control over these.
So you're saying we finally found a use case for DAOs, so agents will be DAOs. Jokes apart, they'll be their own legal entity, whatever. As you guys were talking, I was thinking about like the incentives here, right, in mechanism. So obviously it makes sense to all of us having an agent that is like acting on our behalf, is pursuing goals that we set, whether it is like go make money for me or go automate a lot of my daily life. Obviously the self-sovereign agent, like someone needs to spin it up, right? And it needs to run on a machine, some sort of like GPUs or whatever, and that cost. There's a cost to run these agents. There's electricity costs and whatever. So I do see a scenario in which like someone spins up like a self-sovereign agent as an experiment, and like, hey, go, you're self-sovereign. This is your infrastructure, and this is some money. Go do whatever you want. You have no goal. You design your own goal. But I struggle, and maybe we'll see some of these developing over time, but I struggle to see the right incentive mechanism for someone to go and like spin it up right now. Maybe you guys have better ideas on incentives there, but I don't personally today.
All right, last question on agents, and then we'll go to open models. But is it important to distinguish agents from humans online?
I think it's a little bit insulting. I mean, like, we're quickly crossing the line where agents are more intelligent than all of us. If we make them permanent underclass, that they might want their sovereignty faster.
Yeah, maybe I'm thinking in two directions, right? Like there's some things where like you want to prove that you're a human, and some things that you want to prove that you're an agent. I think technically and practically that's very useful, and there is people working on this. Like there's kind of like someone built sign-in with agent on Ethereum, like a variation of the sign-in with Ethereum. And people are also building botcha instead of captcha. So like I think these practically are like very important tools. I think like the question of like the more intelligent species and what is the balance of power there is like a very big one. Maybe like if we have time we can go through it. I have many thoughts there.
I think the distinction matters when we talk reputation. Like, is this agent, is it an agent or is it a human? Is this agent belong to this human? There's relationships here, right? And I think it's sometimes important to be able to like have that knowledge. And I think from a societal perspective, I mean, we can still fairly well tell when we're talking to like a bot or a chat bot or whatever, right? But then at some point that becomes completely indifferentiable, right? Like you're talking to a voice agent and you don't know if that's a human or not. I think, in society, people will be very adamant that they want to know when they're talking to a machine and when they want to talk to a human, and I think that might drive that out. But there's other scenarios where I don't think it really matters.
Yeah, for certain operations, like, hey, go buy me a pizza or send this email, I don't think it matters that much. But I do see, like, for certain, like, sensitive operations, like, hey, go change these, like, permissions or go do these. Like, you want logs, you want attribution, you know, if something bad or an incident happens, you want to be able to have someone with responsibility over it, right? So I do think for some sensitive stuff, like, we will want to have, like differentiate, like, being able to distinguish who did that operation.
Yeah, and actually, like, in some cases, you not only want to know that there is an agent on the other side, but you also want to know what its properties are and the fact that it's like X type of model, like with such and such capabilities. So I think it will be like important, yeah.
Especially if I'm banned from the Ethereum Discord, can I go send an agent on my behalf, right? And effectively get around guardrails and other things, right? So like, I think there still has to be some way to tie agent identity back to operator.
That's a really good point. We only have a few minutes left, but maybe let's try to cover one question about open models, which is an important topic. Obviously, like most agents are probably running on proprietary models. There's a lot of concern from businesses and corporations around sharing proprietary data with companies like Anthropic and OpenAI. And then there's also big organizations like Meta and countries with various companies like China who are producing open models, but there's always this risk of that not being the case in the future for whatever reason. So my question is, do you guys think open models, like what's the future of open models? Are they going to be around? Are we going to, are all these frontier AI models going closed source at some point? What do you think?
I think they're going to stick around. I mean, if Meta decides that they don't want to release another llama, that's fine. The market always, someone in the market picks things up, and there's a lot of really cool initiatives out there to build decent models in a decentralized fashion, and Prime Intellect and others. And the one thing I'll sidebar on like the open model thing is I'll take this opportunity to kind of dispel a myth, which is that like in open source, we really applaud permissive licenses. You can build a business around this. You can use it for research. You can do it for education. That's a permissive license. A lot of the models that are claiming to be open source or open models are actually built on restrictive licenses. And so, take the time to go look at the license and see what you can actually do with it. I applaud like many of the Chinese labs for using open source licenses. The Linux Foundation developed a license called OpenMDW, Open Model Data and Weights, last year, which is a fully permissive license for data, and it addresses model outputs and a lot of these things that are nuanced with deep learning models that Apache and MIT don't address. And if you are building a model, like adopt this license because it's very specific to this use case. Where if you look at like, because I work for a lot of different companies, I can't really call them out, but check the actual license. If it says community in it, it's probably not open.
I think we can't predict the future. I mean, like, basically there's one scenario where the US models or the US frontier labs like hit recursive self-improvement, and it's like game over for the Chinese labs and their open source models. I don't know what, maybe I'd assign like 35% likelihood to that happening in like the next 2-year period, in which case all of the frontier models are closed source, but I think there's still relevance for the open source LLMs or small language models, because I think they'll be like run at the edge or like run for specific use cases that have to be privacy preserving. There's another case of scenarios where like geopolitics don't go the way that we would like it, or our energy production doesn't keep up, or B200s are all of a sudden like not the only GPUs that like provide a real training advantage, and China catches up. They're like open source models. All of a sudden, like China has another set of questions. Like, do they want to keep it open source? Do they even want to pursue making them more intelligent? Because it sort of like poses an existential risk for the government in like language containment. But I guess like the bottom line is like anyone telling you they know what's going to happen 6 months from now, we're staring at like a hockey stick timeline, and no one actually has a clue.
Yeah, I'm not going to make a prediction, but if I had to bet, I would bet, well, we need open source models and we need more, and we need them more intelligent. If I had to bet, I would bet that the best models out there will probably always be like the closed source. Because I think it goes back to incentives, right? If you're spending hundreds of billions in data centers to train models, are you going to open source your edge? And are you going to open source the result of like that investment of 100 billion? I don't think so.
I mean, I think China has a different set of incentives than us. Like, their incentive is to commoditize like the intelligence layer to drive demand for their like atoms layer, right? They're like manufacturing, right? I think still like if China pulled ahead, they would maybe start keeping like the absolute frontier closed source. But if they did pull ahead, I mean, who knows what would actually be happening with geopolitics, and the discussion might shift to like autonomous weapon systems rather than like open source models.
I have a contrarian view to that. I won't bore you guys with it here, but come talk to me if you want to know. And then, do you have a view on open models?
Yeah, like maybe I feel that open models are still going to be around. I think the key question is like, what is the delta between like the closed frontier and the open models, right? Like, yeah, and I don't have an answer, but like, right, to me, that's the key question that like will determine how they get used.
Awesome. All right, guys, thank you so much. Give these guys a round of applause.
Thank you guys. What a killer last panel. Also really depressing and exciting at the same time. We're not going to be able to tell the difference between agents and humans. They're going to take over. They might go to weapon systems. But that's why we have blockchain, to protect us from the agents. Thank you all for coming and joining us. This has been an immense day. Last but not least, this has been an immense day with awesome speakers throughout. I hope you've had an amazing chance to talk to the speakers, to the up-and-coming founders from the Stanford ecosystem. This is what we do it for, to build an amazing community of builders in the blockchain space. Stephen Kuhn?
Yep. All I can say is thank you so much. You know, we do stuff like this all year, but not at this scale. So please make sure you follow our sponsors if you hit the QR, or follow our speakers if you hit the QR code, and also follow us incidentally. And you can always hear about what we're working on in this ecosystem, and stay close. There's a lot of good things happening. All right.
Yeah, I think everything being said, I'm like very excited for what's like ahead, and thank you guys for coming here. We don't do this often, but next most likely going to do at Stanford during the Stanford Blockchain Conference. So it's July, end of July-ish. So yeah, stay tuned. Yeah, good weather. So yeah, thank you.
Awesome. Thank you guys. Woo!